company will agree to provide a discount on outpatient drugs to state Medicaid programs so that the prices that the states pay align with that the companies charge in foreign countries. Now, do not forget that it would add to the 17 large-cap pharma agreements already struck since the last of September that Trump administration has been working on. So that's the update that we have coming in this morning from commentary coming in from President Trump. But on that note, we're going to slip into a very short break. After the break, we'll get you updates coming in on Nepal's flash floods. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now getting you the latest updates from the world of tech and AI. Nvidia has posted a blowout set of numbers. Revenue came in at $96.22 billion, up around 106% from last year. The engine behind the growth is data center business. Data center revenue alone touched $89 billion. That's now 92% of Nvidia's total sales. The guidance for the next quarter stands at around $108 billion plus or minus 2% on that as well. Let's listen in to CEO Jensen Huang had to say in terms to CNBC on the company's numbers.
Cost of building AI, the cost of deploying AI, it's very capital intensive. And there are several companies, these frontier AI labs, that are once in a generation companies. And we want to be investors in them. We want to support them. We want to be a partner to them. We would love for them to build their ecosystem on top of us, of course, and then scale up their business along with us. And so the opportunity to invest in them in the beginning was a great opportunity. Frankly, I just wish I invested more. And now that they're scaling up, the tokens they're generating are profitable. Their services are profitable. The number of customers is growing incredibly. The only thing holding them back out now is compute. Return cash to our shareholders. We're going to buy back stock and buy back stock. All the excess cash net of what we need for strategy and operations. And we are going to generate a lot more free cash flow next year than this year. Furthermore, this year we have several very large investments, and those large investments in the AI labs are not going to repeat. You know, the opportunity for me to invest in these frontier AI labs is not going to happen again. And the reason for that is because I expect them to go public.
Moving on, Salesforce has raised its annual revenue forecast, betting big on AI demand. The stock reacted immediately, jumping 12% in extended trade. Now, CEO Mark dismissed talks of so-called Sascopolis and said that was nonsense. Salesforce as well as Anthropic have jointly launched CloudForce. The plugin ships with 37 pre-built sales skills, and sellers will be able to update records without ever opening Salesforce itself. Meta has reached a settlement that ends a trial over harm to children on its platform. The company will now pay $17.6 billion to 48 states and 4 territories. In a separate settlement of $459 million covers the older Cambridge Analytica claims as well, and as a part of the deal, teens will be capped at 2 hours a day on the platform for a decade, and access will be blocked from midnight to 6 a.m. without parental consent. Bill Gates, moving on, has weighed in with a stark warning in 6,000 words essay. Gates says that there is simply no plan for the upheaval AI is about to cause in the jobs market. The flag sales support software as well as paralegal work as the first role likely to go. Gates wants some jobs deliberately reserved for humans, and he's calling for national groups as well as an international body to manage this transition as well. Now let's move on to some updates coming in from a neighboring country. Over 150 people were confirmed dead and more than 400, including around 133 Indians, are missing or out of contact after a massive flash flood in Nepal swept through the villages in a district bordering China's Tibet region. Officials said that the death toll could rise and that it would take days to assess the full extent of this damage. A huge wall of mud and rock collapsed into the river on the Himalayan border of Nepal and Tibet on Wednesday, triggering flash flood, which washed away houses, roads, border crossing as well. In view of the flash flood situation in Nepal, Union Home Minister Amit Shah spoke with CMs of Bihar as well as UP and assured all help to the border districts. The administration of these districts have also been put on high alert. And with that, we are absolutely out of time on this edition of Power Breakfast. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant with me, my colleagues Rima and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. So more of the same when you look at the global cues. Crude prices still at 87. U.S. markets consolidating, maybe a little bit of red as we wrapped up the trading session. But after that, very, very strong numbers from the tech majors, NVIDIA and Salesforce.
Both looking very good.
Well, that's right. It'll be interesting to see, right, how things react because the Salesforce beat as well had an AI element in it. And NVIDIA obviously is, the AI poster boy out there. So your tech companies will be in focus today.
Well, yeah. NVIDIA doing well is sort of negative for Indian IT companies, but Salesforce doing well is positive for the Indian IT companies. But, there's one company like NVIDIA, nearly $100 billion of quarterly revenues, doubling. And then you've got a Salesforce growing at 11% with the top line growth of $11-12 billion. Just vastly different. And that's why, one sector, the cohort did very well.
That video of Jensen on stage dancing? Not after the results.
Yeah, I've seen that. Yeah,
I think it was in Korea or someplace, right? I mean, there was a K-pop. He was kind of sort of dancing along, and someone.
He's a pop star, right? He just has to get up from his chair, and there's going to be a video.
Jensen after the guidance raise, but it's been a spectacular set. Absolutely. I mean, the numbers are so large, and then they're on top of it saying we'll grow revenues 70%, 80%. So just quite large. Oil, by the way, is unchanged. We were at $87 yesterday. We are at $87 now this morning. So there's not very much by way of change. Iran essentially said that they've reached a revenue sharing agreement with Oman on the Strait of Hormuz. This is something which, I mean, we kind of knew even yesterday, especially in the second half of the day. But does it solve the problem is the question. I mean, Iran and Oman, the two countries on both sides of the Strait of Hormuz can decide between them that we're going to charge this and that, etc. But the problem is the US and, I mean, everybody else who's got to get their ships through the Strait of Hormuz, will they be willing to accept this arrangement, which will be something new, which has never existed before, and that is the problem. So I'm not sure how to read. I mean, is it going to kickstart flow? Normally, we'll go back to pre-Feb 28th when the war started. Will this be acceptable is what we need to wait and watch, although because we've heard for so long now for the last many months that it's absolutely unacceptable and that waterways will be free. By the way, Trump said that 22 ships passed through the Strait of Hormuz last night, so it kind of again raises hopes. But, we've got to this 25 to 30, 35 ships in the past as well over the last few months, and then it kind of goes away. We'll see this. By the way, reports of attack on a tanker. This is, I think, the story is about a few hours old, so we'll have to wait and watch. By the way, the other front, which is Russia-Ukraine, which has been simmering, slow boil, sometimes escalation, sometimes it kind of pulls back a little bit. There's been constantly talks of negotiations, some kind of agreement being reached. But, well, the latest is Russia is apparently preparing to escalate attacks on Ukraine. It says that negotiations have reached a dead end. There was, of course, also the news over the last 24 hours of a pretty secret, not so secret anymore, a visit by the CIA chief to Moscow to meet with Russian intelligence officials. And, CBS is running a story that, well, he essentially was in Russia to tell them to, stop attack, not attack NATO countries. And all kinds of speculations with regards to what that was about. Wheat, by the way, wheat prices, and remember, Ukraine is one of the largest producers of wheat. Russia is too. It's essentially the grain basket of the world in some senses, was up 6%. Wheat futures were up 6% on a renewed Black Sea disruption risk. So that's something to watch out for. Yields in the US, just to go back, were 2 to 3 basis points higher across the curve. The PCE, which is Fed's preferred gauge by which they measure inflation, was slightly hawkish. The headline number at least was slightly hawkish. So, you look at the 2-year, the 5, the 10-year, they were all 2 to 3 basis points higher. The 30-year, which is the really long end, that was unchanged. And I'm making a mention of it because all the focus has been on this 30-year, the long end of the curve. Equities were flat, no change. NASDAQ was 0.08% change. So this is neither here nor there. Nvidia 5% higher after hours. By the way, Nvidia after the numbers was down 3-4%, and then it picked up as revenue and guidance. I mean, actually it started after the call began, and last I checked after hours 5% higher. So they're essentially guiding for a 70% growth on top of what they reported. This is for the financial year. Salesforce was up 12% after the close. Again, strong booking growth. And we'll get sort of reactions too, especially the Salesforce numbers from our guests here as well. And, you know, that agreement where Meta has decided to pay $18 billion in landmark settlements, well, guess what? The share was up 1%. The Meta share was up 1% or so. So that's, I mean, single stock action. All eyes on Fed Chair Kevin Walsh as the Jackson Hole meeting kicks off. That is, of course, only tomorrow evening, which means, I mean, anything which comes out of it, the market will be able to react. The US will react, but we'll be able to react to it on only Monday morning. And this time there's excessive focus because, you know, is he going to essentially talk about the long end with all the debate has been, you know, buyback? Or is he going to comment on the Treasury buybacks? What about Fed communication, where he's kind of sort of, you know, cut down the communication to pretty, essentially not saying anything in that sense, not in the statement, and of course being very, very, you know, careful with his words at the press conference as well. So we'll see. Just to tie in the levels here. By the way, you know, yesterday we woke up with oil prices $6-7 lower compared to the previous session, and the market did not move. You know, at one point the oil prices were down, but the market was also pretty much at the day's lowest point. So was it because there were no cues from bond markets or, you know, rupee markets were shut because of Eid? Maybe at the margin, but it's also the case that global equities have not reacted in any which way because oil is a global commodity and equities almost like waiting for permission to kind of sort of, you know, break out from here. And we're at that breakout point. So 24,240 is the level we put out yesterday, which is the breakout point. And guess what? We left off pretty much at that level. 24,210 or so was the final closing. So that's the number on your screen. And then, of course, I mean, I'll just put out the support and resistance levels. 24,120 is the support, and on the upside, 24,500 is the resistance. Gift Nifty comes up, gives you a quick sense of how we start. It's another 60-odd points lower. So it's been sideways, zigzag, but, I mean, coming off. That's been the true for the last 13, 14, 15-odd trading sessions now. Nigel has walked across with the F&O positioning and the stats. Nigel, take it away.
Well, in yesterday's cash session, that's between 3:15 and 3:30, the Nifty pulled back closer around 70 points. And this morning, it's indicating another 70 points. So we start off closer around 24,100. I think there's a good possibility that we see a bit of a bounce from there. So let's see how that goes. Well, in terms of flows, they're going to be skewed yet again, because yesterday you did have the flows that were positive. But keep in mind, you have large trades that are taking place on a day-to-day basis, promoter entities, you know, various funds as well selling. So that's why that data point is actually getting a little bit skewed. Moving to the index futures, then you had short positions that got added from the FIs. Close on 3,600 short positions is what they added, with the positioning holding at around that 89% or thereabouts. The options data should come up for you on the screen. 24,400 call. Well, out there you had close to around 50 lakh shares that were added. 24,300 call as well. So the call writers, they believe that they can defend the higher levels. Looking at the options data, looking at the recent technical levels, well, you get a broad zone out there. So that's the resistance levels in terms of technical levels. Simple daily moving averages, both at the 20 as well as the 200 DMA. Those are going to be resistance levels. But if you're looking at a broad range, well, the support zone is in that vicinity of around 23,950 to around 24,000, while resistance comes in at around this 24,500, 24,550, going by the options data. Well, moving to the stocks in focus, then SAIL is going to be a stock in focus. It's seen a good rally. Remember, we here at CNBC TV in the first week of August had highlighted that long product prices were improving a little bit and they were narrowing that gap with flat product prices. The stock has moved into the F&O band. It's already rallied close to around 15-16% from that particular report, but that stock will be in focus. The other stock, the sector in focus is going to be IT, because it'll be interesting to see how the IT stocks react in today's trading session. Nvidia, well, the management has guided that they see a growth of close to around 70%. The street was in the vicinity of around 40%. So that's in fact indicating that the AI trade is alive and kicking. But you had Salesforce as well that's reacting positively. And but the positive reaction was also on account of AI growth and the Anthropic investment plan. So let's see how the tech sector reacts today, because that AI trade is alive and kicking, and normally we have seen a strong AI trade meant a negative reaction for Indian IT companies, but that correlation seems to be weakening a little bit. So that's going to be an index that will be in focus all through the trading session.
All right, thank you very much for that. Jeffrey Dennis, independent emerging market commentator, is now joining in on the show. Jeffrey, thank you very much for joining in. It's been a while since we spoke, and since then, the war continues to simmer on. U.S. bond yields is surging. Gold has made a comeback, and tech earnings continue to remain strong. So assess the emerging market turf for us as things stand.
Well, emerging continue to do pretty well. They've come off their high in mid-June, but then the S&P and the Nasdaq have done the same thing. So no particular major surprise there. And obviously, as your viewers will know, you've seen a big sell-off in Korea and Taiwan, which have been driving the emerging markets this year. In fact, strip those two out, and EM has not done particularly well this year. Now, given the background we've got here, which I think personally is the danger that bond yields go higher. There's suddenly, as we all know, a big focus on the size of the U.S. debt, at 40 trillion US dollars, and uncertainty about exactly what the Fed is going to do and how they're going to do it and how they're going to explain it. So there are a lot of reasons that are giving you a little bit of a pause here. On the other hand, that's translating into a slightly weaker dollar, and that's usually good for EM. So I think EM looks reasonably placed unless the US stock market were to fall sharply from here, and I'm not sure that's going to happen.
So the risks evenly balanced when it comes to emerging markets for now, but within the basket, are you less excited about Korea and Taiwan after the recent underperformance or correction that we've seen? Is India making a comeback? Is it moving up the pecking order?
I'm not particularly negative about Korea and Taiwan. Obviously, they had a big sell-off. They're starting to rally a little bit. And I have a lot of faith here in the technology rally in the US and the AI rally. I think it goes further. And clearly, that will be the major driver of Korea and Taiwan. So I would still be fairly heavily invested in Korea and Taiwan. I think the challenge in India, and we seem to be talking about this, even though I've not been on the show for a while, for many, many months, is finding the catalyst. And the obvious catalyst in India is going to be the return of foreign FII money. And as far as I can see, that's still not really happening. The rupee has stabilized, which is helpful. The dollar's gone down. That's useful. The oil price has come back a little bit, but oil at $80 to $90 for Brent is still a major challenge for all these big oil importers. And so I think it's just hard to see where the catalyst is for India. India's down 9% in dollars this year. China's down 9%. Aside from Korea, Taiwan, I'm keeping an eye on Latin America, where you've seen a big sell-off recently. Both Brazil and Mexico, I think, look reasonably well placed. And that's kind of how I'd see it at the moment.
Got that. There's also, of course, the other issue that it's a market which is, which is absorbing all this selling, which is, local new paper, IPO market is extremely healthy. So yes, while the global stuff is there, but humongous every day, promoters are selling. There's IPOs. And all sorts of paper hitting the market, old and new, Jeffrey. And I think that perhaps also taking a fair bit of liquidity away, at least the local liquidity, which has been keeping things up.
Mm-hmm. I think if you look at that with respect to the US, there's a lot of cash still available in the US, and the potential for rotation from other sectors, if attractive, perceived to be attractive AI or technology companies come to market. So I don't expect the market to be completely saturated by IPOs. Now, I think India is different because the pool of money is obviously, by definition, I think, smaller, less deep. And I think, therefore, if you continue to get a big surge of IPOs as far as India is concerned, I think that will be something that will constrain the market. So I go back to what I said in my last answer. The driver of India is going to be when you start to see a sustained move higher, a sustained return of FII money. Relative valuations have come in quite a way, although India is still, of course, expensive on an absolute basis, and the currency is behaving better. There's not a lot of room for the central bank to cut rates, if any, at this point. And so I think it's all down to FII money, frankly. And yet, yes, you do have to worry a little bit about the potential supply coming into the market. But I'm less worried about that supply in the US.
Hi, Jeffrey. Good morning. Good to see you, Ben. We had Salesforce as well as NVIDIA's numbers that came out overnight, and both of them actually are reacting positively. So difficult to get a direction here for our Indian tech services companies. Going by the fact that you continue to be quite optimistic on Taiwan as well as Kospi, you believe the AI trade is alive and kicking, right? It still has a good distance to go from here.
I think the way to look at it is to say that the period of just extremely strong, consistently strong, blowout performance by these sectors, and in the case of emerging markets by Korea and Taiwan, is probably over. But I think the alternative whereby you're going to get a return to heavy selling, I think is also unlikely. So what I would say, and of course you never get this perfectly in these markets, especially technology-driven markets, but I think we're going to gradually move higher with, I'm sure, a lot of volatility. So I don't think the AI trade is over at this point, but it's going to become slower and perhaps more volatile and perhaps more specific stock by stock, at least as far as the US market's concerned.
Okay.
The big concern here, forgive me, let me say this, is do we get a major further sell-off of the US bond market? Because if we do, and that's entirely possible, that means I think most of these bets on stocks will be off, at least for a period of time.
Okay, all right. Jeffrey, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC TV 18. Well, let's just quickly run through what you'll see come up on the program over the next 2 hours or so. So we'll have a discussion around HDFC Bank facing a lawsuit in the US, and you'll have Abhizar Devanji and HP Ranina join us for some views around that. 9 o'clock, we have Naveen Sadio of ICICI Securities, spotlight on the cement space. Harish Krishnan of Aditya Birla Sun Life Asset Management will be a market master of the day. 9:35, Aadhar Housing Finance joins us to talk about their outlook and how things look following that. The management of Titagarh Rail Systems will be speaking with us at 9:45. And towards the end of the show, Latha will be speaking with Namira's Rob Subramanian. Stay tuned. That's coming up.
Well, time to slip into a short break. We've got a lot of stock-specific action to track for you in our special Top 10 segment. For the time being, I'll run you through the list. We're looking at Vedanta Aluminium, Juniper Green Energy, BEL, GK Energy. All of them will be reacting to the positive news flow. On the flip side, Big Boy HDFC Bank, ICICI Pru AMC, AF Finance, Foseco India and Tata Power will be reacting to negative news flow. Get into that break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's a Thursday morning. The GIFT Nifty is suggesting a slightly soft start. Yesterday, we closed around the 24,200 mark, ending with a cut of 126 points, and the implied open is another gap down opening. We should pull up the Asian markets before we proceed with getting the individual stocks on our radar. The Kospi is currently up close to about 2%. So you've got some green going for itself. The Taiwanese markets are up 1%. So you're seeing the rub-off impact of the strong numbers from NVIDIA on the AI giants, Kospi and the Taiwanese market. But let's talk about stocks. This is CNBC TV 18's list of top stocks for the day. Ananya, go first. HDFC Bank, what's the news?
Well, yes, the update on HDFC Bank is that the MSRDC controversy has now escalated into a formal US securities lawsuit. Now, the lawsuit filed by the investor Jwalan Soneji on August 13 specifically centers around the 45 crore, payments to MSRDC, which were routed through marketing and allegedly used to provide an effective 6.01% interest rate above the normal savings rate, around 2.5 percentage points above the normal savings rate. Now, this follows HDFC Bank's July internal review, which called the conduct business overreach and issued warning letters and 1 lakh penalties to MD and CEO and CFO. Now, at the same time, 3 US law firms has launched investigations into possible securities law violations. Now, the issue has moved from the investigations to actual US court litigation, like I mentioned. Now, the bank says in the United States these type of shareholder lawsuits are incredibly common after a company experiences a stock drop, and many companies listed in the US routinely defend these lawsuits each year. And importantly, the bank believes that the lawsuit is without merit and intends to vigorously defend it. So now the key risk is the potential impact on the HDFC Bank's governance and the investors' confidence here.
Got it. Okay. All right. Thanks a lot for that, Ananya. Well, we're keeping an eye out on the Vedanta Group stocks as well in today's trading session because, there was some speculation with regard to whether or not the promoter entity will come to sell Vedanta as well as Vedanta Aluminium. And Vedanta Resources yesterday put out a release. They said they denied any kind of media speculation over the stake in Vedanta Group companies. They said that there is currently no plan to sell stake in Vedanta Limited or Vedanta Aluminium as well. Vedanta, they said, remains focused on growth, value unlocked through the 5-way merger. And the company highlights, growth, capex pipeline, deleveraging, consistent shareholder returns as well. So for the time being, we'll keep an eye out on Vedanta Limited as well as Vedanta Aluminium, because for the time being, the management says that they're not looking to sell stakes in either of these two. Already seen the stocks pop up a little bit yesterday, but maybe some kind of green to kickstart trade. But it's raining block deals, and Vivek joins us to update us on today, what's on his radar? Hey Vivek, good morning.
Good morning. Well, the run rate of block deals increasing day by day and the equity deluge, supply deluge continues. So today, ICICI Prudential Asset Management, remember yesterday the company did inform the exchanges that the parent company Prudential would be going ahead and selling a stake, and this particular block deal was launched last evening itself. Prudential Corporation Holdings is looking to sell close to 2% of the total equity. The offer price range is up to a 7% discount to yesterday's close, implying that a little over 3,100 crore worth of equity could be sold in today's market in ICICI Prudential AMC, mainly being done to go ahead and ensure that there is, they're meeting the regulatory requirements. They will continue to hold close to 32.6% stake after this particular block deal. The other stock on the radar, iFinance, not a name we discuss too often, but Alpha Wave India, one of the early investors, is looking to sell close to 7.8% of the total equity. The offer price is at 167 rupees a share, which is a 5% discount to yesterday's close, implying a little over 320 crore worth of shares would be sold in a trade today. And lastly, Foseco India, a very large block deal expected over here, post the corporate restructuring of Foseco as well as Morganite Crucible. Morganite Crucible and Morgan Terracin, both of them which held a little over 15.2% stake, will be completely exiting their stake today. Floor price at a 5% discount to yesterday's close. The deal value is at over 660 crore rupees.
Okay, thank you very much for that. Ria now joins in with the other stocks in the news today. Good morning, Ria.
Well, good morning. Two stocks in news today on the back of order wins for both of these. The first one is Bharat Electronics. The company has received orders worth 730 crore rupees since its last disclosure on the 10th of August. Now, these orders that they have received include orders for communication equipment, radars, avionics, tank subsystems, electro-optics, as well as some other components. Remember the quarter one order book for the company had crossed 72,000 crores already, and the order inflow in quarter two of FY27 has already crossed nearly 2,690 crore rupees. This is including the order that we are talking about today. And in fact, for the full year of FY27, the company has guided for an order inflow of over 55,000 crores. But today, the stock is expected to open in the green on the back of this order win. Moving on to GK Energy, they have received a letter of intent for 1 lakh grid-connected rooftop solar PV systems, which aggregates to 100 megawatts. The order is worth 454 crore rupees, and the execution will be within 60 days from when they receive the orders for each of these.
Okay, all right. Thanks very much, Ria, for that. Vivek is now here with information on Juniper Green. Vivek, take it away.
Well, recently listed name, just declared their Q1 FY27 results last evening. A good set of numbers coming in on back of an expanded base. Revenues higher by almost 80% on a year-on-year basis. Reported EBITDA too up 90% correspondingly. EBITDA margins up at 89.6%. Profitability up 50% as well. Higher tax is something that went ahead and ensured that PAT didn't go up correspondingly with the EBITDA increase. So what has happened as far as the operations are concerned? Q1 capacity added at a little over 600 megawatt peak. Operational capacity now that the company has is at over 2,575 megawatt peak, and along with that, the company says post Q1 they have won 2 large tenders and they have signed 1 PPA with NHPC. This is post Q1, so good set of numbers. Expect some green on Juniper Green today.
Okay, and Vivek, what about Tata Power?
Well, Tata Power, this is a long-standing dispute that the company has been having with one of the partners named Kleros Capital Partners. Both of these companies had gone ahead and had actually partnered to go ahead and bid for a coal mining asset as far as Russia is concerned. This particular case dates back to 2013. This case has been dragging on for quite some time. Yesterday, the Singapore International Commercial Court ruled in favor of Kleros, against whom the arbitration was that Tata Power had initiated. Earlier, the Singapore court had gone ahead and awarded a $490.3 million award to Kleros. This is an investment firm. Now, Tata Power, which has lost this particular verdict, now has another 28 days to file against this particular verdict, and they can go ahead and file it to the Singapore Court of Appeal. We spoke to Tata Power in the morning. They said that they intend to go ahead and file an appeal within the next 28 days. But nevertheless, it's a slight setback as far as Tata Power is concerned.
All right, thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Vedanta, Vedanta Aluminium, Juniper Green Energy, BEL, GK Energy. Stocks with negative news flow are HDFC Bank, ICICI Pru AMC, iFinance, Foseco India, Tata Power. Balanced on both sides. But that's about equities. Let's talk commodities. Manisha is joining in for a complete roundup of all the action. Manisha, good morning.
Morning, and thank you for that. I'll start with metals this time around because they seem to be doing quite well. Zinc, for example, has continued to surge higher. We're looking at another percentage point of gain, so trading above those 4-year highs. Copper is another one. In the New York session yesterday, we saw yet again an all-time high coming in for this one. The supply side risks have just about persisted, and traders have continued to divert shipments towards U.S., which is looking at near record inventories, but the inventories everywhere else, including LME and Shanghai, have continued to decline. You're also looking at the Brent crude oil prices declining for a 4th straight day. There are reports of diplomatic progress between Iran and Oman reaching an agreement over each country's share of the Strait of Hormuz waters and revenues as well. There also was a statement from the U.S. president saying that 10 million barrels of oil has passed via Strait of Hormuz on Tuesday. And then the U.S. economic sanctions that U.S. has been talking about on Iran have proven less aggressive than what the markets feared. So all of that has led to crude oil prices continue to be trading in the negative. And finally, on the gold and silver prices, while they are trading firm, but the U.S. PCE numbers are slightly higher than what the street anticipated. But from here, it is going to be about the Fed chair speech at the annual Jackson Hole Symposium, which is tomorrow.
All right. Well, Manager, thank you very much for that. Commodities and gold, etc., very much in focus. We'll take a break. We are back. Deepan Mehta of Electric Securities will be with us in some fundamental stock conversation. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call. You're on CNBC TV 18. Deepan Mehta, Director at Alexa Equities, joins us on the show. Hi, Deepan. What's your view on tech? How would you approach that sector? The reason I ask you this is because NVIDIA, they have gone ahead and now they're guiding for around $100 billion of revenues. Already on a $96 billion of revenues in Q2. And they're saying that 2028, they grow by 70%. Street was at around 45%. So that's clearly, reviving that AI trade. But you also have Salesforce that gone ahead and upgraded their guidance. So that stock was up more than 10%. There's an element of that investment in Anthropic as well as AI revenues as well in there. So the news actually is a little bit mixed. Your approach to the IT pack here in India, the Indian IT services companies?
Good morning, Nigel. All I can share that I wish I could buy NVIDIA shares or Salesforce.
But you can't. Our audience wants to know what to do with tech.
Or some other Chinese companies, they are all, if you compare them to the P multiples that we are giving to some of the high growth companies in India and the defense sector or aerospace or, some of those high growth sectors, you'll find that the global markets are far, far cheaper. But that, whatever happens in the global tech industry actually doesn't affect Indian software services companies at all. And our view remains very, very negative on software services companies. With every passing day, it's becoming more and more evident that the core strength of our tech companies, which was coding, that are going to be disrupted extensively and very heavily. A huge source of deploying manpower, earning revenues from coding, that's going to get impacted very badly. So it's an avoid completely. And I'm actually looking at some of the other mid-cap stocks which we have also invested for a long time, almost a decade plus, like say Persistent Systems, Tata Elxsi. I'm looking at those companies also in a more, cautious light because this disruption is for real. And from whatever we understand that, one software engineer with little bit knowledge of AI can replace 20, 50 traditional engineers. If that's going to be the equation, then where are the software services companies going to, be in 2-3 years' time? So very negative on the sector, and just want to evaluate every single software services company whether it is really worth remaining in this.
Oh, that was an extremely negative view, Deepan.
It was always negative. Now it's become very negative now.
Yeah, and as he says, NVIDIA is, given their numbers, after us, they were up 5%. SK Hynix is up close to around 4% this morning. Kospi as well is up. And Deepan is saying he's not interested at all.
Because you can get, NVIDIA, as I said, $100 billion quarterly revenue run rate, growing phenomenally. Gross margin 75%. So at that engine, you're giving gross margins of 75%. You're guiding for a 70% growth in FY28. And on top of that, the stock trades at 17 times valuation multiple, right? $5 trillion. The only question is, can a $5 trillion company become a $10 trillion company, right? At some point, the law of how large can you be will kick in, which is why, in a way, NVIDIA has also gone a tad bit sideways. But Deepan, that's about, big tech. We can't invest there. We've got IT here, which you don't like. There's one stock which has done very well. That's Genesis International.
Why can't you invest there? You can invest there.
No, in individual stocks and I guess.
No,
you can go through the...
invest. But the question is whether you should or not. That's another question.
I'm saying it's easier to invest in the stocks out here.
No, go on, sorry.
Yeah, Deepan, what about Genesis International? Is this a stock that you look at? We've not spoken about it often, but 40% up in 2 days. It does those geospatial maps, and now they're trying to convert it into an annuity base, so sort of make it a SaaS product, platform as a service. Is this, or has this been on your radar?
No, I think it's a very old company, listed for several years, but now seems to have got into a new growth phase. And that's because GIS suddenly has picked up very well, and its applications have increased significantly. Its importance and its utility value also has gone up, and it's got decent orders. And I think after many years of trying to get the business momentum going, the management has finally got it right, I think. And that's reflecting the stock price and the P multiple also at 40 times or so, a bit on the higher side. There's another company which is doing something similar. I think it's called Sensex. Synfosys, something like that is the name. And that also, I think, is doing exceptionally well. It's only BSE listed. So I think that these niche plays will keep on happening in the software industry. But broadly, the software services industry, you need to be a bit careful.
Synesis, that's the one, right? 730 rupee stock, 1,500 crore market cap. CEINSYS.
Yes, that's the one. Sorry, yeah, that's the one. It's
Synesis,
very difficult to
Synesis.
pronounce the name, but that's the one. That's also done very well. This Sensex tech, yeah. If you look at that chart also annually, the last 12 months has done exceptionally well. And that company also was providing GIS services, and a lot of the revenues come from the Indian market, where it provides to state governments, to other infrastructure players for planning large infra projects as well. So I think both of these companies are similar type of a business. And I think, as I said, this particular activity has got a lot of importance in infrastructure planning, which is why we have seen such good returns and such good performance from these companies.
Deepan, our last conversation, you ran us through a bunch of very small pharma companies, very small IT companies. I'm noticing going smaller down the market cap curve, lower and lower, right?
Yeah, but it comes with associated risks as well, So
Remember, I think we'll talk more about the pharma names as well. I mean, some of the diagnostic space, etc. But small companies, but sometimes it's where that, I mean, large cap stocks have been kind of flattish, and all the action has been in these very individual kind of names where if you've caught on early, you've made a fair bit of money. Deepan, just coming back to you, this HDFC Bank news flow, I'm not sure what to make of it, right? There's a lawsuit in the US. Investors filed a lawsuit alleging 45 crore that MSRDC payment. And bank, of course, is saying the lawsuit is without merit and intends to vigorously defend itself. Abhijit Divanji is with us, and so is HP Ranina. Gentlemen, good morning. Good to have both of you here. Thank you very much for joining us. Abhijit, what to make of this one?
Thank you, Prashant. I do think that this seems to be now, since the Adani.
Abhijit, sorry, I think we got you on a patchy line. We'll just fix it. Mr. Ranina, what should we make of this one?
Well, this is something which was on the anvil, I think, because they had made the inquiry and now they feel that there is something in it. So therefore, the lawsuit has been started. It's a class action lawsuit. Maybe some people will join in. I'm told that this is something which is commonly done in the U.S. It's for now HDFC to defend itself vigorously and to make sure that nothing adverse comes against it.
All of the investigations, the report, etc., what came through here, I mean, is that not material when something like this happens in another jurisdiction?
No, it is material, but the question is about the actual allegation that a certain amount has been paid to MSRDC as a marketing fee. And this is just to cover up for additional interest.
Yeah.
Now, that is the crux of the issue. So HDFC can show that there is nothing to it and that they actually made the sponsorship to MSRDC, which is a totally independent transaction, nothing to do with the deposit which MSRDC had placed with HDFC, then it's a different issue altogether.
Yeah.
The issue is whether there's a cover-up or whether there's a misleading information under the U.S. laws. That has to be established in the U.S. court.
Yes. No, I'm saying there was an internal investigation into some of this stuff here, right, Mr. Ranina?
Yes.
Yeah. I'm saying, that is...
They got a clean sheet and...
Correct. So that...
that will help them, yes.
That should. Abhijit is with us as well. Abhijit, hopefully on a better line. First thoughts on this one?
Yeah, I personally think that, this is getting a wee bit kind of excessive in a sense. And I say this purely because I think these issues are getting repeated in different forums. And I'm not sure whether it is just to keep these issues alive or in any form. Very frankly, there is no case where a bank has been defrauded or shareholders have been defrauded. So very frankly, if these are within normal banking laws, with nobody outside of the stakeholders being beneficiaries, then why are these issues being consistently raised is a question that intrigues me.
You're kind of sort of suggesting maybe being put up deliberately to kind of sort of hobble the bank. Is that what you're saying, Abhijit?
seems to be the case. And I think since Mr. Mr. Chakravarti raised those issues around the board, I think things seems to have kind of gone completely out of control, where everybody seems to want to capitalize on it, it seems.
Yeah. But is this likely to do as what you say, which is kind of sort of, these are all, it takes a fair bit of bandwidth, and it's a distraction, isn't it, Abhizar? In terms of management bandwidth, etc.
So there are systemic issues in the bank, as you highlighted earlier, because of the merger, the handling of the merger, the consequent market circumstances because of which the benefits of the merger are getting delayed. Then, of course, there have been operational issues that have been the case with every bank, either on the technology side or on the mis-selling side. I don't know why a 2013 issue has been raised and linked, to broader governance that's happening today, or a 2013 or a 2016 issue. I mean, one has to take cognizance of the fact that these were, transactions done much earlier in time. And I'm not talking about the MSRDC transaction, but I'm actually talking about more the mis-selling transactions. I mean, these were times when different things were being sold differently. To rake all these issues again at the same time, in my view, seems unwarranted.
No, absolutely. Looks like it. Abhizar, stay on. Let me thank Mr. Ranina for coming on early this morning. Mr. Ranina, thank you very much for joining us. Good speaking with you. Abhizar, if I can ask you, just since I have you on the line, we reported yesterday, this was a CNBC TV in exclusive, that lots of bank transactions, you've been involved in a bunch as well, but DCB Bank is looking to they've got a board approval to raise 2,000 crores. They're talking with private equity players like Chris Capital, etc., to get a fund infusion in. I don't know if you have any thoughts at all on this situation, Abhizar.
Oh, I don't know about the specific transaction, Prashant, but I can tell you for sure that the mid-sized private sector banks, about time that they raise capital to strengthen their balance sheets from a resilience point of view. I think everybody needs to do it. We've seen it with Yes Bank, where confidence capital came in. We've seen it with RBL, which has kind of upped its balance sheet. You've seen it with Federal Bank, where Blackstone came in. So I am not surprised that mid-sized banks are shoring up capital, purely because they need to make themselves more resilient to the kind of lending that they do. I mean, I remember RBL before the ENBD transaction was susceptible to every market change. So if there was an MSME crisis, their stock price got hit. I mean, look at mid-sized banks today. Most of them are at either 1.2 times book or maybe sub-book. And that's because the sentiment doesn't play with them. Once they are able to raise capital, I think that sentiment will play out well. So I am not surprised that DCB may be headed that way.
But how should we see this? This is bank capital is the raw material, but is this also it's been the cost for re-rating in some cases, right? But not all, right? It's that generalization perhaps would be wrong.
No, I think most mid-sized banks will have to raise capital. The larger guys are raising debt. I mean, HDFC we saw, ICICI we saw. But the mid-sized guys need to shore up tier one capital. And that's the reason why they are going for, I'm very frankly, foreign capital is very amenable to Indian banking now. As we've seen, a lot of money has come into Indian banking.
No, Abhizar, what I meant is, what does it mean for shareholders? I mean, how should we see some strategic guy coming in versus a private equity firm coming in for equity holders, Abhizar?
So private equity is mostly transient. Because what then happens is that once a private equity comes in, they will want to exit in a few years. They take, sub 9.99% stake. They basically provide growth capital to create a stronger platform for a strategic to be interested.
Oh.
So I think it's a transient thing. Shareholders will benefit.
Oh. And this IDBI thing is the other one, right? Which we understand is going to get like a nod from the government finally, the Fairfax one. Any thoughts there?
I hope it happens soon. It's been cry wolf for a while.
And how will you read that whenever that happens? I mean, I
think it's certainly a positive, and it'll be, in a true sense, IDBI will get privatized if that happens. Of course, there is a huge challenge in terms of converting a so-called public sector bank, which is now classified as private sector, but still a public sector in nature. To transfer it into a private sector bank is a challenge. but I think it will bring a lot more, a large bank and with global scale again, like we're seeing elsewhere. I think Fairfax will be able to bring it the global presence that IDBI deserves.
So the stock re-rates, Abhizar? I know you're not a stock analyst, but I mean...
I wouldn't know about the stock. I think the market may have factored things in.
Yeah. No, although, I mean, I was also surprised. We put up the chart. It was up 7% yesterday. So 94 now on IDBI Bank. Abhijit, thank you very much. A great
Hope that doesn't kill the deal, Prashant.
that was probably the issue. Maybe one of the reasons why it's taken so long, the price, the ask and the current market price, etc. It moves and then things have gotten derailed earlier. Thank you very much, Abhijit. Appreciate your time here. Thank you. Okay, we'll take a quick break. We are back and we will continue our discussion with Deepan Mehta. And we'll also have Sudarshan and Mitesh join in for some technical trading ideas. Okay, welcome back. The pre-open session is about 8 minutes out, and let's get some brokerage calls out of the way. It's lots of stuff happening. Sud is here with what's caught his eye this morning. Sud, morning.
Good morning, Prashant. So first one is on the consumer companies. Goldman Sachs has come out with a note, and that's mainly on the back of the sharp spike that we have seen in sugar prices. It believes that sugar forms key input cost for majority of the companies and used in manufacturing of many categories. And because of the higher input costs related to sugar and palm oil, Britannia is impacted the most. For Nestle and Warren Beverages, they will have some impact but can be mitigated better. And that's the reason it has neutral call on Britannia with a target price of 6,000. neutral call on Nestle with a target price of 1575 and buy call on Varun Beverages with a target price of 550 rupees per share. Next one is Zydus Life. Macquarie has come out with a note, maintains outperform call with a target price of 1285 rupees per share. It says there is a strategic mix shift to drive margin expansion. It believes that EBITDA margin can expand to 27 to 28% from the current level of 24%. And innovation portfolio is emerging as a meaningful US growth driver, and company expects India business to outperform the IPM by 300 to 500 basis points in FY27. And it also benefits from supplying semaglutide to partners like other partners like Lupin and Torrent Pharma. On UPL, DAM Capital maintains buy call target price is 870 rupees per share. It says restructuring announcement has been a material overhang over last couple of quarters, but it has obscured the fact that business has moved from strength to strength, and Advanta is compounding at 20% plus. Specialty chemical grew by 51% Q1, and Q1 contribution margin had moved by 180 basis points, and EBITDA was up 15% on 10% revenue growth. And this growth has come in a despite operating environment, and market is playing a holdco discount of almost 61%, and that it believes that it's excessive because it will still retain its fastest growing segment. Another key driver can be Advanta because its IPO should force first year mark on potential value unlock opportunity. And just we have got a note from BofA Securities. It has initiated coverage on both cable and wire companies Polycab and KEI Industries.
Thank you very much for that rich list there. There's one more, CLSA on Sterlite Tech. They've always been bullish, but they reiterate their outperform rating. Target price 950 on Sterlite Tech. Current market price 660, so see more than a 50% upside. They say it's the top data center play. But Dipan, coming on UPL, the stock's been an underperformer. Investors had concerns about restructuring, lower by 25% year to date. Would you be bullish from here on? Do you think the concerns have played themselves out in the stock price?
The thing with UPL now is that it keeps doing so many corporate actions, it's difficult to keep track. They will merge companies, demerge companies, acquire something over there, acquire something in Brazil. So it's very difficult to keep track. It's this company is great for a merchant banker or an M&A specialist because they're keeping on doing deals all the time. And the core business really doesn't go anywhere. End of the day, I was just checking, last 10 years, the profit growth has been 6.11%. Compare that to PI Industries, compare that to Sharda Cropchem, compare that to many of the other, agrochemical companies, and you will find that, this is, just not happening from that point of view. But, who knows, managements change, and hopefully if they just settle down for some time and, just focus on getting whatever structure they want to get it right, and then not change it too much. Now, if Advanta is going to go for an IPO, all these things kind of confuse the investor, at least as far as I'm concerned, because at the core level, the profits are not growing. The only advantage that UPL has got, I think, is that it acquired a lot of foreign companies, and those are done when the rupee was much more, more, so that, the various rates would be 60, 70, 80 to a dollar. Now the rupee is almost 95 to a dollar. So all those international acquisitions suddenly become quite valuable. But apart from that, I think, so many moving parts also. So in my opinion, it's an avoid unless we see some, drastic change in strategy.
Okay, we will slip into a very short break. Dipan, hold that thought. We'll come back. We'll get the pre-opening rates. We'll also connect with Naveen Sahadev of ICICI Securities to focus on the cement sector. Stay tuned.
Welcome back. Hope you're having a good morning. Well, let's welcome on the show Sudarshan Sukhani as well as Mitesh Thakkar. Good morning, gentlemen. Well, the cash session yesterday was the total opposite of what we saw in the previous trading session. What I mean by that is 315 to 330 on Tuesday, the Nifty went up by close to 70 points. Yesterday, it reversed all of that. That said, we're starting the day at around 24,200. Sudarshan, you go first. What do you think? We're in this range-bound trade for very, very long. Which side are we going to be breaking out on, and what would your trade be?
Good morning. I have no idea where we should break out. Ideally, after a long protracted range, the eventual breakout, especially because we are in a range for 2 years now, so the eventual breakout should be on the upside. But that will happen when it will happen. I think we have to widen the trading range we are currently in and say 24,500 is a boundary. Within that boundary, if anything happens, just leave the Nifty alone and trade, perhaps focus on the stocks. And the Bank Nifty has a slightly better chart. So maybe look to buy the Bank Nifty on dips. The Nifty is now an avoid till 24,500. The Bank Nifty is a buy on dips, and stocks, of course, are always there.
Okay, all right. Got that. You're focusing on stocks, and we're going to hear from you on those stocks. So, Mitesh, what about you? Bit of frustrating phase, right? To be in this 300-400 point range, but that's the market for you. Would you trade the index?
I think, we've time and again said that this is a market which needs to sustain about 24,300 to get some strength. And last few days, you've seen a couple of failed attempts over there, while 24,000 is a good fluid. So the only way you can trade is possibly if you get an entry around 24,000, explore a long position with a 60-70 point kind of a stop loss. Otherwise, the index is clearly the one.
Okay, all right. Individual stocks is going to be the name of the game. Mitesh, go first.
I have a mix of buying and sells today, 2 buys and 2 sells. So on the buying side is Cochin Shipyard, which is a buy with a stop below yesterday's low. So 1512 is what I recommend as a stop, and a target of 1625, 1630 can be looked at. Then Ashok Leyland is a buy with a stop at 174.5 for targets of 188. A sell on Bharat Forge with a stop at 2040, targets of 1930, and also a sell on Bharti Airtel with a stop at 1926 for targets of 1855.
Okay, and Sudarshan, what stocks would you go with?
I'll go with Adani Power, which is a buy with a stop under 205. Tata Steel, where again buying is suggested with a stop under 185. Naukri, which is Info Edge, is a sell with a stop above 1350. And Oil India, OIL, Oil India, is a sell with a stop above 460. So 2 buys and 2 sells.
Got it. All right. Thanks a lot for that, Sudarshan, as well as Mitesh. Well, let's focus on the cement pack, though. Very, very boring sector. But yesterday, there was some kind of buzz that there could probably be a price hike that was pushed through a few days ago in South India in particular. And part of that was absorbed. Remember, we're in a monsoon season, so still things are very wibbly-wobbly. But let's get in an expert. We have Naveen Sadeh, the analyst at ICICI Securities, who joins us on the show. Hi, Naveen. Good to see you in. Sporting a new look this morning. Haven't seen you jogging, when I come to work for a while. But nice look. Let's focus on the space, though. Not too exciting, so I think you have decided to spice things up with a look. Have you heard of any kind of these price increases that have been taken? Some reports suggest that in South India, there was a push through of around 20 bucks and 10 bucks got absorbed. What kind of feedback are you getting? Which part of India has there been a price increase? And what are you factoring in, say, towards the end of September? Because in all probability, there'll be another push through.
Right. So the best part is that the news agencies typically report only the hikes. Nobody wants to talk about the decline. And as you said in initial comments, that it's a pretty dead sector as of now. So yes, there has been some decline, and on that, I think the attempts to price hike are more from a perspective that prices don't slide more. So it's very simple, right? If you have to keep things in action. If you don't make an attempt to increase prices, they only tend to fall down, especially in a weak or a seasonally weak monsoon quarter like monsoon. So there was a dip. Again, there is an attempt by the industry, especially only in South, to reverse the decline, so to say. But net for the quarter as a whole, I would still think it's safe to assume at least a 1 to 1.5% quarter kind of a decline in realizations quarter on quarter.
Okay, got it. And Naveen, just one clarification I'd like to give you that we are at CNBC TV 18, unless there is an outsized hike or an outsized cut, we don't report either of them. So, with regard to the comment on the news agency, and we have known each other for close to 15 years, so I think you can track that as well.
I didn't mean you. I meant in general, there's a very steady decline that tends to happen, and
Got that. All right, Naveen, let's focus then on the EBITDA per ton because profitability is most important, right? So you put in together some kind of price moves, input costs have gone up as well. For the industry on an EBITDA per ton basis, Naveen, what are you working with for quarter two? And I guess there'll be some recovery that you'll be working with in the second half of the year as well. So movement on the EBITDA per ton for the industry. Please go ahead.
Right. So Q2 typically has the negative impact of operating leverage also, right? Because volumes are seasonally lower. And this quarter in particular is more, I would say the impact is more pronounced because the impact of the entire fuel cost, which was with a lag, is coming at least 100 to 115 rupees, just the fuel cost impact. And then if I club it with the operating deleverage, so to say, or lower volumes sequentially, then the impact on a per ton basis could be anywhere between 200 to 250 rupees sequentially in my view. So that's the decline. And yes, second half obviously sees a recovery, but I still think on a year-on-year basis, it would be more flattish kind of a EBITDA per ton for the entire industry. Flattish or a marginal increase at best.
Got it. What about demand? What are you working with in terms of demand for the year? Traditionally we have seen anything between 4-5% in a bad year to around 8-9% in an optimistic year, which we haven't got actually in a bit. For this year, what are you working with?
So frankly, let me correct that also. From FY11 to FY26, each year we keep every annual report you pick up and there is an optimistic demand case of 7 to 8%. Fact of the matter is FY11 to FY26, the CAGR is 5.5%, be it any source that you are picking up. My estimate also is broadly this year also is about more like 6 to 7% range only. And I think it's a pretty healthy trend to continue even going ahead, 6 to 7%.
I think I said 4 to 5% and 8 to 9%. So average came to 6%, 25 to 6%.
No. I'm saying FY11 to FY26 CAGR, all India growth is just 5.5%. This year, so far, it appears to be about 7 odd percent, but I'm still saying you'll close the year anywhere between 6 to 7%. No real reason to expect a significant jump in demand.
Got it. Okay. All right. So we got that out of the way as well. Let's focus on your top picks then. What are you bullish on? The sector is lacking too much of spice. People are not talking about it. At least some point of time, people start talking about that replacement theory. Then there was a lot of inorganic growth, which has also slowed down. And a lot of those plans that these big names had didn't play out, whether it's with regard to scaling up of operations or cutting down on cost. Give and take everything. What do you like right now?
So the only stock that I am pushing or positive about is Grasim. Frankly, I think that stock continues to do extremely well. My first and foremost argument there is that high dividends from Ultratech will clearly continue, which will benefit Grasim either in the form of reduced leverage or to be deployed in other high growth business. So I think that is a key argument, even to expect a lower holdco discount when it comes to valuing Ultratech stake in for Grasim. The other positive, of course, is the significant ramp up in line with management commentary that we are seeing in the paints as well as the B2B e-commerce business. And both these segments, I think, are on track for a break-even next year. B2B e-commerce could break even much earlier and paints next year. So I think a traction on both these segments as well as high dividend clearly makes for an optimistic case in Grasim. I think even people who are slightly positive on cement, they could still clearly play the story through Grasim.
Okay, all right. Play through, Grasim is what you're saying. And as you're saying that, even the paint business and all, they have been delivering as expected. Just one point on that hold company discount. What are you factoring in?
So earlier, currently it is in the 40, I mean, historically it has been the 40 to 50% range. I would peg it at 40, but given the visibility of now high dividends coming or year after year, I have reduced it to 25%, which I think is fundamentally in line with the tax leakage that will be applicable on other income. So I have pegged it or brought down to 25%, which then gives me a target price of 4175 on Grasa.
Okay, and Ultratech Cement, their cables and wires arm, I got the invite yesterday. First week of September is when, they're going to be having a press conference and they're going to be launching that. You're penciling in anything into your SOTP for Ultratech Cement?
No, very nominal, because typically in the start of the business, we would value these segments on a price to sales basis rather than because profitability itself will take time. So you don't want to take a negative number for sure. So initially we would peg it at more like price to sales. But as of now, given they will be in the ramp up phase initially, we're not assigning any value or a significant value, if I may say, from an FY28 perspective. Let's wait out for the management commentary and guidance on that front as well.
Well, it's a pleasure having you on the show, Naveen. Thanks a lot for joining in, giving us your view. Grasim is your top pick from the sector, and you're not expecting anything, fancy to happen this year. Around 6% roughly in terms of demand growth. EBITDA per ton could pull back by around 200 rupees per ton and then recover in the second half of the year. Have a good day ahead, Naveen.
Thank you.
From cement, let's focus on steel then. MK, they've come out with a view on steel. They say that their outlook has turned constructive in comparison to their earlier expectations. The reason is that improving pricing environment across longs as well as flats, that's what points to a stronger FY27. They're given a few data points as well. The rebar recovery support, the maintenance shutdowns as well as tightening availability, coupled with firm input cost, which has pushed up rebar prices. We at CNBC TV 18 had mentioned this at the start of August, that the difference between rebar prices as well as flats, they had moved very, very apart. And that's why some narrowing could have possibly taken place. They also mentioned, though, MK in their note about demand. They say that demand remains moderate, largely need-based, given that we are in a monsoon. Though healthy retail offtake as well as sustained infrastructure activity, that's providing some kind of support to demand. On HRC prices, it's been aided by controlled supply, robust auto demand with, the PV and CV demand this year itself is up by close to around 20%. They also go on to mention that India HRC prices continue to remain at around a 6% discount to Chinese import parity prices. So that's giving you some scope for prices to move up, and also elevated iron ore as well as coking coal costs. That's what could prevent the prices from falling down here. In terms of their picks, it comes up for you on the screen. Tata Steel is their buy, or there they have a target price of 230. On JSW Steel, they have an add. Jindal Steel buy and sale as well add, but the target price has already come about. So that's what MK has to say with regard to the steel stocks. Yesterday as well, these stocks were buzzing. But it's 9:10, getting Sudarshan back on the show. Sudarshan, tell us, 9:10 call?
Well, it's Tata Steel, buy with a stop under 185.
Okay, Mitesh, what about you?
I'll go with buy on Cochin Shipyard.
All right, gentlemen, thank you for that. It's over to Vivek now for Tata Power. Vivek.
Well, that's right. Tata Power is showing a downtick as far as pre-open is concerned. This particular case that the company has lost in the Singapore court pertains to a case of a joint bid of the company as well as Kleros Partners. This is for a coal mine in Russia in 2013. Singapore International Commercial Court has ruled in favor of Kleros, implying that Tata Power now has to go ahead and pay a little over $490 million worth of arbitration to Kleros Partners. Remember, the company has 28 days to appeal this particular verdict, which they intend to do so. Along with that, the company may also have to pay the legal fees as far as Kleros is concerned. This could mean that it's a significant setback as far as Tata Power is concerned, but important note that typically in such cases, the payment will be made in tranches.
All right, thank you very much for that. Just counting down to the open, some more stocks that you should have on your radar this morning. Juniper Green Energy on the back of the numbers, so that one could open up in the green. I think in pre-open it's up close to about 4%. Keep your eye on Vedanta Aluminium, BEL, GK Energy. But on the flip side, HDFC Bank and block deals, good pressure at ICICI Pru AMC, Adani Finance and Fuseco India. Tata Power, Vivek spoke about.
Okay, first rates in a couple of seconds from now, and then we pick up from there. So the Nifty about 70 odd points higher. So I mean, it'll basically first, I guess, correct a little bit of the dip that we saw in the cash session yesterday, and then we basically built up from there. It's kind of the opposite of what we saw yesterday, because on Monday you had the market. On Tuesday, the cash session was positive. We corrected that yesterday, and today it's the opposite. So yeah, 1/3%, 24,280 on the Nifty. The Nifty Bank is up about 1/3%, 57,960. The mid-cap index is up 1/4. The small-cap index also higher. So actually, the absolute opposite of what we had at start in a trade in yesterday's session. 76 now, 24,285 on the index. At this stage. So about 1/4 to 1/3 higher is what you have on the board as far as indices are concerned. Let's just look at the 50 stocks and take a look at where things are at. Adani Enterprises is there. Adani Ports is there amongst the top gainers. Bajaj Finance is higher. There's Apollo Hospitals and Kotak, which are some of the other top winners. There is HDFC Bank, which is on the other end. About 8 odd names which are lower. Grasim is down, and there is Tata Consumer, which is higher in a trade as well. So that's the picture with regards to the Nifty 50 start. It's positive, about 80 odd points for now. Rima.
Well, IT is doing well. If you look at the top sectoral gainer today, it is IT. The Nifty IT index is open with a gain of about 0.5%. So that's positive, despite NVIDIA's numbers. Generally, when NVIDIA does well and the rest of the tech stocks like in Korea and Taiwan do well, IT has been negative. But as I said, Salesforce positive numbers and a 12% reaction post-earnings is a positive rub-off on the Indian IT companies, because for last many quarters, we've been hearing very dire predictions about the end of the software SaaS apocalypse. The models are going to eat everything that IT companies do and SaaS companies do. But so far, at least, the numbers are kicking in for the SaaS companies. So in a way, a positive rub-off. Science should come up for you on your screen, because that was a big winner in IT yesterday with a 7% up move. We'll wait by to see if there is any follow-through. On the way up, you've got a Sterlite Tech. As I said, CLSA, an outperform rating, target price 950. That's pushed up the stock higher. DCB Bank was in focus yesterday on the back of a potential PE fund raise. This is source-based information. Stock is excited. Juniper Energy up and about in the green. On the way down, Tata Power has sold off. HDFC Bank has got that lawsuit overhang, so lower by 0.7%. And ICICI Pru AMC and iFinance both have ticked lower. 4.5% lower on ICICI Pru AMC. Promoters will be selling a 2% stake, and on iFinance, it's a much larger block deal of nearly 8%.
Well, that's right. Vedanta Group stocks, they are in focus. Vedanta Oil and Gas as well as Vedanta Steel, both of them are bucking the trend today. Very, very high volumes, both of them up and about in today's trading session. Good uptake is what we're seeing out there. A few more notable movers. Russell India, that stock is up close to around 17%. I think market capitalization is not very, very large, but suddenly that stock, in fact, is up 17%. Wondering what's going on there. Bombay Burma is up close to around 7.5%. That's not a stock we normally talk about. So good uptake is what you're seeing on that name. Jindal Worldwide is up close to around 6%. That's coming up in terms of some of the top movers. GK Energy, some fundamental news flow. So that stock as well pops up in trade. Good move is what we're seeing on that name as well. Genesis, last two trading sessions, it's been up close to around 40%. Today, it's giving back some part of what it's put on, close to around 6%. Dipen had commented earlier this morning on that name. Waterways Leisure as well is down close to around 4.5% or thereabouts. And Advait Jewels, last few days, the stock had rallied close to 40%. That's down close to around 3.5% in today's trading session. So the Nifty for the time being is holding on with some gains, 40-50 points higher, but plenty of action in the broader markets.
Okay. All right. Well, a quarter for now to show for it with about, 2 or 3 minutes into market open is what we have, 24,260. Well, Harish Krishnan is with us, Chief Investment Officer, Equity at Aditya Birla Sun Life Asset Management Company. Harish, speaking to you after a while. Thanks very much for joining in as always. Good to see you. You've had more than a few winners over the last few months, and big ones, Harish. I hope those have been outsized positions for the sake of your investors in your mutual fund, and not small positions in that sense. Some, of course, have been large. Talk to us about where are you focused on, what are you doing in terms of, the effort of the team. Obviously, is to find winners, but talk to us a little bit about how you're going about doing it. Is it, where there's earnings acceleration, or where there is some change afoot? How are you doing it? What's the process right now?
Thank you, Prashant. So I just want to call out two particular data points first, Prashant, and then I'll get to where we're seeing opportunities and value today with our framework. The first data point that I have is in terms of the number of companies which are growing by more than 15%. This number used to be in the 30s, 36, 35%, say about 12, 18 months back. That number today, as we speak, is close to about 53, 54% of the top 500 companies. So we're seeing an inch up wherein the center of gravity is kind of shifting into faster growing companies than what it was before. So that's call out number one. The second call out is in terms of valuations. So if you look at about, again, say 2 years back, close to about 43% of the top 500 companies had a price to earnings on a trailing basis of more than 50 PE, which means a 2% earnings yield. That number came down to the 20s sometime in February of this year, and currently it's about 30%. It's still a far number from the 10, 12% it used to be pre-COVID, but there has been a meaningful reduction of froth. And therefore, these 2 points, to my mind, are very encouraging in the sense that you're seeing an improvement in earnings growth coupled with reasonable amount of froth dissipation from the broader markets. And therefore, we have a positive stance on equities. Now, coming to which are the areas where we are finding opportunities, I would rather flip it into broadly, there are only 3 areas that I think where we are a bit hesitant to commit more capital towards. Those 3 areas, to my mind, are one is capital markets, the area that we are all in. Of course, we are all very big beneficiaries of the same. There is financial penetration, all of those possibilities ahead, but there is just way too much of supply of paper. And over the course of the last 5 years, profit pools have gone up almost 20x, which meant that there is a whole host of competition coming our way as far as capital markets is concerned. The second area where I think we are a bit hesitant in deploying more capital is in defense. That's again a space which, for all the right reasons, ordering has kind of come through. Again, given the nature of government being the largest paymaster out here, we do think that working capital is significantly stretched as a whole. So while near-term growth is good, we are a bit wary of very high working capital and therefore this requiring significant amount of dilution. This is very similar to what railways was, say, about 18, 24 months. And therefore, that's again an area where we are not wanting to commit capital towards. The third is, of course, the capital goods space, especially those that are large beneficiaries of the AI trade. And of course, it is something where which has taken the world by storm in terms of the significant expansion which is happening on the ground, especially in the US. But we think we are reasonably far away from the action. There are beneficiaries, of course, but I would say that that's again a space where ownership levels in funds are significantly high for the street, that even upward surprises are no longer going to provide a delta for the move for the ownership that is there. So if I leave these 3 spaces, we actually see value pretty much in every other aspect of the market. And that's really the area that we want to focus on with our approach called the good to great. The good to great is basically essentially picking up companies which have significant market share, which are gaining market share, which are doing things differently. And in every sector, we do see maybe 5-7% of companies which are doing things very, very differently. And those are the areas that we want to allocate disproportionate capital towards. And that is what, we want to focus on. So rather than looking at macro at this point of time, we think this is a market for micro. We want to go bottoms up and identify some of these franchises which are transitioning from good to great.
So these are necessarily, I mean, when something is great, it's already becomes very large, right? But so these are necessarily in the smaller segment on the market cap curve.
No. So the interesting thing is what you're saying is absolutely right, because, what is great is often a discovered trade. And therefore, as we've seen, many a time, the bigger companies or the well-discovered names, when they become over-owned, there is actually a far greater chance of disappointment than, further surprise. So yes, to a certain extent, they are far more prevalent in broader markets. But what I would like to say is that, across every sector, you actually see, sectoral headwinds come through. Let me give some examples just to make my point. So if you think of insurance, this is a dead sector for the last 5 years where there has been no real significant appreciation. And every almost 6 months, there has been some kind of a negative surprise from a regulatory change of stance, etc. But in these 5 years, if we have been able to identify companies which are using tech differently, which are gaining share, we think that these are the timeframes to actually back some of these names. I'll give you another example. If you think of, say, the West Asian crisis, there is definitely an impact on travel. But if you think that there are airports available, which are doing the right things, which after 20 years of losses have turned profitable for the first time, and have got under 30, 40 years left of residual life in those concessions, we think that, these headwinds, which come from because of sectoral reasons, provide a great opportunity to buy into many of these franchises. Similarly, we did do a significant amount of heavy lifting in auto anchors last year, wherein because of the tariff increases that Mr. Trump had imposed and the rare earth ban that came through from China, we saw earnings kind of collapse for the entire auto anchor industry. But we've seen that over the course of the last 6-9 months, providing a wonderful opportunity for us to kind of increase our positions into a few of them to get the benefit out of that. So the point is that every sector goes through a pain, Prashant. For example, IT is going through pain. Can we identify companies which have grown at 3% CQGR for the last 24 quarters? And it's not been an easy macro climate for them in the last 24 quarters. For sure, nobody knows what the future is going to be like. But that is where we think the opportunity is, that when the sector goes through pain, we get these good to great franchises at far better relative bargains, and which is what we want to kind of persist with.
So basically a tough sector. The starting point is a sector kind of ignored and not doing very well, has not done very well, right? And that ensures that you get that cheapness element in, and you're not overpaying. And then within that, you look at things which perhaps are doing things differently. It's not necessarily the sector itself is turning around, but that's the hunting ground.
That's right.
Harish, but is there one sector where there are enough structural tailwinds that we will have many winners? I get that this market's been all about individual stocks, winners in every sector. You pick the right stock, irrespective of the sector having headwinds, you would have made money. But is there any one sector which you can identify where there are enough tailwinds that majority of the stocks may do well, and it's not so much about individual stocks and stock picking?
So I think one call out that we have been as in new age businesses. That's a segment which, if you look at from a 3-year perspective, hasn't done that well. Of course, from a 5-year perspective, a lot of wealth has been created. But that's an area where, if you think about it, many of these are entrenched leaders in their particular categories. They are the categories in many of the cases. And for sure, the unit economics are not at the optimum level. These are newborn companies, in the sense that they're still finding their feet in terms of the optimum cost structures, etc. But here you've got their biggest cost being that of engineering talent. And if you've got AI, which can kind of deflate a lot of these costs and provide more for the same amount of talent in terms of features, in terms of customer journeys, in terms of revenue pools, we do think that there can be disproportionate value created in new age businesses across the board. It could be consumer tech, it could be fintech, it could be EVs, a whole range of sectors. I would think that that kind of comes through. Similarly, if I were to think of, say, chemicals from the old economy space, I would say that that's again going through a similar spot, wherein you do see definitely a China plus one narrative now coming through. It's also kind of buffeted by the fact that you've got the Chinese yuan to the Indian rupee, which is kind of moved to the 14 handle from the 12 handle, say about 12-18 months back, which has made Indian players even more competitive. So that's the other area. Of course, it's a global play in the sense that the demand is more global than from an India perspective. But over there, we prefer import substitution plays as well over there. The third area I would say would be auto anchors. I still think that there is still a reasonable amount of steam out there in some very well-run companies out there which are doing differentiated work. And there is a lot of, we've done a lot of FTA agreements with Europe, with UK, with the China segment, Middle East, I would think that, markets have opened up for India, and a falling currency has kind of further strengthened our competitiveness. So these would be the three specific areas where we think, there are greater opportunities for the here and now as well, apart from a whole range of other sectors where we do see more stock-specific kind of plays.
No, absolutely. Well, if you allow me, Harish, I know you can't talk about individual situations, but you were a big backer of Welspun Corp early on. It's done phenomenally well. You still own the whole position, or have been trimming?
We can't really speak of stocks, Prashant. We remain favorably positioned on that name. It's done very well for us. But it's just not about returns. It's also about sizing and positioning and risk management. So a whole range of other things come into creating a portfolio. So our attempt is to find more such companies rather than just have one company which does the trick for our unit holders.
Yeah.
Same space. From the same space, pipes, oil and gas?
We haven't found that many over there.
Okay.
Maybe it's some.
Okay, I think even another company that you were looking at through a close lens was, that was the anti-consensus trade, I think, over there, investment, the IPO. You'll believe that theme as well will pick up from here on?
Sorry, which IPO?
With a closer lens.
Okay. Yeah. I would think so, absolutely. I mean, we continue to be very large owners out there. And in this case, obviously, they've executed supremely well, post-listing and even beyond. And we think that this is possibly one of India's multinational companies in the making, with significant use cases in the AI world. We think that this is one of our core positions. We continue to kind of maintain them.
Any other ways to approach things? I mean, I think we've at one point spoken about change at the top, right? Perhaps being a catalyst for a better direction. I'm talking about management change, etc. A focus on that as well, Harish?
Absolutely. So, Prashant, just to give you again another data point to kind of give the base rates of all these, right? In any given year, roughly about 30% of the top 500 companies give an alpha of 20% on a one-year basis. These are outsized alpha, I would imagine, when you think of a 20% alpha, right? Now, the key is, what are the common characteristics of these 30% names? The names keep changing. And of course, we don't play them only for 1 year. We play them for maybe a 3-4 year kind of a period. But I'm just giving you a reference as to how we think about it. So one set of names are the completely ignored camp, quote unquote value, deep value, etc., which, there can be a catalyst in the horizon. It could be a sectoral catalyst more than anything else, which does the trick. And therefore, you have these themes which kind of catch forward. It could be PSUs in the past. It could be industrials in the past. We think that, pockets like insurance, etc., possibly can kind of get in that. Now, the reality is nobody knows when exactly these themes are going to fire, but you want to be kind of present in those. The second was, as you rightly called out, changes. Wherein, typically a good to great doesn't happen on its own. It has to kind of get kindled by some change from within. And that is what we keenly watch out for in terms of where is talent going, what is the kind of talent that companies are kind of attracting. And that is what we want to kind of look at very, very closely in terms of seeing that come through. The third is, of course, momentum, right? Stocks that do very well can continue to keep doing very well in the near term. And that is what you want to kind of continue to play. For example, metals is something that we called out about 18 months back as a dark horse segment. And now it is no longer in the dark horse segment, having done so well. But we still think that there is still continuing to be opportunities out there in metals, wherein the rest of the developed world is getting back into manufacturing and industrializing, which means that they can afford far higher cost of metals compared to when China and India alone are the only consumers of metals. And therefore, that's again a thesis that we have that we want to kind of play through. So a combination of these 3-4 different sleeves or approaches is what we look for to try and have a reasonable amount of our portfolio in those 30% bucket. Of course, nobody knows beforehand which of the 30% will fire. Some of them may not fire. But if you increase your surface area out here, I would think that there are greater chances of success than failure.
Harish, some of these recent IPOs in the last 2 months have been complete repricing events, 30-40% pops in 1 month. Have you all participated? And if yes, give us the themes which you liked in the recent IPOs.
We've been selective, Rima, in the sense that some names that we really like, again come from, say, precision engineering is a name that we participated. Dairy, again, FMCG has been out of mindset. That's again an area that we've kind of liked. That here is a company that's doing things very differently, and this is a name that we want to kind of evaluate and kind of participate in. So, and of course, then there have been new age blocks, etc., that we've been kind of nibbling through. But our overall IPO participation, just to give a sense, is close to about 20%. So 4 and 5 IPOs, we are not really participating in. We are a lot more selective just because of the quantum of people that's at play today, that we want to be slightly more selective and then to take, big meaningful bets rather than spraying and praying across a whole range of IPOs.
Yeah, no, absolutely. And in some of these things, I mean, if you extend the timeline after the initial 30-40% pop, I mean, you usually get after the frenzy, you get a bit of a hangover, right? You get those dips eventually, and then of course.
Just to give you data out there, Prashant, so in the last 3 years, only about 30% of IPOs have actually kind of outperformed NSE 500 by more than 5% since their listing. So the odds are stacked against them for really holding on for much longer. But that doesn't mean that, we are flippers. We kind of want to think from a longer term lens and back companies which are doing the right things. So the key is to therefore, be selective rather than say spray and pray. At least that's been our approach over the course of the last 2.5 years.
Harish, I know you mentioned briefly that you in the macro stuff, etc. I know you have an eye there on all the big macro changes afoot, etc. as well. But you become much more micro, right? And that has absolutely worked. So is this? But we've been in this micro regime, macro can go to hell kind of an environment for a while. But it comes back sometimes, right? And there's that overlay, gold and oil sometimes does what it does. But broadly, it's been a micro market. Is this regime here to stay, in your opinion, or you think we will flip back to a macro-ish kind of market? What's your sense?
I think the easiest way to see that is Google search trends, Prashant. If you still look, and I haven't looked at it in the last 1 month, so might be a bit dated. You look at the number of search trends happening in India on multi-baggers and the number of search trends on, say, Crunch. Okay, and what you see in, let's say, March, April, the number of search strings for crashes were far more than the number of search strings for multi-baggers. The number of multi-baggers, even now, the searches for that is still significantly lower than what we have seen in 23-24. So we are still in the early stages of bottom-up investing, is my sense. That doesn't mean that macro doesn't play a role. All we are kind of saying is that, today there is no real edge in forecasting what Mr. Trump can do. He can do anything. And therefore, if I'm going to spend disproportionate time there, I'm going to miss out on a lot of opportunities. Having said that, the only one macro variable that I keenly track at is interest rates, especially at the longer end. And the developed market, clearly interest rates have kind of broken out after a 2030, in certain cases, even longer time frame horizons. And that is worrying because that can reset a whole range of paper on the riskier assets. I really don't know how this is going to play out. But this is something that I would say, one should definitely keep an eye out for, rather than completely get carried away to micro and then, to go to lower quality names, etc., just because, the momentum is seemingly good at that point of time. So I would say from extreme micro, maybe we need to get to, say, 70% micro and 30% macro. Just putting a number just to give us, convey a sense of how we think our thinking is kind of gravitating towards.
No big macro moment of reckoning, but introduce some element of that possible, right? I mean, suddenly it changes and you got to be, so it can't be all, you got to have an eye there. Well put.
I would say US 10-year crossing 5, if at all. I mean, that is a massive thing. We're not very far off, so we'll have to look out for that.
Lovely conversation. Thank you very much, Harish. Great speaking with you, and come back again soon. Thank you. Harish Krishnan, Aditya Birla, AMC, with the conversation around markets. But I think we've got a corporate waiting from the housing finance space. Rima, Aadhar Housing.
Yes, indeed. So Rishi Anand has been patiently waiting by. He's the MD and CEO of Aadhar Housing Finance. Thank you very much, Rishi, for joining in. We'd like to talk to you about business, asset quality, and where we are headed from here. But let me begin with a question on asset quality, because your credit costs, I know on a small base, but it did increase sequentially. It was 10 crore, it went up to 31 crore. Your stage 2 assets increased. It's now 3.3% of your portfolio. Gross NPAs, though 1.3%, ticked up year on year. Is there any early signs of stress, or was it driven by accelerated write-offs? What are the slippages? Any stress that you're seeing?
Morning, Rima. As always, it's a pleasure being on your show. And it was lovely to hear Harish with his views. Okay, with regards to, the numbers that you've quoted, whether it is GNPA numbers, stage 2 numbers, I think it is more to do with the seasonality impact. That's how the numbers tag out on quarter one basis. But are there any early signs of stress? I've always been very vocal about it, that for us, the first line of defense are the bounce rates. Fortunately, the bounce rates have been stable state for the last 8 quarters, and even the quarter and the current status as we are in. I don't see any stress. It's more to do with the seasonality impact. And as we go towards quarter 3 and quarter 4, things are better than quarter 1.
Okay, so the increase in the deterioration slide is on account of seasonality. On the spreads, because I remember Aavas, financiers management, he sort of explicitly said that a structural compression in affordable housing spread is unavoidable. That was the word he used. And he said that, their spreads could come below even that 5%. For you, you're higher at 5.5%. But are you seeing over a period of time, as competition picks up and this becomes fairly standardized affordable housing, there could be a structural compression in spreads? Or do you think these stay?
Rima, the quarter in question, we've exited at 5.8% spread. And if you recall, all our interactions, I have maintained a stand that at any given point in time, Aadhar will be 5.5% upward. Are we looking at a compression on spreads as we go ahead? I will not use the word compression, but the incremental business coming in is a slightly lower spread. And on the book, it will take a couple of years to catch up. So I will take that statement with a pinch of salt, saying that there is substantial compression. Yes, it will, over a period of next 2 years, I'm saying will be upward of 5.5. Today, we are at an exit of 5.8.
And why is incremental business coming in at lower spreads? Is it on account of competition or anything else?
It's a mix of multiple things, Rima. The urban locations, which are the top 150 branches for us, the incremental business comes at a lower spread because on account of competition. And then there are these emerging locations, which are 450 branches, where the quantum is less, but the spreads are higher. The art is about balancing the entire act.
Okay. All right. Hi, Rishi. Good morning and good to see you, Ben. Could you tell us what is the targeted mix for non-home loan products? For example, I ask this because if I look at it, I think in the last quarter, your other mortgage loans grew by close to 20%. That's what outpaced the retail home loans. I think it accounts for roughly around 27% of the AUM. So what's the targeted mix?
You're right, Nigel. The targeted mix always will be 70-30 on an outer side, because we are governed by something called the principal business criteria, which has to be a 60% on balance sheet, broadly 70-30. We are today on the book, and your numbers are right. We are at 27%. That's where we want to be. We don't want to be closer to the margin line. So 27% is what we are looking at. Incrementally today, we are hovering around 24-25%. That was on account of the West Asia crisis, and we had called out certain locations. But given the current situation, it's a comfortable position, and we will inch back to about 27% incrementally.
Rishi, hi, morning. We had a banking NBFC event recently last week, and it was Jairam from Piramal who essentially, I don't know if it was an early call out, but he essentially sort of called out LAP as a segment, which he thinks, and by the way, they're all affordable, they're all housing and LAP as a book, saying that, well, maybe the LAP segment has grown too fast compared to price appreciation and underlying assets there. Would you see it that way? What's your sense?
Prashant, I saw that interview between you and Piramal. The way I look at it, higher ticket LAP has grown substantially. with companies which do premium housing. And there can be a question mark around that. But the way we do our business is our lab ticket size is lower than our home loan ticket size, which is approximately about 9 to 10 lakh rupees. I don't foresee any stress. Risk adjusted, and the other way to look at it is risk adjusted spread for me in the low ticket lab that I do is about 350 basis points, Prashant. So I would say it's a comfortable position to be in unless we get up and change the segment altogether, which we don't intend to.
I see. So these are, I mean, you're exposed to, in terms of ticket sizes, very much smaller. I mean, even as compared to housing.
That's right.
Right? And you're saying that maybe the risk is building in the higher ticket size loans there, LAP loans.
That's right. That's what we get to hear from the industry. Having said that, low ticket size, there is no built up that it's seen. Again, I'll come back to the same point of my first line of defense, bounce rates being stable even on non-housing loans, which is loan against property.
What are your bounce rates?
Sorry?
Okay, no, I was asking you what your bounce rates are, but just in case we run out of time, one more question. While your growth is in line with the guidance that you've been sharing, 17, 18% disbursements, 20% growth on AUM and PAT, so you've been consistently holding on to that. But some of your peers are actually growing much faster. So again, comparing with, say, Aavas Financiers, 41% growth in loan disbursements in the current quarter. Home finance disbursements were up 31%. So compared to that, like to like, your growth is lagging. Go ahead. Is that a conscious? Go ahead.
I will not say it's a conscious decision to grow slow, Rima. I think the fair comparison would be, over the last 2 years, the companies that you mentioned, the previous year growth numbers were lower. So when you do a YOY comparison, that's how numbers tag. Last year we grew again YOY all 4 quarters at about 20%. And this year, again, we are growing at about 18 to 20%, holding the guidance at 20% AUM growth. I think it should be fair enough to compare last couple of years rather than just one year of YOY.
And any update from Blackstone in terms of their holding in the company? I think once you told me around the time of the IPO that the fund life stays till 2030. So does that still hold, or are they looking at periodic stake sales?
So, Rima, the good news there is that February this year, they rolled over the fund from Fund A to Fund B, which is good news, which means they are not looking at an exit right now. And obviously, it's a private equity rollover, which gives a lot of confidence and trust on the management. And the market, the so-called buzzword overhang is off the table for now, at least.
Got it. Rishi, we'll leave it there. Great conversation. Thank you very much for coming on. It's always a pleasure.
As always, Prashant, thank you.
Thank you. Well, that is Aadhar Housing with pretty solid commentary, all told. We'll take a break. We're back with the management of Titagarh Rail Systems. The Indian Railways plans four laning of 11,000 kilometers of high-density network to boost train capacity. What's the opportunity for Umesh and Titagarh Rail Systems? That's the conversation up next. Welcome back. We're just moving away from markets for 2 minutes. Absolutely tragic news coming in from Tibet and Nepal. The visuals are scary and heartbreaking at the same time. Over 150 people were confirmed dead, and more than 400, including around 133 Indians, are missing or out of contact after a massive flash flood in Nepal swept through villages in a district bordering China's Tibet region. Officials said the death toll could rise and that it would take days to assess the full extent of the damage. Our colleague Arunima has reached Kathmandu and has filed this report. Let's just go across to her.
See, I am reporting live from Kathmandu, and what we are learning is that from Kathmandu, if you move up north, for about 50 kilometers, the road is still available, the road is motorable, but beyond 50 kilometers, for the next 150 kilometers, there is nothing available. So the Nepalese army, they are trying to, see whether they can take the circuitous route to reach the epicenter, because there is no, relief and rescue material that is possible to be sent there using the road route. The roads, and we've seen those visuals, how bridges have been washed away, how the river in Spate took down one bridge, and the impact of that concrete cut through a number of bridges, like it was just cutting through, it's like a knife and butter meeting. That kind of visual we saw over the last 24 hours. We're also reporting from, one of those nalas, the tributaries of those rivers which connect various parts of Nepal and then flow onwards towards Bihar and Uttar Pradesh. There was a lot of concern that the rising level of water could bring down, villages on the border areas of Bihar-Nepal border and UP-Nepal border as well. But we are told that the river water there has now stabilized. But here in Nepal, the situation is extremely grim. All the help that is coming in from India, from the other countries, is much needed as Nepal tackles yet another natural calamity.
Our hearts go out to the people who are still missing. As I said, 133 Indians still unaccounted for. Those visuals and a lot of these pictures and visuals on social media and elsewhere, which kind of tells you the scale of the tragedy, the volume of water, and just it's in some ways, some of the worst we've seen, a natural disaster unfolding in front of your own eyes. We'll keep getting you updates and, put out the information with regards to the helplines, etc., which are available, where you are able to sort of, hopefully get in touch with loved ones and people who are still not being accounted for. So that's the news out of Nepal at this point. Okay, well, just to come back to the markets and the corporate landscape. Now, the Railways is planning to 4-lane 11,000 kilometers of its high-density network to increase train capacity, reduce congestion, and improve passenger and freight movement. Do note that these routes cover about 16% of network length. 41% of national rail traffic is covered in this as well. Umesh Chaudhary is Vice Chairman and Managing Director at Titagarh Rail Systems. He's with us. Umesh, good morning. Good to have you with us here. Thanks for joining in. Could you tell us, sort of comment on the news that I just read out, and tell us what does it mean for Titagarh?
Yeah, good morning, Prashant. So this is something which, I've always maintained that the railways are very well on track to target the 3 billion ton of freight loading. And I think, the whole way that the railway ministry has been moving in a very systematic manner, they've kind of identified the bottlenecks in the entire railway circuit. Earlier, the dedicated freight corridor was commissioned, and that took away some of the bottlenecks. And these are the residual bottlenecks which are actually becoming impediments in growing the freight traffic to the 3 billion ton target to start with. And obviously, all of this will mean enhanced wagon offtake from the railways, for which it's going to directly impact our business positively.
So this is these are basically 2 lanes, which will you got to put 2 more tracks, right?
That's absolutely right. So basically what happens is that, the whole track, if you look at the entire railway system, is like a pipeline of water. So how much water can flow through the pipeline is only dependent on the blockages that are there in between the pipeline. So these are the blockages that were happening. Once those blockages are kind of removed by having additional capacity on that pipeline, the whole capacity of the entire network kind of multiplies.
And wagons will come in. You're the late, in a way, out of this project. You're the late cycle beneficiary, right? Wagons will come in last in terms of the need for them. How long does this take typically? I mean, do we have an estimate for laying these tracks now?
So, any infrastructure investment in the railway is actually, the wagon is always the last end of the beneficiary cycle, but it is the perpetual one. So if basically if you kind of look at it as an industry, the railway track is capacity creation, and then in order to use that capacity, the wagon purchase is like purchasing raw material, because the more you use capacity, the more wagons you require. Now, it's very difficult to kind of identify or quantify this exact number of wagons that is going to get enhanced because of this, and because of the existing routes, because that's not completely infungible. So it's basically going to elevate the overall freight loading of the railway system. That doesn't mean that the existing system is not going to require additional wagons. This is only going to bring the next quantum leap on the wagon requirement.
Typically, Umesh, has land acquired, or this will we need to go from land acquisition, because then that is a lengthier process, right? There is land typically available on both sides.
Most of the cases, the land is available.
Okay. So you don't...
Because if you look at the railway landscape, the land along the track is always owned by the railway. So it's basically just the execution has to be done. And I also must compliment the railways on the speed of execution. They've been extremely good. And I've seen the way the Honorable Minister monitors projects nowadays over the last 4-5 years. It's been phenomenal.
Okay. Umesh, the other set of news that happened recently is that you've been included in the approved vendor category for supply of traction motors. How significant is this development? So earlier you were sourcing these motors from someone else and putting them into the wagons, and now you're a part of this vendor list. How many people are included, and how large is this opportunity?
So this is significant from multiple perspectives. So we started manufacturing traction motors a few years ago, and there is a kind of a process that one has to go through in order to become approved. So we supplied a few number of motors in the beginning that got tested, and this is the final category when sufficient number of motors, if I'm not mistaken, 1,000 or 1,200 motors have already worked successfully in operations for more than a certain period of time, 1 or 2 years. So then we come into the vendor category. Now, what it does for us is market opportunity opens up for us, so we can supply traction motors to the Indian Railways. But also, what is significant is that this is a part of our overall larger plan to start using our own propulsion. So, for example, in the Vande Bharat or in the metro, when we want to use our own propulsion system, which I've always said that within 28, 29, 30, we'll start using our own propulsion system. There is a certain eligibility of having supplied a certain number of motors and propulsion sets. So this actually helps us in getting closer to that target as well. So it is not only from a business perspective extremely important for us, but also from the future strategy perspective extremely important for us.
So what is the total addressable market for traction motors today, the TAM? And what is your capacity? As you said, you want to use these propulsion motors for internal use, for Vande Bharat, etc., for captive use. What is the capacity that you have currently that you can supply on an annual basis for yourself, or even to sell outside?
Our capacity is 1,800 motors right now, which we will increase to 2,400 traction motors over the next maybe year or two. What we have got an approval is for 1,200 motors per year for the locomotive motors. So these are the larger motors that go into use for locomotives. And the balance, we will use it for EMUs or MEMU or the passenger trains. So not the locomotives, but the passenger trains.
I guess designing, casting, delivering these would be higher margins? Would this be a margin accretive?
Yeah, absolutely. So, these are much more kind of higher end in technology. So, whatever we are doing in our passenger rail segment is actually a very different business from what we do in our freight rail segment, because, it's both are wide, but both are chalk and cheese, in terms of technology, in terms of infrastructure and skill sets required. they're very, very different from each other.
And this 1,200 units per annum is how much do you sell each one for? And what are the margins?
So ballpark is about 16, 17 lakh rupees a piece.
16, 17 lakh. And margins?
So propulsion typically, on a steady state, propulsion gives you a 20% margin. So I'm not saying that we'll start getting 20% margin from here, but it's complete propulsion means traction motor, traction converter, and TCMS. So as we've always said that our metro coach, for example, 20-25% of the metro coach is the propulsion, and that's a 20% EBITDA margin business. So once we can, through this and through our own development, start using our own propulsion for our metro coaches, we would have an effective 4% additional EBITDA margin that will come into our books.
And this capacity expansion, how long will it take? And is it sizable in terms of the investment?
No, we've already made almost all the investments. So it'll come into action within the next maybe 12 months. Most of the investments already done.
All right. Umesh, we'll leave the conversation here. Thank you very much for joining in. Always a pleasure. Okay, for the markets, very, very quiet. The Nifty stuck around the 24,200, 16 points lower on the Nifty Sensex, down 100 points. All the indices, I think the total move for all of them is less than 0.1% as we speak. So I guess all the action shifts to the last hour because that's when we have the Sensex expiry.
Well, that's right, Rima. In today's tradings, I'll tell you what, let's do one thing. Let's slip into a short day, come back, we'll give you an update in terms of the F&O market, given that today is the Sensex expiry, and also Manisha Gupta will be joining in to help us out with the commodity action. Stay with us.
Welcome back. Let's talk commodities now. Manisha is joining in and she's eyeing copper. Why is that? Another day, another move?
It is, and another all-time high as well. Well, actually, when you look at metal as a space, whether it has been ferrous, non-ferrous, all of that has been doing quite well. And even as we're looking at zinc prices at over 4-year highs, strong rebound in copper, iron ore, steel. But it is copper that is what we're looking at, because we're looking at all-time highs in the New York session last night. And we did see prices go all the way to $6.67 per pound there. Well, copper in US has been surging quite high. When you look at the LME prices, well, they also hit $14,350 a ton. All-time high that we saw in January for copper was $14,600. So not too far away from those kind of levels there. And the markets or supplies are pretty tight outside of US, and that is what is bothering the markets therein. The US COMEX inventories, when you look at that, are at a record 6.75 lakh tons. And US has imported nearly 885,000 tons of copper in the first half of 2026 itself. Now, White House is yet to make an announcement on tariffs on refined copper, but what we do understand and what has been proposed is that it's going to be a 15% tariff on refined copper from 1st January 2027, and that could be hiked to nearly 30% in 2028. And ahead of that, there's a lot of front loading in sense of inventories that we have seen in US. So US has record inventories, which will perhaps take them years to consume all of that. But when you look at inventories in various other exchanges, well, that clearly has been declining. COMEX, as I said, 6.75 lakh tons, and it has been much lower in LME at 2.3 lakh tons. Shanghai, if you look at those numbers, in August is much lower at 41,000 tons, just about that. In March was a high of 3.26 lakh tons. So we are looking at inventories continuing to decline. And it's not just about inventories, because when you look at the overall global markets, well, they have lost nearly 3.3 lakh tons in production in first half of 2026. These are the reports that have been coming in from various agencies. Add to that the fact that there is lower output in major producers like Indonesia, Congo, Chile. We've been reporting all of those mines from these countries on the kind of impact and damage that they have. And then it also has to do with the smelter crisis, because there is lack of concentrated copper, and that has led to zero treatment and refining charges. It also has to do with sulfuric acid, where you are looking at geopolitical factors training the supply of that. That also has led to lower smelting capacities. And then you have strong demand coming in from data centers. The conventional copper demand has in any case been on the stronger side. The global power grids, which are also undergoing mass infrastructure builds, especially in China, where they have a very strong target until 2030 and then 35. Chinese demand for copper has been on the stronger side as well. The EVs, they require, well, 6 times more copper than what internal combustion engines do. So everywhere that you look, you are looking at stronger copper demand going forward from here. Until now, the markets believe that it was perhaps just on paper and the on-ground demand is not picking up, but the inventories do show us, and when you do that maths, you do understand that there is strong demand. And then apart from that, you have institutional investors, hedge funds also very active in physical commodities, and that in turn also has seen a lot of money rotating into this one, keeping the copper prices higher.
Thanks a lot for that, Manisha. Well, let's focus on the Sensex derivatives action at this hour. Well, in terms of the Sensex, we're holding more or less flattish, but a couple of sectorial gainers in today's trading session include the likes of the capital goods space as well as the defense space. So though the Sensex is more or less flattish, you're seeing traction on both these two indices. Moving to the options data, then, there is clearly signs of call writing. The 78,000 call, the premium out there, well, that's come down, to quite a bit. It's come down to around 16 bucks. At the start of today, it was around 55 rupees. As is the case with around the 77,500 call. Premiums down to 100 bucks. Earlier today, it was at around 250 rupees when we started off the trading session. So there is writing being seen on that levels. For the bullish perspective, they are hoping that lower levels hold out, because 77,400 put, 77,300 put, there's a fair bit of action at both those two. So to put in a level, I think on the downside, the 77,150 mark, that's important that we defend on the downside, and close to around 600 points higher, which is 77,250. That 77,750, that could be the broad range that we're looking at for today's trading session as well. So let's see how that goes. For the time it appears, this is the 500-600 point range that the street is positioning for this weekly expiry to play out. For the time being, though, we'll slip into a short break. On the other side, our special segment, It's the Economy. Lata speaks to Nomura's Rob. Stay tuned for that.
Welcome to It's the Economy. This is an important discussion. Global financial markets are keenly awaiting Friday evening India time. That's when Kevin Walsh, the US Federal Reserve Chairman, will speak at Jackson Hole. Jackson Hole, Wyoming is a very important, almost a mecca of central bankers, and the speech by the US Federal Reserve Chair is very important at that point. It's also important because of the context. US yields are at 19-year highs, and the latest inflation reading, July PFCE inflation, has come in at 3.7%, slightly higher than market expectations of 3.6. So the speech becomes even more important because higher US yields can tighten money supply for the world and even for emerging markets like India. To help us understand the global context along with the Jackson Hole speech's importance, I'm joined by Rob Subaraman, the chief economist at Nomura. Rob, good morning, and thank you very much indeed for your time.
You're welcome, Latha. It's good to be back.
Thank you. Well, let's start with the speech itself. 19-year highs on US yields. The last PFC inflation reading is not really very encouraging. 66 months of US inflation being above the target 2%. What would you watch out for?
Yes, so there would be a lot for the new Fed chair, Kevin Walsh, to talk about, but he seems to have a new communication style, which is minimum communication. So I think he's most likely going to stick to his new strategy, which is not providing much forward guidance. And so I don't think we're going to get too much new news from Jackson Hole, from Chair Walsh's speech. Look, Lata, I'd say the one thing that he could do, he doesn't want to give any kind of hints of what the FOMC is going to do because his argument is, it's very uncertain, we don't know. Forward guidance isn't as useful tool as it used to be. But what he might do is lay out a few scenarios of how the US economy could evolve going forward and give a little bit of a hint of his reaction function depending on those scenarios. So, one might be that because of AI, inflation reaccelerates and what he would do. Another could be that AI actually starts to boost productivity more and we get inflation coming down, and then he could discuss what he'd do. There's many others, but that's what he might do. Talk a bit more about his policy reaction function. And if he says anything about US Treasury yields, I think that's going to get a lot of interest as well, given that his counterpart in the Treasury, Scott Bessent, has been trying to push those yields down.
Yes, you're right. It could well be the yawn of the week with Kevin Walsh not giving away anything at all possible. But in that case, let me also draw up scenarios. What are the chances that US yields go to 5%? At 4.73 now, the US 10-year, and inflation not coming down, the oil prices, crude prices also not falling enough. And most importantly, my colleague Manisha was just speaking to us about giving us a commodity roundup, and she says copper prices are also at all-time highs. So is there a chance of this US yields going to 5%?
I think, Latha, certainly there's a chance that 10-year Treasury yields could reach 5%. I mean, if you look at the drivers, we have a very large US budget deficit, which means there's a lot of government bonds being issued. At the same time, these hyperscalers are issuing their own AAA bonds, and that's kind of crowding out Treasury buyers who will typically be buying Treasuries. They're buying the hyperscaler bonds instead. In addition to that, as you've talked about, inflation is still a bit elevated, and the report out overnight was a little bit higher than expected. And then the other thing is the composition of the buyers of treasuries, the holders of treasuries. It used to be foreign central banks. They've been scaling back, and instead we're starting to see private sector investors, including hedge funds, holding a greater share of treasury bonds, and they're more price sensitive. So the answer is yes. I think there is a risk that 10-year yields go higher. And then the interesting thing will be to see how Scott Bessent responds to that, because he says there's a lot more tools he's got a lot more tools in his kit. It'll be interesting to see, what he actually comes out with. I think if he came out with very draconian measures, the most draconian would be to somehow strong-arm the Fed to restart quantitative easing and buying treasuries. I mean, that's a strong way to get treasury yields down. But that could lead to more inflation, and I think the implication would be a weaker dollar in that scenario. So it's no surprise to me that we're starting to see gold prices, Bitcoin prices going up now. I think that's partly over these tail risks that Scott Bessent could get much more aggressive with draconian measures to try to get the treasury yield down, but that could risk debasing the dollar.
Fair point. But just one last word on this global US yields. Do you think even if they go to 5%, the scare doesn't seem to be like it was in 1997 and 98, when the Asian crisis happened, nor even 2013 when India was one of the fragile five. Now, higher US yields don't seem to be rattling to the point of disruption. Is that fair, that even if it is 5%, we don't have to palpitate in Asia?
I think that's a really good question. I mean, part of the reason for resilience is that you have this very powerful AI theme, and NVIDIA just released their guidance for revenues going forward, and it remains very strong. So, I think that... as well as just still a very strong US economy, I think makes it more tolerant to be able to, have a higher yield without kind of tanking the economy. But, Latha, these things never move in a straight line, and there is the risk at some point that the rising financing costs start to bite. So I think we have to keep that in the back of our mind, that the way I'd put it is, the higher that long-term rates go, the more they go up, the economy is more vulnerable at some point to a setback. It's hard to kind of pinpoint when. Maybe if some other shock happens, that can trigger it. But clearly financing costs going up is a constraint on the economy.
Actually, you answered partly the question that I was going to come with. Instead of worrying about the bond yields, are we celebrating growth not enough? Are we ignoring these very important growth signals? There is a huge capex cycle in the US, which is why, of course, copper prices, etc., are rising. There is also a very big capex cycle in Asia. There were some reports by brokerages saying that credit growth, loan growth in Korea, Taiwan, China, Japan, in Asia in particular, is at an 18-year high. So maybe there is a big growth tailwind, would you say?
I would say that certainly the global economy has been remarkably resilient, right, Latha? If you think about, if you started this year and talked about, this severe US-Iran conflict and what's happened to commodity prices, energy costs, now food prices going up, and you talk about, all the geopolitical uncertainty that we've seen, I think most would be surprised at just how well economies have done. I would say, the biggest factor for this has been the AI capex build out, and that certainly helped the US. And as you rightly say, it's helped a lot of countries in Asia that are the big hardware suppliers and the chip suppliers for this AI build out. So you're absolutely right. I think that's why we talked a bit earlier how it's not surprising to me that we're starting to see interest rates going up. It's kind of justified by how these economies are doing. I would point out, though, that not all economies are resilient and strong. Economies that are kind of large commodity importers and are not benefiting as much from the AI boom are struggling. So, I think there's countries in Europe like that. And then even in Asia, there's some countries in Southeast Asia that are kind of struggling because of that. So it is a bit of a mixed bag, but there's certainly economies that are doing a lot better than people would have thought, given where commodity prices are. And I'd say that's the AI boom that's driving that.
Oh, yes, it indeed is. But, India actually fits your description of one of the more vulnerable economies because you're both commodity importers and we are not beneficiaries of the AI boom in the sense we don't have an AI-listed stock. But, Rob, I think the global growth advantage is impacting India. The Reserve Bank started the April-June growth forecast at 6.6. They scaled it up to 7. A CNBC poll, which I did yesterday or day before, came at 7.5, and there are people who are expecting, large banks like SBI, expecting an 8% GDP growth for the April, May, June quarter. So do you think there is an upside risk that people are underestimating India growth?
I think they are, and certainly we would be in that camp, that the risk for the next quarterly GDP number that I think comes out later this month for the first quarter of this calendar year, second quarter of this calendar year, is going to potentially surprise on the upside and could be very similar to the first quarter, so close to 8% growth. And, that, as you say, Latha, that is a very strong achievement given the commodity prices going up and India, not benefiting at this stage as much from this AI build out as others. Although I do think over time, India will benefit more. There'll be displacement as well, but I think on net, India is going to do reasonably well. I would put a lot of it down, Latha, to good policies, right? I think the RBI had very prudent monetary policy. Fiscal policy has been pretty prudent. And I think, domestically, that's allowed people to get on with business, whether that's the consumers or the corporate sector. So growth is doing well. Indian inflation, it's been picking up, but from a very low level. Fundamentals in India are much better than they used to be.
Mm-hmm. Oh, yes, absolutely. We were all, the noise around growth is negative, but the data on growth is extremely positive, at least up until July, as even your report is pointing out. Just finally, do you think the rupee is kind of past its worst? We've got all these $70-80 billion of the special flows that came in. So do you think the rupee is past its worst? Or do you think these AI trades can come back to strike again?
That's a good question. I mean, I think through the FCNR and other schemes, the RBI has built up, rebuilt its FX reserves, and that can dispose of them to deploy them to stop the rupee weakening in the near term. But I think a lot of investors are thinking what happens after these schemes end. And the RBI has a lot of obligations in its FX forward book as well that will eventually mature. So I think it really comes down ultimately to the fundamentals in India. If India can sustain growth rates of close to 7%, and if Indian inflation does not get out of control, I think then, India will, over time, start to attract more capital from overseas. I think at the moment there is a little bit of this stigma that India is not a key player in this AI theme. I think that will change over time. India has an enormous amount of talent. Just as it got into software, I think it will get into AI over time. But it will take a bit of time. But as long as growth is strong, inflation is low, I think the money will start flowing to India. And I think, dollar INR should do reasonably well. Our forecast for the end of this calendar year, December, is 93 for dollar INR. So we do have a bit of a strengthening against the dollar in the second half.
Well, that's good. Thank you very much, Rob Subramanian, for giving us a world view, giving us an A+ probably for the way in which policy has handled so far, but caution ahead. Thank you very much for joining us. Well, break after that, Chartbusters.
A Singapore court rules against Tata Power in a near $500 million arbitration case. The stock falls 4%.
The United States issues an order restricting its purchase of some foreign-made power equipment. Analysts say that the order seems to be primarily focused on China and believe that Indian exporters will face lesser competition. Power equipment makers like GE Vernova, Hitachi Energy and CG Power rally in trade.
U.S. investor files a lawsuit against HDFC Bank citing a breach of U.S. securities law. The bank in a statement says the lawsuit is without merit and that it will defend itself. The stock trades with a cut of almost 1%.
Morgan Stanley is bullish on Adani Energy Solutions. The brokerage is overweight on the stock with a target price of 1,943 rupees a share on the back of encouraging order wins and higher transmission capacity.
And Pine Labs rallies on the back of a bullish note by Investec. The brokerage has initiated coverage with buy rating and a target price of 200 rupees per share, expecting 20% revenue CAGR over the next 3 years, along with significant margin improvement.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam, and the markets are more or less flattish. The Nifty just below the 24,200 odd mark. What's up?
Well, Nigel, just a couple of stocks that are up right now. The market's pretty much flattened out right now. We do have, from the broader markets, a couple of these real estate names doing extremely well, particularly the ones which are based out of Mumbai and around as well. So Prestige, for one, it has a Mumbai property up at the high point of trade. We have Godrej Properties, which has moved higher as well. So alongside that, we're seeing some traction here. RBL Bank is the other one from the broader markets, which is actually spiking. But beyond that, we just have a few stocks which are gaining as against the number of stocks which are at once declining. And the ones which actually are falling right now are these cable makers. So we have Polycab, which is lower at the low point of trade. KEI Industries too is the other one, which has slipped to the lower point of today's trading session. So good time to actually get in a quick technical check on the market. There you have those cable makers currently at the low point of trade. Sachi Taker joins in now. Sachi, we've been consolidating. I mean, every time we move towards 24,350 above, we start seeing some supply. And as we move towards 24,150, 100, we start seeing some support. And that's been the case for the last few trading sessions. In light of that, do you stay away from the index and play only individual stocks, or do you have a trigger here as well?
Good morning, Mangalam. Good morning, Nigel. Clearly, if you look at the last 5 trading sessions, the Nifty defended this support at 24,180 well. In fact, it has been managing its closing above this particular level, which is very significant. Its 50-day exponential moving average is also placed in this same cluster. But on the higher side, we have seen that it has not been able to surpass above or sustain above that 24,300 mark, 340 mark. If you look at the overall data set, it again coincides with the 5-day exponential moving average resistance. So I think it's better to stay away from the index. But if you look at last 2 trading sessions, the way the Nifty has shifted gears again, the 24,000 support now looks visible, and we may see slippages towards the same. So I think from a trading perspective for a day or so, probably one can be on the short side. One can keep a stop loss at 24,280 on closing basis and expect that the markets remain trending on the lower side towards 24,000. Until unless we don't see a confident close about 24,340, the probability of a bullish wave unfolding on the higher side looks, bleak, and probably we may see slippages going forward. So it's better to be on the short side, keep a stop loss at 24,280 on closing basis when it comes to Nifty.
Okay, all right. Let's get a stock picks out of the way.
Well, it's better to keep a long-short combination. Jubilant Foods is something that has seen a very good up move in the last few months. But if you look at last 2 trading sessions, we have already seen a breakdown and a classic failure near that 50-week exponential moving average resistance. If you look at the cluster, 500, 505 has been a very good resistance since yesterday. We have already seen a negative crossover on its 5 and 20 exponential moving averages. The stock is finding it difficult to sustain about the 50-week exponential moving average resistance. So we're expecting a drift towards the 466 levels, hence recommending fresh short positions in Jubilant Foods futures. One can keep a stop loss at 505 on closing basis and deploy shorts. On the long side, Ultratech Cement has started this particular series on a good note. 11,800 has been a very strong support now. If you look at the overall setup, it looks like a breakout from a falling wedge formation. We are expecting a further upside towards 12,260 to unfold, and hence we are recommending building fresh long positions in Ultratech Cement futures. One can keep a stop loss at 11,760 on closing basis. Disclosure would be that we have recommended this trade setup to our clients as well.
Thanks a lot, Saji, for joining in and filling us in with those calls on various stocks and the index as well. For the time being, we'll slip into a short break. On the other side, Amit Murarka of Axis Capital will be joining in to help us out with the outlook on steel pricing and tell us how is he reading the recent bounce in long steel prices. Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. Well, let's focus on the steel pack then. Off late, we have been seeing that companies with higher long exposure, they have been bobbing around. Stocks like JSPL, that's Jindal Steel, that's been renamed as Jindal Steel, as well as SAIL in particular. Amit Murarka of Axis Capital joins us to help us out with a quick check. Hey, Amit, good to have you on the show. Thanks a lot for joining in. Well, tell us, what's your reading of this bounce that we're seeing in long steel prices? First, what is the quantum of the bounce that we've seen in long steel prices? What is the difference currently between longs as well as flats? And how do you expect trends to take place going ahead?
Sure. Good morning, Nigel. Thanks for having me. You're right. Long steel has been rallying for the close to 1.5 months period now. And I would just point out that this is a seasonal recovery as well. So long steel typically tends to get used more in construction businesses, and therefore during the monsoon months we usually see a decline starting from mid of May towards July, and then a seasonal recovery starting from sometime in August till November. So there was a sharp decline which had happened between this period, this time as well, about a 12,000 per ton fall. we are largely seeing a retracement of that, with almost a jump of 6,500 having happened broadly in the last 1 month. So currently, the rebar pricing is at 54,500. But just to remind everyone, like this was actually close to 58, 59,000 in like April, before it started declining to 48,000 in July. So there could be some more hikes on the way.
Okay, got that, Amit. Thanks for putting that into context. Why is this happening, though? I think some of the mills will be shutting down. That could be one of the reasons. What else?
So yeah, like in July, early July, I would say prices had fallen to a level wherein some high-cost mills started to kind of make losses. And I think that forced a seasonal shutdown being taken by quite a few of them. With supply tightening up, I think that supported some improvement in pricing levels. And now we are seeing that kind of getting reinforced through better restocking activity by dealers. Typically, dealers tend to destock when pricing is declining, and they restock when price starts improving. So we are seeing that cycle kind of fueling the recent second level rally, and probably as the monsoon gets over and demand actually picks up, let's say from September onwards, I think there could be more support to pricing. Also, another important factor is that the coking coal cost have also been moving up. In the last 1 month, it is up almost 20%. And that's because China is back in the coking coal, seaborne coking coal import market. Locally, their mines are currently facing disruptions because of the inspections and a mining disaster which happened back in June. So they're also kind of, there's a cost support to the pricing as well.
Okay, but for the Indian companies then, part of that pricing high gains will be offset, right? Because we are net importers of coking coal. How do you read that?
Yeah, so all of this hike will not translate into margins. I think partially, like I would say, maybe if I do a rough math, and maybe 70% of it could still reflect into margins. But typically, Indian mills tend to blend the high premium coking coal with PCI and other coal as well. So to some extent, some local coal as well. So the blended cost tends to be a bit lower than the premium coal. So there will be definitely some increase in cost, but more in the third quarter than in the second quarter. And that will still on a net basis would be positive for spreads as price hikes are more.
Okay, all right. That said, what is the difference currently between longs as well as flats? I recall that after that 12,000 rupee correction that we saw in long prices, the difference between long and HRC, I think, had gone to around 11,000 odd, which is, not something that we normally see. Currently, what is the difference? Do you expect it to narrow further?
So the difference now is about 5,000. So I don't think it will narrow too much from here, also because it's important to note that the flat steel has a 11.5% safeguard duty, which is not available to long steel. So to that extent, there is a gap which is in a way justified, like almost a 10% gap which is justified through the safeguard duty. But mind you, even the HRC is actually moving up now because of the cost inflation. So and Chinese spreads are back to like 3-4 year lows at about $85 per ton or so. So it is possible that the Chinese steel price may also start inching up because of cost pressures, which could provide a further support to domestic HRC.
Correct. When Chinese players get into trouble, that's potentially a very, very good news, because that means they can't dump more and they can't cut prices from there. So to increase their spreads, the probability of them hiking prices is large. Before we let you go, Amit, tell us your top picks. If we look at it, the big trading bounce actually has come in sale. From 165, 170 bucks has become 195 rupees. What is your picks as of now? How would you approach the sector? I think you're reasonably more optimistic on JSW Steel, which has been a good executor, and they'll have volume growth as well going ahead.
So in order to play long steel, we prefer Jindal Steel over SAIL. We feel that Jindal Steel has more legs or drivers beyond just the long pricing. There is volume growth, reasonably strong volume growth as well as some cost reduction, margin improvement measures, which will play out over the next 12 to 18 months. SAIL, on the other hand, I would say could get impacted by the upcoming wage revisions as well as the lack of volume growth over the next broadly 3 to 4 year period. And after the recent rally, we actually don't find valuations too supportive in sales. So we would clearly prefer Jindal Steel to play longs, and our structural pick is JSW Steel, which we believe will continue to execute the best in the sector with the 10% plus volume CAGR over 4-5 years.
Always good to speak to you, Amit, making sense of what's going on in the entire sector, the space as well. Thanks a lot for joining in, Amit. Explains why some of these long steel producers actually, just in the recent past, have actually outperformed, particularly on stock prices. Whether you look at Jindal Steel or even SAIL, if you pull up a last 1 month chart, let's do that of SAIL as well as JSW Steel. Well, it'll tell you that actually SAIL has outperformed what JSW Steel has done. And one of the reasons really is because of the higher exposure to longs that SAIL has. And obviously, it had got badly beaten down as well. Well, we'll take a short break, come back. We'll continue our focus on the markets. Stay with us.
Welcome back. You're watching us here on Chartbusters. Let's get you an interaction that we had with Mahindra's Last Mile Mobility's Uman Mishra on the company's growth trajectory, the IPO plans, and a lot more. Our colleague Sudarshan spoke to her.
I think the fundamental thing that we are very excited about is that today this L5 category has crossed more than 40% electrification. Okay, and this is on the back of TCO, is the back on the policies, the supplier, the OEM landscape, etc. So for a category that has crossed 40% electrification in just about 4 years, and it's fast reaching 50%. I think the medium term and the long term targets have to be set with assuming 80% electrification. So I think that it's fair to say that we are looking at an acceleration in the electrification trajectory. And within the next 3 years, I'm expecting that, like say 2030, it should reach 75 to 80% electric, which means we are looking at a doubling of the industry, as well as, I would say, our capacities, our performance, etc.
So you continue to hold the leadership position in the three-wheeler segment. What about the cargo segment? In that segment, what would be your market share, and exactly where do you see the electrification, considering the push that we are seeing from government and all the regulatory bodies, but still the penetration is in the range of 13 to 14%, if I'm correct. So where do you see the penetration, especially in the cargo segment, increasing to over the next 3 to 4 years?
Okay, so in the cargo segment, we can separate the three-wheelers cargo from the four-wheelers cargo. The three-wheeler cargo is around 20% electrification, and we are market leader in that space. So I expect that by 2030 to at least reach 50%. And this is on the back of a lot of the trend is accelerating, but also a lot of innovative products are coming into the market. So that should help accelerate the trend. And government policy, as you mentioned, mandates electrification in this category as well. Now, on the cargo four-wheeler side, this is what you said is 13, 14%. It's a little slow to electrify. So it would be great if in the next 3-4 years, it reaches 30% electrification, right? So there, obviously, we are just participating in the place, and currently we are either the second or third player. And there I see a huge opportunity for expansion for us as a last mile mobility player. We intend to bring a large number of products and innovative solutions across all our categories, but with a particular focus on cargo.
So by the end of FY26, your gross turnover was around 4,800 crore. So by the end of this fiscal, where exactly this would be, and also what would be bottom line and EBITDA margin?
We have seen a phenomenal growth, right? So we have almost more than 50% year-on-year growth already we are clocking. So that should give us a good, upside. Let's see, because there was, as you know, currently everyone is seeing a wave of electrification because of the crisis of fuel. So this electrification wave, if it continues through the end of the year, we are certainly going to see very healthy growth. As terms of margins, what we have to understand is that currently there is a lot of government subsidies in the mix, which makes the margins a little up and down because there is PLI subsidy. Last year there was demand side incentive. So when we are okay to reveal all the detailed financials, I think you will see that there is a healthy margin improvement on a year-on-year basis for us, even without the subsidies.
So I cannot let you go without asking one question related to IPO. I understand that, and last time when we were talking to Anish Shah and several other people from Mahindra Group, we were expecting IPO for Mahindra Last Mile Mobility to come in 2027. How much time it's away?
Yeah, I think we are still working towards the same timeline, but I want to say like broadly 12 to 18 months. The exact, Anish, as he has clearly mentioned, that the exact timing will be subject to the market situation, to our own evolution. Where are we in terms of growth, profitability, trajectory, etc. And we have very, very patient investors. So I don't see there is any real pressure to do it in a certain day or time, but we will do it when it's the right time. And we're still working towards the same, let's say, the 27 or FY28, let's say this type of time frame.
Okay, all right. Well, time to wrap up on this edition of Chartbusters. Stay with us. The team of Trading Hour is waiting by.
Morning, you're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu, with me Ritu Singh. And as always, the market's been actually, fairly consolidatory right now as we speak. It's sold off a little more. The Nifty is hovering around the 24,150 mark at the lower end of today's trading range. And we've seen far more number of stocks decline than the number of stocks which are advancing. The problem pocket today, along with the IT pack, is that the Nifty Bank isn't holding up. The PSU banks are lower. And alongside that, we have in the private sector, HDFC Bank, which is putting the Nifty Bank lower as well. So that index currently at the low point of trade, hovering between the 20 and the 50-day moving average support zone. We have the Nifty, which is around 24,150. Hi, Ritu.
Hi, good morning, Mangalam. Lower volatile moves, range-bound moves in the market today. That continues. Like you said, for the Nifty, the drag is coming from various pockets. IT, of course, is one of them. The PSU banks have been the big drag. And the mid-cap and the small-cap index is also not holding up in trade today. So if you look at the broader markets, the mid-cap index is trading with cuts of about 62 points. And the small-cap index is also down in the red, trading with cuts of about 37 points as we speak. The advanced decline ratio will also show you those lines that had crossed in the morning have stayed far away. You have about 1880 stocks that are on the decline versus about 1200 that are advancing. Sectorally, pharma as a pack is doing relatively better. There's some buying there. Realty energy is flattish, but what's under pressure is the media pack as well as the auto pack. In the media pack, PVR, Saregama, all of those names are down in trade today. The metal index is also seeing some selling pressure, as is, of course, the IT index. But let's, as always, put the spotlight on the individual movers and shakers in the market. Let's go back across to Mangalam for that one.
Well, typically we start with a bunch of gainers today because of the advanced decline ratio and the market's mood. Let's start with some of the top losers today. We do have Tata Power, obviously, the arbitration not going their way, so that stock down about 4.5–5%. Manappuram, Muthoot, the gold financiers also lower by about 2.5 to 4% each. PFC from the power pack, and we'll talk a little about the power pack in just a bit as well. KFin is the other one which is lower. But among the F&O gainers, we do have BHEL, some of these power equipment makers, the likes of CG Power, Hitachi Energy, HFCL, all of them higher in today's trading session, bucking the trend. One corporate group in particular, which is doing extremely well today, is the Wadia Group. Don't know the reason why so far, but Bombay Burma up around 14%. This is the holding company. Then you have Bombay Dyeing, which is up 7% as well. National Peroxide, another of those group companies, up by about 5–5.5% as well. Can't say the same for Britannia. But other gainers in the broader markets do include, with a lot of volumes, the likes of Imagica World, which is up around 18% with 2 crore shares trading. Travel Food Services, we had the management earlier this week on our channel saying that the business looks good for them. 25 to 30% growth is where they expect to come back to in the second half of this year. Bodal Chemicals up 5%. Some traction in RR Kabel, Roselle India for this week, taking their gains to about 15%. HCC and NMDC Steel are the others which are gaining about 6 to 7% as well. So a bunch of stocks which are buzzing around in today's trading session, some with a lot of volumes, but more on the way down. But the name that I spoke about first was Tata Power. That's in focus among the top losers after losing a near $500 million arbitration challenge in Singapore. Vivek joins in with more.
Well, that's right. So Tata Power, one of the top drags as far as today's session is concerned, is on the back of the fact that the company updated the exchanges that yesterday the company actually went ahead and lost a court case. This is in Singapore International Commercial Court. So they ruled in favor of the entity that the company, that Tata Power was fighting against, and the name of the entity is Kleros Capital Partners. A bit of a background to this particular case: Tata Power as well as Kleros Capital Partners had joined hands and had bid jointly for a Russian coal mine in 2013. Post which, a lot of disputes arose, and this particular development or this particular case has been going on for quite some time now. Earlier, the court had gone ahead and given Kleros an arbitration claim awarded to it of $490 million, which Tata Power had challenged. Yesterday, however, Tata Power lost this particular challenge, and they are expected to pay this particular arbitration amount along with interest. But Tata Power continues to have 28 days to go ahead and further file, this particular decision. They can file an appeal against this decision to Singapore Court of Appeal. This will be done within 28 days. And we spoke to the management earlier today. They said that they intend to go ahead and file this particular case. Important to note that most likely, even if they do have to pay this particular claim, it will not be done in one go. It will be done in several tranches.
All right, Vivek, thanks very much for putting perspective, onto that story. But let's move on, and you have United States that's tightening curbs on foreign-made grid equipment in what analysts are seeing as a likely China-focused move. But could this give, Indian equipment makers with U.S. exposure a competitive edge? Let's take stock and bring in Vinny Motiwala to help put things into perspective.
Hi, thanks so much for that. So we've seen this executive order that's signed by President Trump this morning. Mainly, this is a national emergency declaration that is what is signed by the U.S. to restrict U.S. purchase and imports of certain foreign-made power grid equipment. So these power grid equipments mainly they're worried about a lot of Chinese players entering the market. So this is what analysts are highlighting, that, this is primarily for the China crackdown that is spanning across transformers, generators, BESS systems, and you have grid-connected inverters, turbines, all of that is there, including some software solution in key industries like data center, defense manufacturing, and grid infrastructure. So mainly to crack that down, this seems like an order that is passed on this front. We're awaiting more details in terms of who are these vendors who are included, what is the equipments that are included as well. So we'll wait out for those details. But as of now, there's not a negative impact that comes in for Indian players. This is in fact a positive update that comes in for them, because now the companies with US exposure maybe could further increase their exposure there as well. And in fact, this is much more positive for companies, whether you look at GE Vernova T&D, Hitachi Energy, CG Power, TD Power, Apar Industries among some of the first movers who will be actually seeing some bit of an advantage if this goes through, and believe exports from India will start facing now less competition. So that is why we're seeing all these stocks that are buzzing in the trading session today on the back of this news flow. As of now, a big positive coming for these players.
Right, take that point. That explains why these stocks are a buzz in today's trading session. We'll probably get a conversation going with some of these power equipment players on our channel shortly as well. But good time to take a short break. Come back on the other side. We focus on the bond market. Manisha Gupta joins in with all the updates on the other side.
Welcome back. As promised, let's get you all of the action from the bond markets, and Manisha Gupta joins in to fill us in. Manisha.
Well, thank you so much for that. The government bond markets open slightly on the weaker side on the opening trades therein. This is as the traders place short bets ahead of the fresh supply of 6.94% 2036 bond at a weekly auction that is tomorrow on Friday. But there is some support coming in from the fact that you have seen the crude oil prices decline. Also, the U.S. Treasury yields have seen a bit of a calming down as well. But there's a lot of stuff that the street will watch out for. You have clarity on the US-Iran peace talks that the markets are looking for. It also is about tracking movement in the US Treasury yields, which are as of now factoring in heavy supply and inflation as well with the kind of numbers that we saw at US PCE numbers therein. And then it is the India's GDP data that comes in on Monday as well. So plenty to watch out for in the next few days therein. In the meanwhile, you have a long list yet again on the private bond issuances that are hitting the market today as well. You have Ergo Capital Limited, which is looking to raise 3.8 billion. And they're doing it via issuances of 5-year bonds maturing in August 2031. There also is Home First Finance into the markets today. They are looking to raise 1.5 billion, and they also have issuances of bonds which are maturing in 2031 yet again. Geo Credit Limited, a wholly owned subsidiary of Geo Financial Services Limited, is on Friday will raise nearly 20 billion, and they are doing it via issuances of bonds which are maturing in August 2029. It's a long list. Textile company Himmat Singha side is also on my list, and they are looking to raise 5.5 billion, and they're doing it via unsecured listed non-convertible debentures on private placement in one or more tranches. Therein is what their letter to exchanges says. And then you have Toyota Financial Services as well, and they're looking to raise nearly 1.9 billion. They're doing it via reissuances of 8.2% with bonds maturing in the next 5 years. Maple Infrastructure Trust also is on your screen. 7 billion is what they are looking to raise. And then REC Limited, of course, there's a lot of news going around for this state-owned company. They are looking to raise 60 billion, and they are doing it via issuances of 2 bonds with various different maturities.
Right, Manisha, thanks a lot for that. So those are some of the companies in focus on account of the bonds that they're issuing, and that's the bond market update coming in. But let's talk about the paint space, and it deserves to be spoken about, especially after the first quarter, because we're looking at numbers coming in from the second quarter, how demand has panned out, and at the same time volatility in raw material prices continue, even as these companies have actually turned a corner in the first quarter with regards to price growth doing well. And one of them that did exceptionally well was Indigo Paints, with a 20% revenue growth, 40% EBITDA growth, and a 60% net profit growth. It far outpaced the industry, and that's something that it's been doing for a while as well. So what we'll talk to them about are obviously the trial production at the Jodhpur plant, which is likely to be underway. We have demand and raw material uncertainty, how the company pans through that, and then obviously the growth that the company is projected in their construction chemicals business via Apple Chemi. We have Hemant Jalan, who is the MD of the company, who joins us now on the show. Thanks a lot, Mr. Jalan, for joining in. It's always a pleasure speaking with you. And, we're speaking towards the end of August, and that's exactly where the trial production in the Jodhpur plant was supposed to start. I wanted to know whether that started or not. And once that starts, what's the outlook here on the likely output this year?
So, yes, the trials have started, and as we speak, they are ongoing. We are waiting. I think within a week, we'll know whether there are any major bugs or snags in the equipments. Hopefully, there isn't. If so, then some output will be visible in another week or so coming out of the plant. I hope that by end of September, the plant would stabilize, which would be well in time to start taking care of our season demand in October when the pre-Diwali demand kicks in. So, yeah, fingers crossed. Hopefully all will go well.
Right, hopefully all will go well. How is all going right now? In fact, the second quarter, how's the momentum from the first quarter sustained? Has it increased? And raw material volatility still continues, right? So do we expect some sort of support here?
Well, raw material volatility is considerably less than what it was in Q1.
Got it.
There's some volatility, but not a whole lot. So I would say that prices have more or less stabilized, albeit at a level significantly higher than what they were before the Iran war started. But there doesn't seem to be too much of volatility in the last 2 months. So there is a lot more predictability. Availability of raw material is not a problem. As far as demand is concerned, I would say that the good scenario of Q1 seems to be carrying forward in Q2, so far at least, that there is good uptick in the demand. And doesn't seem to be too much of channel overstocking due to the price increases that happened in Q1. So we are seeing good lifting happening in Q2 as we speak. So hopefully Q2 would be similar to Q1, could be plus or minus a couple of percentage points in terms of top line growth. I can't predict because we still have another 5-6 weeks to go. September would be the main month. A lot would depend upon when the monsoon withdrawal starts. If the forecast is correct that there will be a weak September monsoon, then that may not augur well for agricultural production, but it would in the short term augur well for the paint industry as far as India is concerned.
Mr. Jalan, since you say there isn't much to speak of as far as raw material volatility is concerned, you've come close to 17% on margins, and then the second quarter you said will be similar, if not better, at least on the top line. For margins for the full year, if you could guide the street, what would they look like? Could there be a significant improvement from here on?
See, as far as Q2 is concerned, first of all, Q2 is the worst quarter for the paint industry in terms of margins because the product mix deteriorates. During the monsoon months, exterior painting comes to a halt. And those are some of the more profitable paint items that the industry sells. So both gross margins and EBITDA margins will take a hit in Q2, all other things being equal. The other thing is that there was a lot of high-priced purchasing that happened in Q1. Most of that raw material will get expensed out into the P&L in Q2. So I would expect overall margins to be lower in Q2 compared to Q1. I think the way to look at margins would be to look at the 6-month total from April till September, rather than taking Q1 as a guide, which may have been a bit of a roller coaster because raw materials were going through the roof, pricing was going through the roof. So all depends upon who bought what at what prices. And therefore, I think that Q1 margins and Q1 EBITDAs are not going to be very indicative of what the future bodes. So I would really look at 6 months combined. And overall, as far as the year is concerned, I would expect margins to be pretty similar to what they were last year.
Got that. Mr. Jalan, you've spoken about increasing your focus on wood coatings. New products are expected by September. Is that still on track? And what would be the contribution from that to your business in terms of your top line and bottom line?
In general, wood coatings do contribute 8 to 10% of the top line for some of the larger paint players. For us, the contribution is much less. It's been somewhere around 3 to 4%. That is because we did not have the full portfolio of products to offer as far as wood coatings is concerned. We were dealing more with the entry-level products. So we are expanding our offering to cover the entire gamut of wood coatings. We have recruited an entirely separate sales force in about 5 or 6 states, which are some of the larger wood coating consuming states in India. And these products are going to start getting rolled out from second half of September and will continue into October and November in a phased manner. And we don't have any numbers, guidance to say as to what kind of turnover share they will occupy. It will take some time because it's not an easy sector to get into. You have to work with a different set of influencers, which are the wood polishers, and against a very stiff competition. So I would wait for 6 months after the launch, see how the launch goes, how well the products are received in the market, before giving some kind of a forward guidance as to how much the wood coating is likely to exactly contribute to our top line going forward.
Right, take that point. Just a last question quickly before we let you go. Sir, Apple Chemie, It obviously has been a strong growth driver for the company. You've gone ahead and increased your stake here as well. What is the road to further stake increase out here? Is there a call option that you have on the value at which you can increase it? What's the plan? And also free cash flow. You said you are likely to generate more of it over the next few years as majority capex is behind. If you could give us a number over the next 3 years, say what would the free cash flow generation be? So on Apple Chemi and free cash flow generation, sir.
So I'll first finish with the free cash flow part. So we have been averaging a PAT of around 150 crores or thereabouts. Add to that a depreciation of another 50 crores or thereabout. So the cash generation in the company has been roughly 200 crores, minus the capex that has been going on for the last several years. Now that capex comes to an end. So the only capex going forward of a significant nature are the tinting machines, which is not more than 40 crores a year. So I think we do look at a free cash flow of more than 160, 170 crores a year going forward for the next 3 years at least, probably increasing with every successive year. So that's as far as the free cash flow goes. The second part about Apple Chemi that is concerned, Apple Chemi has been growing very well. As far as our stake is concerned, we did have a call option to buy up to the 100% if we wanted to at this stage. We don't want to do that because the promoters, we want them to remain invested in the company, to run the company. So after mutual discussion, what we have reached at is that we are going to be acquiring another 11% stake. And after which both the call options and the put options will be done away with going forward.
Oh, that'll be very interesting. We'll monitor how this goes along because in case you want to buy the whole thing, will that be at a much higher valuation than you earlier anticipated or not?
I'm not interested in buying the whole thing because we don't want to run a B2B business. So we are happy with the promoters, the way they are running it, and we want them to remain invested in the business.
All right, take that point. Thank you so much for joining in. Incredible conversation. Always a pleasure speaking with you, Mr. Jalan. We take a short break, come back on the other side. Saumil Mehta joining in with Market Technicals.
Welcome back. Let's get you details on this insolvency case that is bound to grab a lot of eyeballs simply because of the extraordinarily bad outcome, a shocking outcome for the lenders, where the National Company Law Tribunal has now approved a repayment plan for Z Group founder and chairman Subhash Chandra, under which creditors are going to receive only 6.5 crore rupees against the admitted claims of more than 22,000 crore rupees. Now, that amounts to a haircut of 99.97% for the lenders involved. Now, the case goes back to this 170 crore rupee loan that was given to Vivek Infracon, for which Subhash Chandra had given a personal guarantee. So when the loan was not repaid, Indiabulls Housing Finance, which is now called Samman Capital, had moved against Subhash Chandra in 2022, with the NCLT finally admitting that case in April of 2024. Now, cut to now, the repayment plan that has been approved by NCLT involves creditors recovering only 0.03%. Now, it's interesting that the plan had already received approval from lenders with 80.8% voting support in November of 2024, but there were several large lenders, LIC Housing, HDFC, Axis, Canara, RBL, Union, that had objected to this, and they had argued that 5 entities that held or controlled almost 62% of the voting share were linked to Subhash Chandra. But now the NCLT has rejected all of these allegations that creditor voting was skewed by entities that were allegedly associated with Subhash Chandra, and they've sided with the approval of the plan, saying dissenting creditors are unlikely to recover any more by rejecting the plan. Now, creditors has also interestingly questioned how Subhash Chandra's net worth could have fallen so sharply. I mean, his certified net worth was around 45,888 crore rupees in 2017 versus the latest disclosed net worth of about 31.8 crore rupees only. Again here, the NCLT said that the historical net worth figures by themselves don't really establish any concealment or diversion of assets. So now the matter goes back to the original NCLT bench for formal orders to be pronounced, but for the lenders, it is an extraordinary outcome. 99.97% haircut means creditors are recovering virtually nothing against the claims that were admitted in the process.
All right, we'll take that point.
Well, let's bring in...
All right. Thank you for putting that to light. We'll go to Saumil Mehta from here now. Just get a quick call on indices and individual stocks. Saumil?
Good morning to everyone. Markets are again back in the range. We saw a very good move, 3 trading sessions back, taking again resistance around 200 daily exponential moving average, which is around 24,400, 24,370 to be exact. Now we again slided down below 40 daily moving average, which was a very crucial support. We are headed towards 24,100 again, which was the previous swing low, and 24,000 is a very crucial support as well in the very short term. So short term remains very cautious stance for me here, as it has taken resistance at crucial levels and again started sliding down below the averages. In the medium term, still the view remains positive as we are making higher lows from 22,200 to 23,000, from 23,000 to 23,600. So these are higher lows. However, in the very short term, we've seen a little bit of correction. I think the sideways correction will still continue. However, there are pockets which are doing really good, like defense, pharma, a little bit. Metals are doing good. So there are pockets where I think there are still opportunities, and we should focus on those opportunities right now. At this point of time, I have 2 stocks in my radar. First one is Amber. Amber has broken out of an ending diagonal pattern, trading about 20, 40, 200 daily moving average. Great setup. And I think this is a medium-term reversal from here because the previous weekly swing high has also broken on the upside. So my target on the upside for Amber is around 8,200 and my stop loss is 7,340. The other stock is a little risky bet from the IT pack, which is Kotak Mahindra. Kotak Mahindra is already in the uptrend in the medium term, trading above the averages, has taken support at 40 daily moving average and the lower end of the Bollinger Band. And I think from here, again, a new move starts. Stop loss would be 1550 and my target would be 1690.
Well, Saumil, thanks very much for joining in with that. Pleasure as always having you on the show. Slip into a short break on that note, but up next, we're going to discuss market fundamentals with Sunny Agarwal from SBS Securities. Stay tuned.
Welcome back. You're watching us here on Trading Hour, and let's take a look at the F&O setup right now. The market's been fairly volatile and it's choppy, but as we speak, there is some recovery that we've seen, especially on the mid-cap end of things. The mid-cap index has moved marginally into the green, and the Nifty too is down about 50 points, but hovering around the 24,150 mark. If you look at the India VIX as well and the broader market index, you will see way more number of stocks declining than the number of stocks which are advancing, and the Nifty is perilously close to its 50-day moving average. The support for the Nifty comes below that 24,000 mark, just around 23,992, which is the 100-day moving average. So those two levels on the Nifty extremely crucial. Crossing 24,200 will be very important on a closing basis. The Nifty Bank, 50-day moving average and the 20-day moving averages are about 70-80 points below where it is right now. So that's a crucial support zone for that index as well. For the Nifty, while it's hovering around the 24,150 mark, we are seeing a lot of writing at the 24,200 call, and the 24,150 call and the 24,150 put, both of them equally active, have created a bit of an envelope around this range for the frontline index. Around 24,050 is where you're expecting support, and above 24,250 is where you're expecting some sort of resistance. So that's about the F&O's setup, Ritu.
All right, Mangalam, thanks very much for bringing us that update, which sets us up very nicely to bring in our next guest. Sunny Agarwal from SBI Securities is with us now to discuss market fundamentals and his outlook. Sunny, thanks very much for being here. Let me just start with the news that came in on HDFC Bank this morning. Private sector lender that's virtually given shareholders no returns, and now this new lawsuit has come into the picture. Broadly speaking, with all the developments that are happening, in these large cap lenders versus some of the mid cap names, where there's more activity in terms of deals that are probably, taking shape. Where would you bet your money, or is it still safer with the PSU pack?
Good morning, Ritu. Good morning, Mangalam, and thanks for having me on the show. I think, yes, what we have seen is that tier one lender or large private banks are going through one or other challenges, and that is the reason we are seeing that valuations are at a multi-year low for all the private sector banks, including HDFC Bank. Obviously, ICICI Bank has been an outlier where we have seen a consistency in terms of performance as far as net interest margins or growth is concerned. So obviously at current juncture, seems that mid-size private sector banks like Crude, Federal, DCB, Cub, where we feel that valuations are comfortable, relatively growth is slightly ahead of the large private peers. So there, to generate an extra alpha, obviously investors need to focus on such set of banks. And having said that, even among the PSU bank, there are few outliers where we have seen a consistent performance delivery when it comes to banks like Indian Bank or for that matter, Bank of Maharashtra. So I think we can choose is a way to participate in the banking story. And having said that, at a broader level, we feel that with an mobilization of STNR deposit and with a likely stability in the ensuing quarter on the net interest margin front, ultimately banking sector, we should see that the profit growth should start getting in line with an balance sheet growth. So what we have seen is that despite of very robust balance sheet growth or advances growth, the profit growth has been struggling because of the pressure on NIM or focus on a low yielding corporate book. So I think as the focus shift towards the retail book and as the NIM stabilizes, I think earnings should also catch up. So I think again, the right way to participate is through mid-tier private sector bank and selective public sector banks.
Sunny, any view on these power equipment names? With this news coming in that the US has restricted imports and purchases of foreign-made power grid equipment, which some are seeing as, against China and in favor of India. What are your thoughts?
I think, yes, definitely seems this development augurs well for domestic players like GE, Vernova, T&D, or for that matter, any other power ancillary player. But let's see, how this development plays out. Irrespective of that, what we feel is that the opportunity, even on the domestic power ancillary or power sector side is humongous. So we all know that we are targeting 500 gigawatt of power capacity by 2030. And that too, majority will be contributed from the renewable side. So power ancillary obviously will be the key beneficiary, and the right way to play through is obviously through transformer players, and at the same time wires and cables, which have been consistently delivering very robust volume as well as price growth. So companies like Polycab, where we feel that there is still a lot of potential to create a wealth out of that. Transformer companies, so mid-sized transformers companies are moving up the value chain, so that will help them command a better margin. So companies like Atlanta, or for that matter, CG Power, Siemens Energy. So I think the entire power sector, in fact, power ancillary is very well placed to deliver an sustainable earning growth over the period of next 2 to 3 years.
Right. Sunny, it's difficult in this market to pick one particular theme, and a lot of the experts that we've been speaking to, they're saying it's more of a bottom-up sort of market approach, especially in the mid and small cap space. Are there any 3 or 4 more ideas that you can leave us with, ones that you're extremely bullish on?
Yeah, definitely, Mangalam. I think, again, we continue to remain bullish on auto ancillary pack. So we all know that auto OEM has been reporting very strong set of volume growth. But auto ancillary, we are seeing that obviously the benefit of domestic growth and at the same time export market, and then venturing into an adjacent sector like defense aerospace is helping them to deliver a better sustainable growth. So few names which come to my mind is Precall, where we have already seen that both the vertical DICV as well as FMS has delivered a 25% growth during the Q1, and they have already announced a demerger of both the vertical. So we are hopeful that the DICV vertical will have some a marquee investor which will be coming in that will help the company to take the growth to the next level. Another pick from the auto ancillary is the Lumax Auto, where we have seen that on the back of a robust volume growth for M&M and Bajaj, especially for Chetak, the company has been consistently delivering a solid earning growth. And on the CNG side, because of onboarding of Maruti because of green sale acquisition, that is another trigger where we feel Lumax Auto, so our fair value of the business there is 2,700. Among the structural steel tube pipe, recently we have initiated coverage on one smaller name, which is the JTL Industry, wherein the company is going to double its capacity from 0.9 million ton to 1.8 million ton, and the value added share mix is likely to move from 22% to 56%. So JTL Industry, our fair value estimate is 127, keeping in mind the 10 rupees has been allocated to the its defense vertical, wherein the company holds the majority of the stake. And among the auto and another Sandhar Technology, another IC which we have initiated. So company has been going through trouble, but now what we feel is that the sheet metal business and yeah.
Wonderful. Thank you so much, Sunny. You've given us a lot of ideas to work with and look at as well, and our viewers as well will obviously keep tracking these. Thank you for joining in. With that, we'll take a short break, come back, more on the markets on the other side. Welcome back. You're watching us here on Trading Hour. Earlier, we spoke with Harish Krishnan, who's the CIO equity at AB Sun Life AMC. He remains cautious on the capital markets, defense and capital goods theme, while sees opportunities in new age companies and chemicals, as well as select auto ancillaries. Listen in.
Three areas that I think where we are a bit hesitant to commit more capital towards. Those three areas, to my mind, are one is capital markets, the area that we are all in. Of course, we are all very big beneficiaries of the same. There is financial penetration, all of those possibilities ahead. But there is just way too much of supply of paper. And over the course of the last 5 years, profit pools have gone up almost 20x, which meant that there is a whole host of competition coming our way as far as capital markets is concerned. The second area where I think we are a bit hesitant in deploying more capital is in defense. That's again a space which, for all the right reasons, ordering has kind of come through. Given the nature of government being the largest paymaster out here, we do think that working capital is significantly stretched as a whole. So while near-term growth is good, we are a bit wary of very high working capital and therefore this requiring significant amount of dilution. This is very similar to what railways was, say, about 18-24 months. And therefore, that's again an area where we are not wanting to commit capital towards. The third is, of course, the capital goods space, especially those that are large beneficiaries of the AI trade. And of course, it is something where which has taken the world by storm. The good to great is basically essentially picking up companies which have significant market share, which are gaining market share, which are doing things differently. And in every sector, we do see maybe 5-7% of companies which are doing things very, very differently. And those are the areas that we want to allocate disproportionate capital towards. So I think one call out that we have been as in new age businesses. That's a segment which, if you look at from a 3-year perspective, hasn't done that well. Of course, from a 5-year perspective, a lot of wealth has been created. But that's an area where, if you think about it, many of these are entrenched leaders in their particular categories. They are the categories in many of the cases.
All right, take a short break on that note, but we'll get you more on the markets and macros in just a bit when we return. Mac, let's get you a quick check on how the macros are stacked up. Crude oil prices extending their losses today, down for now a fourth consecutive session. That's being driven by signs of some sort of diplomatic progress in West Asia. So crude prices have eased roughly 0.85% as we speak, trading at around $87 per barrel. The rupee opened weaker today. It then recovered slightly thanks to lower oil prices, but has since slipped further, and it is now at 95.52 odd against the greenback, an 11 odd basis point depreciation that we've seen in trade today. Meanwhile, the 10-year government security GSEC yields are trading around 6.86 odd percent, which is about 2 basis points higher than yesterday's close, and they've remained in this steady, narrow range for the last several trading sessions. So that's a macro setup, Manglam.
Indeed, Ritu, thanks a lot for that. What we'll do is, on that note, take your leave on this edition of Trading Hour. You stay tuned. We have Ritu, me, and the market in the middle. Signing off. On the other side, the team of Halftime Report.
Stocks trade soft ahead of the F&O expiry on the BSE, even as global cues remain mixed. Pharma and consumer durables see some green, while IT and FMCG trade in the red.
HDFC Bank's troubles don't seem to go away, even as the street thought its recent troubles were behind. A suit filed by an investor in the US puts the MSRDC issue back on the table. HDFC Bank says it'll vigorously defend itself.
Well, and the Singapore International Court has dismissed Tata Power's challenge of a $490 million arbitration award to investment firm Kleros Partners. Tata Power says it will appeal against the verdict, but the stock takes a bit of a dip.
In a new national emergency declaration, US is restricting imports of gear for power grids. Analysts say that the move, targeted mostly at China, will reduce competition for Indian exports. Stocks of power gear makers rally. Hello, good afternoon. You've tuned into Halftime Report coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny. Along with me is my colleague Nigel as well. Nigel, a very good afternoon. And again, a muted day of trade that is coming in for the markets, down 0.2%. Broader end of the markets too, not doing well in trading.
Lackluster, to say the least, Vinny, but we've got an entire show of HDR ahead of us, 12 to 1. And I'm happy to be on the show after a while. So let's tell our viewers what we've got lined up first on the show, and then we get straight to the action.
Absolutely. So on the show, we'll talk about US tightening its grip on critical foreign-made power equipment that could put Indian grid equipment companies in a sweet spot. We'll discuss all of this with Renu Betpugalia of IIFL Institutional Equities. Then we'll connect with the management of TD Power Systems to talk about all of this, as well as the outlook of the company going forward. They're raising funds as well. What is the rationale behind that? We'll discuss all of that. We'll be focusing on stocks that are moving around in the trading session today. Stay tuned in for that. And in the commodities corner side, we'll have Philip Newman, who is of Metal Focus, and they will join in to discuss the sharp surge in precious metals. Stay tuned in for that as well. But let's go across first up to Renu Betpugalia, who is joining us from IIFL Institutional Equities, and we're discussing US President Donald Trump's declaration and the executive order that he's passed for these equipment players, foreign-made equipment players, to export to their country as well. So what does it mean for Indian grid equipment players? Are they in a sweet spot? Who's going to be benefiting from all of this? Renu, afternoon. Thank you so much for joining us on the show. You know, this executive order that has been passed this morning, this is more focused towards Chinese companies, right? So from the Indian point of view, who will actually see the benefit of this, and when can we expect to start seeing this benefit now?
Well, if you look at the declaration order, it seems to be on lines of what Europe had done for solar inverter components and electronic parts. India also, post the Galwan war, if we see post the pandemic, had implemented restrictions on Chinese imports. So while this executive order doesn't specifically mention China, but this is implicit for Chinese vendors here. So this would impact the entire grid equipment value chain, where there have been relative presence of the Chinese vendors. Indian vendors' presence is still relatively limited, but they will definitely benefit with the 10-15% space which would be vacated by the Chinese vendors in forthcoming orders. So clearly we see in terms of beneficiaries, the transformer manufacturers who are in a long lead time as an equipment supply in the US tend to be the first run of beneficiaries. CG Power already has orders from there. Siemens Energy also has some orders. And recently we had seen GE Vernova management also mentioning of some orders for the US data centers, which were under discussion as part of the RPT approvals which they had taken. So we definitely see these companies benefiting, and the other components on the grid equipment side, which follows on cables, conductors. So players like APAR, Polycab should also benefit out of it.
And overall, all these are beneficiaries, but which are your top picks in all of this? Well, which one should the companies look at? And does TD Power also get some bit of a benefit from this one? They have exposures, but obviously they are more into turbines and all. So do they also benefit?
TD Power is more on the cogen part of the business, that too servicing on utility as well as the data center part of the market. So they technically are not direct beneficiary of the grid equipment restriction which the government is placing. And on the cogen side, you not just have TD Power, you have companies like Thermax and even companies like MTAR through Bloom, who has been participating on the cogen market on the US data center part of the story. So technically, this restriction is on grid equipments, and these companies are part of the cogen value chain and not the grid equipment value chain.
Okay, Renu, thank you so much for joining us for this quick take on what it means for Indian power equipment players and who will benefit from this as well. So thanks so much for joining in this afternoon, Renu. But on that note, we're going to slip into a very short break. After the break, we'll connect with the management of TD Power Systems as the company has approved raising of around 675 crore rupees. We'll talk about the outlook of the company as well as what the US executive order means for them. Stay tuned for all of that.
Welcome back. You're tuned in to Halftime Report. Well, as promised, let's get the management of TD Power Systems, who's joining in on the show. We have with us Mr. Nikhil Kumar, the MD of the company, and we should get the three focal points that we're going to be focusing on the screen. 365 crores of fundraise is what they're looking at. Why they're doing that? The order book, what's the inflow looking like? And what's the guidance after multiple upgrades to that guidance? Well, Nikhil, it's been a while since we chatted. Good to have you on the show. I was just telling my colleague Vinny that close to around 9 years or so ago, we are at CNBC TV18 explained the company. I think the market capitalization was around 700 crores, 650, 700 crores, and you had 200 crores of cash in books. Well, close to 9 years later, the market capitalization is 23,000 crores. And in fact, you still have some cash in your books. So kudos to you and the team with regard to execution.
Thank you.
Well, Nikhil, we want to understand a few aspects now. You have cash in your books. You have put in some money as well. And now you're looking at a QIP. Tell us why exactly are you doing this? My gut is that, in fact, as of now, you're doing, the products that you're doing, the generators are around 45 MW approximately. And you're looking at being part of bigger generators is what I understand. So could you tell us, as of now, what is the product mix looking like? And with this fundraise, where do you think you're headed?
Okay, our existing product mix is actually, it goes up to 100 megawatt.
Okay.
And we have most of our business today coming in, let's say 99% of our business coming in products below 100 megawatt. And this is the sector which has given us a lot of growth and will continue to deliver growth for us into the future. Within that, below 100 megawatt, between 60 and 100 is where we are really now focusing more of our energy to become more established in this larger segment. and we'll be further upgrading our capacity and further upgrading our capabilities in this segment. But the big one for us right now is a recent deal that we have signed with a major multinational organization, and this we had made an announcement on the exchange for this. It's Siemens Energy Incorporated, and we'll be working with them on a build-to-print contract where we'll be making generators for them, exporting it back to them to the US market and then to other markets all over the world. This is going to require a significant amount of capital, and that's the main reason for us to go in for the QIP.
Nikhil, a few details. You're saying 99% of your business is sub 100 megawatt. But 60 to 100, I guess that proportion is less. So break it up for us.
And that's where we're going to be putting more efforts, correct.
How much of the current book is sub 60?
95%.
95%. Okay, so very small proportion is in that 60 to around 100, and you want to focus more on that. Now, since you're going to be looking
because the market between 60 and 100 is as large as the market below 60.
So the big potential for you then. Give us a few more details. The client that you're talking about, the global client, I'm guessing is Siemens. So what kind of a revenue potential could it bring to TD Power, say in the next few years? Point number one. And point number two is, post this fundraise, what is the total asset, what is the total turnover, the revenue potential for the company? Please go ahead.
Yeah, so there are fairly, I would say, strict confidentiality restrictions that we both have, both companies, Siemens Energy and TDPS have in this contract on disclosure. So I'm not going to be able to speak very freely on many of the aspects of our contract. All I can say is that there's the fundraise, the QIP is going to be actually a little bit lower than what we have taken an enabling resolution for. So it's going to be maybe in the region of maybe total fundraise could be region of around 500 crores. And one has to look at our historic sales to investment ratios and on that end, of course, this project is a little bit more capital intensive, so it may deliver a slightly lower sales output compared to the investment, but it's over a period of time, it's going to end up being at the same level. And based on that, one has to figure out, indirectly what is going to be the sales of this particular project.
Revenue potential of 4,000 crores, Nikhil. 4,000 crores of revenues, approximately 4,500 crores of peak revenue potential is possible post this 500 crores?
Beyond that, Nigel, for sure.
5,000 crores, give us the number. Potential, we're not asking about a guidance, we're saying what is the potential?
It's going to be good. I'm not saying no to what you're saying. That's all I can say. I'm not saying yes and I'm not saying.
Approximately, Mr. Kumar, what would it be? So above 5,000. Nigel has said 5,000. Could we expect it above that?
Yeah, you guys are pulling this out of me, but I'm not going to be able to confirm that.
We are in the vicinity. We are in the vicinity of around 5,000 crores. I think that's what Nikhil is telling us.
I think that if you look at the scale of the investment, right, and if you look at the historic return on capital that we have given and the sales to investment ratios, those numbers that you're talking about are not unrealistic. Okay. That's all I can say.
Okay, realistic numbers there. Then I can realistically expect that we could see one more upgrade coming in terms of your revenue target for FY26.
I want to say something. Sorry, say one last thing. This project is not going to happen overnight.
Right.
And the investment at the factory itself will take. We're building a brand new plant. It's going to take 2 years to build the factory. So we'll be ready somewhere June, July of middle calendar 28. And then the ramp up of production will take place another year after that. So we'll really start seeing meaningful results in this larger segment. And this segment that we're talking about with this multinational company is basically above 150 megawatts. So it's beyond our current product range. And we'll see big revenues jumps taking place in this product range somewhere around calendar 30. Okay. So it's not going to happen overnight, but the visibility and the order book of our partner in this goes well into the mid-30s. So they have a very long visibility of order book, and we're going to be a part of the supply chain.
Okay.
I think it's going to be a very exciting project for TDPS.
Absolutely. We'll watch out for that from calendar 2030. When you start seeing that benefit, that will also be key to watch out for. And July 2028 is when your plant will also come into action. Mr. Kumar, a couple of points then. Overall, you managed to raise the guidance for FY27, last 4-5 quarters. Again, how has the demand so far been, especially the motor side, which was facing a bit of an issue? Could you talk to us about that as well?
So we have been upgrading guidance simply because we give guidances only when we are 100% sure that we're going to be able to hit those numbers that we guide. We don't give a guidance and then we say, hey, you know what, we're going to be below that number. So we have been seeing a very positive trend in the order inflow, and there's also extraordinary demand coming from all parts of the market, not just the data centers, but it's also from grid stabilization, basic power generation, waste to heat energy. We're seeing demand coming from all sectors of the market. So we've been forced to, customer deliveries are really forcing us to make more machines within this year and also for next year, and therefore pushing up the sales, and therefore we push up the guidance. The order inflows are extremely strong. There's no let up, and right now we're in a very, very exciting period of growth in the organization.
Mr. Kumar, then could we expect, given Q2 so far, could we expect one more upgrade in terms of guidance in Q2 as well? How is that looking? Since you are seeing the trends and then giving us the guidance. So for revenue guidance as well as in terms of margins, you are at the upper end of your guidance. 19% is what you reported as well. You've spoken about 18 to 19%. Is this the peak margin also for the company, or could we see this improve over the next few quarters and next year as well?
The more operational leverage that we have, the better the margins are going to be. But I'm not going to commit that on the show that we're going to do better than 19. I have told my investors, and I continue to tell my investors, please expect a guaranteed 18 to 19% range. And of course, the management, we're trying to do as best as we can to push the numbers higher. But for the moment, I think the definite performance will be 18 to 19%.
Mr. Kumar, I believe in one of the con calls you had mentioned that, mainly there were some constraints going on with OEMs because your supply is related to their production and how that is moving. Has all of that, improved, or are there any still bottlenecks with the OEM side?
It takes a long time to set up engine manufacturing capability, gas engine manufacturing capability, or gas turbine manufacturing capability. It takes years. But we are seeing that our OEM customers are doubling their capacity. In some cases, they're also going in for 3 times the capacity increase. And we're a part of that supply chain. We will see those numbers gradually coming into production for them in 27, and then large scale increases will start taking place in 28 and 29. I'm talking calendar. And correspondingly, the forecast that we have been given to keep pace with their increases is also really exciting. So I have not yet given out the guidance for 28 and 29 yet, but it's if everything works out well, then we'll be here. As I said earlier, we're in really exciting times right now.
Okay. All right. Mr. Kumar, just one more thing. Data centers is the buzzword, right? How much of your order book is linked to that?
We don't give that specific number.
It's a rough idea at least. We'll do with a big range.
I don't think that's one number I'm not going to give, but it's an exciting part of the market. All I can say is that from the power generation side, I'm talking about equipment suppliers, none of us are putting all our eggs into that basket. And we're being prudent that we need to keep the other parts of the market also fully supplied, whether it's oil and gas, or whether it's power generation, basic power generation, or whether it is, renewable, whatever, waste to heat energy. We are making sure that other parts of the markets are also well supplied. And this is the strategy, I think, which is sound, and this is the strategy which is going to be going in, which is going to be fulfilled also in the future.
Mr. Kumar,
unfortunately, I can't give that number out to you, but it's the data center market is big.
Okay, Mr. Kumar, just one last quick one. For the year, then, could we expect a revenue of 2,800 to 2,900 crores? Is that an expectation now?
27 is what I have given as the guidance, and that will be 100% met. Any further upgrades if possible, I will call it out in November when we next have the earnings call.
So it's 2,700 crores of guidance, right, for this year?
That's right.
And a rough math tells me that in the next 3 years, if you have to go from approximately this 2,700 crores closer to around 5,000 crores by 2030, directionally, then you'll be compounding in terms of a CAGR on sales could be approximately 18 to around 20%. So we'll see how that goes. Mathematically, it appears like those are the numbers.
Absolutely, Nigel. But Mr. Kumar, thank you so much for joining us on the show, speaking with us about the outlook of the company as well, what we should watch out for, how are the trends shaping up. Thanks so much for that. On that note, we're going to step into a very short break. After the break, we'll have Hemant Kapadia of DR Choksi FinServ, who will join us to talk about trading strategies. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is at 24,140 levels, just holding on to that mark. Day's lowest point around that is what the Nifty 50 is trading at. Nifty Bank not doing well. Nifty IT is also not doing well in today's trading session. And in terms of sectors that are actually managing to hold on to some bit of a gain is pharma, realty, and some of these energy names are supporting the market right now. But apart from that, we're seeing most of the sectors trading in the red. On that note, let's go across to Vivek, who's here to tell us which are the stocks that are moving around in the trading session. Vivek, good afternoon.
Good afternoon. Thank you so much, for that. In terms of individual stocks and sectors that we are tracking, can't look beyond the entire capital goods, power equipment space. Some sentiment positive coming in as far as the US news flow is concerned. But on the back of that, have a look at some of the names today. BHEL up almost 4%, even although it has very limited exports. CG Power another 3% higher today. Apar Industry, LG, Verno, T&D, all of these stocks doing quite well in the session. The next group of stocks that are doing quite well is the entire Wadia group. Some relief coming in terms of Supreme Court observation regarding an earlier land issue, something that has led to quite a bit of a spike across the entire group. So Bombay Burma up almost 13% on very good volume. So that particular stock doing quite well. NMDC Steel, one of the top gainers on good volumes today. On the NSE 500 index, that particular stock high by over 8%. Pine Labs, again, this particular stock, Investec has initiated coverage on this particular stock with the buy rating. That particular stock cooled off a little bit, but still high by almost 2%. And steel, pipe and tube companies, so look at names like Welspun Corp, Jindal Saw, Ratnamani Metals, all of these stocks in the NSE 500 index, all of these stocks doing quite well. On the other hand, quite a few drags as well. The gold financiers, both the names taking quite a bit of a hit today. Both Muthoot as well as Manappuram among the top drags in the session today. Tata Power, one of the top drags, losing an arbitration case, a significant material setback. Will be interesting to see, whether they get any relief, once they appeal this particular case further. Lupin, a downgrade coming in from Citi on this particular name. That particular stock has recovered a little bit, but at one point of time was down almost 3%. And across the financial space, seeing quite a bit of selling pressure, especially in names like HDFC Bank, again hitting a fresh 52-week low. Shriram Finance seeing quite a bit of selling pressure emerge. And even SBI Cards, after a brief bounce that we saw in the last couple of trading sessions, that particular stock too today down.
Okay, all right. Thanks a lot for that, Vivek. Well, let's welcome Himen Kapadia, Technical Associate, DR Choksi FinServ, who joins us on the show. Hi, Himen. Good afternoon. Good day, actually. Good to see you, Ben. I think after a while, we're connecting more frequently. What's the view then on the index? The Nifty is a little bit lower, but you have to stay still in the range. So your take.
A very good afternoon, Nigel. Pleasure to see you. Thank you for having me on the show. Yes, nice to connect after a long time. More frequent. I hope my green color shirt inspires the market to do better. But frankly speaking, if you see for the last some 20, 21 trading sessions, Nigel, we've gone nowhere. And the VIX continues to remain docile. Normally, you would expect the market to do contrary of what the VIX does. VIX is up, market is down. VIX is down, market is up. It's oblivious and impervious to anything what the VIX does. We've gone nowhere. Now, 24,150, the important support level, we are hanging on to it for dear life, so to speak. Now, that breaks decisively in the sense, a proper break. I think we could be seeing further pain going on. So, nothing much. It's extremely not even sector specific anymore. It's stock specific. It's all over the place. So, one has to be very selective. And the Nifty or the Bank Nifty, I think one can avoid a trade because the bullish moves don't sustain, the bearish moves don't sustain. We remain relatively range bound, Nigel.
Got it. All right. So you're in a shade of green, but my co-anchor, Vinny, is in red. So I have a little bit of both on the show today.
I think right now I'm winning for the markets, right? It's more red on the screen than green, but hope it moves towards the green side.
I think Himen and me both will agree Vinny always wins. So we're both in your camp, Vinny. But let's get to the stocks. Yeah. Himen, tell us, which are the stocks on your radar?
Yes. Firstly, Nigel, I have a buy call on Minda. We are in a short-term uptrend. It's about a 55-day exponential moving average. It's about a 55-week exponential moving average. It's in an intermediate uptrend. The setup looks good, looks set to resume its long-term uptrend. Frankly speaking, on the short to medium term, it is ticking all boxes. So a buy on Minda at 1280, stop loss of 1255, target 1330. It's a modest target for a trading view. If you have a longer term view, I believe there is much more significant upside left. And the other stock on the list is Godrej Properties. I'm bullish on the entire realty space. If you look at the realty index, Nigel, it has done relatively well, and it is promising to do even more well. So a buy on Godrej Properties at 2080, stop loss 2040, target of 2160. Short-term positives, taken support on 55 EMA. Intermediate trend is up. The longer-term charts are turning positive on technical parameters after almost 1.5 years. So things are looking copacetic there for upside. Nigel.
Okay, Heyman, thank you so much for joining us on the show, talking to us about your trading strategies and individual names, Uno Minda, as well as Godrej Properties. We'll keep an eye out on those levels over there as well. Thanks so much for joining in. On that note, we're going to slip into a very short break. After the break, Manisha Gupta, who will be in conversation with Philip Newman of Metals Focus to discuss the sharp surge in precious metals, what's driving the rally. Stay tuned in.
Welcome back, and joining us on the show now is Philip Newman. He's MD at Metal Focus. Philip, hi, thank you so much for joining in, and I hope you're having a good stay in Mumbai today. How are you looking at the gold and silver prices? I mean, the month of August does seem quite positive. We seem to be holding around that $4,600 an ounce. At these current levels, what is your sense on what fundamentals are markets watching out for? It's going to be global central banks, interest rates, currency. What is it that you're looking at?
Well, good afternoon, Manisha, and thank you for having me back on your show. So I think, as you pointed out, prices are holding up well for both metals. I think if we start with gold, of course, we've had those US data prints, which have been less positive, and that in turn has seen markets scale back quite significantly their expectations for a Fed rate increase this year. And I think that has certainly been, I think, one of the key sparks for gold to move higher. We've seen pressure on the dollar. And I think something else which has unsettled the markets as it's done in the past is the threat or the onset of tariffs in the US. We've seen the trade war resume between the US and Canada. We've of course got the US midterm elections coming up. They're just around the corner. And there's always been speculation or concern about how President Trump would mobilize his base. We've seen him go for tariffs before, and he seems to be going back to that playbook again. And I think that would also weigh on the dollar to some extent.
If it does weigh onto the dollar index, do you see support come back for gold, especially given the fact that the US debt itself seems to be ballooning, now moving towards that $40 trillion mark? Where are you looking at gold prices by the end of this year? And if you have a range already ready for 2027?
Well, I think, yes, we are looking for prices to strengthen for gold and silver. We think that, gold could get back towards the $5,000 level by the end of this year. And we are looking for further upside, perhaps getting, back, touching or perhaps even exceeding those record highs, perhaps briefly, that we saw in January this year. So, strength finishing off this year and that strength carrying on into 2027.
You are also bullish on silver, as you mentioned, but silver has seen a very, very sharp correction from that $120 an ounce of a high. Are you looking at triple digit yet again, somewhere this year or maybe next year?
I think for this year, with the upside I mentioned for gold, we think that silver will do pretty well. We're calling Metals Focus for a high, say around $90 before the end of 26. And for 27, there is a possibility of getting to 3 digits. Do we think that it will hit the 120 level? Perhaps not. But, once silver does strengthen, and if trading gets a little bit thin, then it is a possibility, perhaps not our base case, but I guess that shouldn't detract from the fact that we do think that silver will do very well again before the end of this year and carrying on into next as well.
Philip, you are in India, you're doing your meetings here. What is it that you're picking up in sense of festival demand this time around?
That's a very good question. Of course, as you mentioned, I'm in Mumbai, just back from the India Gold Conference in Goa with my colleagues from our Mumbai office. I think things are starting to pick up to some extent. Of course, you've got the potential headwind of the price, that volatility, which can cause concerns. You set that against the fact that I think the monsoon, according to my colleagues, and it seems to be quite decent. So I think they are cautiously optimistic, and that's been a sense that in terms of some of the meetings that we've had, again, around the conference in Goa and in Mumbai as well.
How are you looking at the global central bank buying and the ETF buying? I mean, those two pillars really led gold prices higher for much part of last 8 to 12 months.
That's absolutely right, Manisha. So, as you would have seen, we had a relatively quiet first quarter to this year, but that was followed by an exceptionally strong second quarter in terms of those net central bank purchases. So we are optimistic that this year will be another year of very strong demand, perhaps not eclipsing what we've seen the past 3 years, but those were exceptionally high. So taking a step back, I think that will be another positive year. And we see little sign that that will slow dramatically going forward as well. So central bank activity will be important both in terms of underpinning the price, Manisha, and also in terms of investor sentiment. And then in terms of ETFs, again, we had some gentle weakness there recently, but I think taking a step back, given our gold price forecast and our expectations for gold for next year, we would expect to see buying return in force again in the coming months.
Philip, also, how are you looking at the physical buying, especially in India? I mean, low weightages, lesser quantities, keeping it inside the budget. Is that what you're getting your feel around?
Well, you're absolutely right. I mean, there is that a slight detachment between the value of purchases and the underlying volume from a kilo standpoint. In terms of the light weighting, perhaps an element of slightly lower carats. And these trends are entirely understandable, not just in India, but really across not just South Asia, but across East Asia as well.
Okay, Philip. Point taken there. We'll keep an eye out on the updates coming in precious metals and hope you enjoy your stay in Mumbai. And thanks so much for joining in. And Manisha, thank you so much for taking us through that conversation as well. But with that, we are absolutely, actually, we're going to slip into a very short break. We'll come back and we'll take you through more stocks, what's happening in the market as well on the other side. Stay tuned in.
Welcome back. Markets have recovered a wee bit from the lows of the day, so that's pretty interesting. If you look at the Nifty, we've come off a little bit from the lows. What's helped in terms of this recovery? Adani Ports moving from strength to strength. There's a speculation there could probably be some inorganic growth on this one. That's moved to the high point of the day. Eternal, what a dream stock that's been. I recall on the day of results, it had come down to around 270 bucks. So in a matter of a month, the stock actually has moved up by close to around 15 to around 18% from the result day lows. On the flip side, a few stocks that are putting some pressure. Tata Consumer has slipped a little bit, and Trent as well is not doing too well, Vinny.
Absolutely, those are some of these individual names. But earlier on the day, we spoke to Harish Krishnan, CIO at Equity at Aditya Birla Sun Life AMC, and he believes that there is still some steam left in select auto ancillaries. And when asked specifically about Lenskart as well as the potential for the company going ahead, here is what he had to say. Listen in.
We continue to be very large owners out there, and in this case, obviously they've executed supremely well post-listing and even beyond. And we think that this is possibly one of India's multinational companies in the making, with significant use cases in the AI world. We think that this is one of our core positions. We continue to kind of maintain them. Chemicals from the old economy space, I would say that that's again going through a similar spot wherein you do see definitely a China plus one narrative now coming through. It's also kind of buffeted by the fact that you've got the Chinese yuan to the Indian rupee, which is kind of moved to the 14 handle from the 12 handle, say about 12-18 months back, which has made Indian players even more competitive. So that's the other area. Of course, it's a global play in the sense that the demand is more global than from an India perspective, but over there we prefer import substitution plays as well over there. Auto ANGs, I still think that there is still a reasonable amount of steam out there in some very well-run companies out there which are doing differentiated work, and there is a lot of, we've done a lot of FTA agreements with Europe, with UK, with the Oceania segment, Middle East. I would think that markets have opened up for India, and a falling currency has kind of further strengthened our competitiveness.
Okay, on that note, we're going to slip into a very short break. We'll come back after the break and focus more in terms of individual stock names. Stay tuned in.
Welcome back. Markets a little bit lower, but individual stocks doing a thing of their own as the Nifty has cut its losses. GK Energy, that's a stock on Vinny's radar. She's a busy lady today, tracking quite a few companies. Tell us what's the news flow here. Stock up 5%.
So today, actually, it's on the back of an order inflow that's come in. It's a very big order for them. 454 crores is the order, and this is for a 100 megawatt of rooftop solar project. And the company's spoken about this as well, that they want to focus more on the rooftop side as well. They are mainly onto the pump side. Now they're increasing the exposure toward the rooftop side. So order size, very big order size. The scope of work, it includes design, engineering, supply, installation, testing, commissioning of grid-connected rooftop solar PV systems. And there will be also an O&M period that is of 5 years as well. So that O&M service is also something they'll be providing. Now, do not forget, as on Q1 numbers, when they reported their numbers, that time the order book stood at 541 crores. Of that split, in terms of revenue split, only 5% came in from rooftop, 95% was from pump. When you look at the order book split as well, in Q1 FY27, order book, 20% of the order book has started coming in from now rooftops, and 80% is from the pump. So that time the management has said that, you know, the rooftop side of the business and segment is also started picking up pace, and that's where they'll see more growth coming in as well. Like you can see in terms of the growth coming in for the order book, especially on the rooftop side. And they've given a guidance which is on track to double their revenue in FY27 with these big orders. Seems like that's on track as well. As of now, because of all of this, the stock is holding on to very strong gains of around 4 to 5% in the trading session.
Well, brilliant, Vinny. Thanks a lot for educating us on that one as well. Well, it's that part of the show where we're done. Halftime report we wrap up on, but the team of Business Lunch is waiting for you on the other side. Stay tuned.
Stocks trade soft ahead of F&O expiry on the BSE, even as global cues remain mixed. Pharma and consumer durables see some green, while IT and FMCG trade in the red. HDFC Bank's troubles don't seem to go away, even as the street thought its recent troubles were behind. A suit filed by an investor in the US puts the MSRDC issue back on the table. HDFC Bank says it will vigorously defend itself. The Singapore International Court has dismissed Tata Power's challenge of $490 million arbitration award to investment from Kleros partners. Tata Power says it will appeal against the verdict, but the stock takes a dip. In a new national emergency declaration, US is restricting imports of gear for power grids. Analysts say the move, targeted mostly at China, will reduce competition for Indian exports. Stocks of power gear makers rally. The death toll in Nepal's devastating flash floods crosses 170, with hundreds missing as the rescue operations continue. India sends relief materials as centre puts Bihar and Uttar Pradesh on high alert, with NDRF deploying teams. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan. Good afternoon, guys. The market's in the red, but we're seeing some sort of a recovery in the last half an hour. The Nifty now above that 24,150 mark. It's about 0.1% in the red. The mid-cap index falling in line with those blue chips, but the Nifty Bank underperforming slightly. That index is about 0.2% in the red, losing a little over 100 points. If you take a look at the sectors, we've got PSU banks that are the top losers. Bank of Maharashtra down 1.5%. We've got Canara Bank that's down nearly 1%. PNB also seeing cuts of nearly 1%. FMCG names, those are also feeling the pressure today as well. Imami down over 3%. United Spirits and Tata Consumer Products, both of them nearly 1% in the red. What's doing well? We've got those defense names managing to hold in the green. We've got Solar Industries up nearly 2%. BL up nearly 1%, and Dynamatic Tech nearly 0.5% in the green. We've got that realty pack that's also moved into the green as we speak. So that's how the markets are shaping up this afternoon. But first up on the show, a US investor has filed a lawsuit against HDFC Bank, citing a breach of US securities law. The bank, in a statement, says the lawsuit is without merit and that it will defend itself. That stock now lower in trade as we speak. Ananya is here to take us through all of those details. Ananya?
Well, yes, the MSRDC controversy has now escalated to a formal US securities lawsuit. Now, the investor, Jwalan Soneji, filed this, lawsuit on August 13. Specifically, this centers on the alleged 45 crore payments to MSRDC which were routed through marketing and alleged use to provide an effective 6.01% interest rate above normal savings rate, almost above 2.5 percentage point above the normal savings rate. Now, this follows HDFC Bank's July internal review, which called the conduct business overreach here and issued warning letters and 1 lakh rupees penalty to MD and CEO, CFO and other senior executive. Now, at the same time, 3 US law firms had launched investigations into possible securities law violations. Now, the issue has moved from investigation to actual US court litigation, like I mentioned. Now, here the bank says in the United States, these type of shareholder lawsuits are, incredibly common after a common experiences, stock drop. Now, and many companies listed in the US routinely defend these lawsuits every year, the bank mentioned. Now, importantly, the bank believes that lawsuit is without merit and intends to vigorously defend itself. But the main thing is, or the main risk now is the risk about the governance and the investor sentiment here, which is also weighing on the stock today.
All right, Ananya, many thanks for taking us through those details. Now, shares of Tata Power is in focus after losing $490 million arbitration challenge in Singapore in favor of Kleros Capital Partners. Vivek is here with all of those details. So, Vivek, the stock feeling the pressure, down nearly 4% in trade.
Well, you're absolutely right. So Tata Power, just to give some context or some perspective, this is a case that pertains to a joint bid that both Tata Power and Kleros Capital had done as early as 2013. This was for a Russian coal mine that both of the companies had jointly bid for together, post which there were various disagreements with both of the parties. Post which Kleros had dragged Tata Power into an arbitration. Earlier, a Singapore court had given an arbitration award of a little over $490 million to Kleros Capital, which Tata Power had gone ahead and had filed an appeal against the decision of the court. Yesterday, this particular appeal was disposed of, implying that Tata Power may now have to pay the $490 million worth of arbitration to that particular entity, Kleros Capital. However, Tata Power still has 28 days to further file a challenge against this particular decision. They can go to the Singapore Court of Appeals. We spoke to Tata Power in the morning. They said that they do intend to file an appeal. Important to note that this typically in such cases, whenever there is an outgo for an arbitration, it is not done in one single tranche, but it might be taken over quite a few tranches.
All right, so we'll have to wait and watch what happens in this case. Thank you, Vivek, for taking us through those details. Now, the United States is tightening curbs on foreign-made grid equipment in what analysts see as a likely China-focused move. But could this move give Indian equipment makers with U.S. exposure a competitive edge? Let's take stock and bring in Vinny to help us put things into perspective. Vinny?
Hi, thanks so much for that. So it seems like it could give Indian makers, power equipment makers an edge today, and especially looking at the stock move. Now, what's actually coming? There's an executive order that is signed by President Trump. This is a new national emergency declaration by US to restrict US purchase and import of certain foreign-made power grid equipment. Now, we're awaiting more details on this one because which are the vendors, which is the equipment that is going to be included in all of this. Those details are awaited, but this seems more of a move that's come in for Chinese players. Now, analysts are saying that this is primarily for Chinese crackdown spanning across transformers, generators, BESS, grid-connected inverters, you have turbines, including, software solution which is provided for key industries, whether you look at, data centers, you have defense manufacturing, grid infra, all of that has been picking up pace. And because of too many imports coming in from China in US, this is a restriction that's come in here. Now, this shall be some bit of a positive move that comes in for Indian players. The exposure that companies have to the US is not as much, but this will give them at least an edge on that front, could increase the exposure furthermore over there. So positive for GE, Vernova, T&D, Hitachi Energy, CG Power, TD Power Systems, you have a Power Industries, all of this are also some of the beneficiaries that could come in on this front, but we'll wait out for more clarity here as well.
All right, Vinny, many thanks for putting that into perspective for us. Moving on, the NCLT has cleared Z promoter Subhash Chandra's repayment plan worth just a fraction of the over 22,000 crore rupees owed, with lenders taking a huge haircut. Ritu Singh is here with all of those details. Ritu?
Well, this case is catching all the eyeballs thanks to the very shocking outcome involved for the lenders. The National Company Law Tribunal has approved this repayment plan for Z Group founder and chairman Subhash Chandra, under which creditors receive only 6.5 crore rupees against the admitted claims of more than 22,000 crore rupees. Now, that amounts to a haircut of 99.97% for lenders. And, to go back to the background of the case, it goes back to a 170 crore rupee loan to Vivek Infracon, for which Subhash Chandra had given a personal guarantee. And when the loan was not repaid, Indiabulls Housing Finance, which is now Sammaan Capital, had moved the court against, Subhash Chandra in 2022. And the case was admitted in 2024 and cut to now. Under the repayment plan that's been approved, creditors get to recover only 0.03%. Now, keep in mind, the plan had already received support from the lenders with 80.8% of voting support from creditors in November of 2024. But also importantly, there are several large lenders, LIC Housing, HDFC, Axis, Canara, RBL, Union Bank, that control about 20% of the shares. They had all objected, arguing that there were 5 entities which control nearly 62% of the voting share that were linked to Subhash Chandra. But NCLT rejected those allegations that any kind of creditor voting was skewed, and they sided with the approval of the plan. Creditors, in fact, had also questioned how Subhash Chandra's net worth could have fallen so sharply from 45,888 crores in 2017 to just about 31.8 crore rupees now. But the NCLT says historical net worth figures by themselves don't really establish any concealment or diversion of assets. So the matter now goes back to the original NCLT for formal orders. But for lenders, it is an extraordinarily bad outcome. 99.97% haircut means creditors are recovering virtually nothing. Now, the case has even prompted a jab from none other than Vijay Mallya, who's taken to social media with some visible sarcasm. He's called it the Indian Debt Resolution Justice, pointing to more than 200% recovery claimed in his own Kingfisher Airlines case and contrasting it with what he says is a pattern of other borrowers repeatedly settling their debt at a fraction of what they owe.
All right, Ritu, many thanks for taking us through those details. On that note, it is time for us to head into a short break, but more news and updates follow on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Commerce Minister Piyush Goyal, who is in Japan, pitches India's manufacturing opportunities to Japanese companies across key sectors. From the sidelines, my colleague Abhimanyu Sharma caught up with the minister, and here's a slice of that conversation.
I think this visit, coming within a month of the visit of the Honorable Prime Minister of Japan to India, will help us take this relationship to the next level and fructify the 10 trillion yen, which is about $70 billion investment that Japan has committed to do in India over the next decade, may actually happen in less than 5 years.
You spoke about that around 70 trillion of global GDP has opened up for India, and India's exporters, of course, have huge opportunities in the global market now. Now, apart from the review of existing trade agreements, India is also coming up with several other trade agreements. Many are under negotiation, many have been finalized but are yet to be signed and implemented. What can be the timeline for these agreements to come into force, which is possibly going to be a force multiplier for India's exporters?
Well, recently Oman came into force. After that, UK came into force on 15 July. Very soon, New Zealand will enter into force. Around the end of this year, calendar year, we will execute defining documents. The legal scrub is over with European Union, and the 27-nation bloc will enter into force in the first quarter of calendar 27, sometime February, March 27. So all the 38 countries we are hoping to cover, including the US, where we will get preferential market access, will provide a huge $60 trillion additional GDP to the $10 trillion that was finalized during the UPA government. That 10 trillion before 14, 60 trillion in the last 4 years, collectively open us $70 trillion GDP to us. In addition to that, we are in active dialogue with Canada, Chile and Peru, and Ecuador wants to also discuss countries in that region. We hope to further expand the PTA with Mercosur, where Brazil takes the lead. We have already launched negotiations for a PTA with SACU, South Africa-led customs union. We launched it a couple of weeks back in India. We are in dialogue with the GCC that was launched. Negotiations with GCC were launched a few months back, and the first round is later this year. Israel negotiations are powering on. The Eurasia negotiations are going on. Maldives negotiations are making fast progress. Egypt has indicated an interest. Kenya has indicated an interest to expand trade relations. The world today is looking up to the great India story, moving from a $4 trillion to a $30 trillion economy under the leadership of Prime Minister Modi. Viksit Bharat is the collective commitment of India, and we will achieve it.
On that note, it is time for us to head into another short break, but more news and updates follow on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. On to news from Tibet and Nepal. Over 150 people were confirmed dead and more than 400, including around 133 Indians, are missing or out of contact after a massive flash flood in Nepal swept through villages in a district bordering China's Tibet region. Officials said the death toll could rise and that it would take days to assess the full extent of the damage. Arunima is joining us from Trishuli in Nepal with the latest.
This is the Dhunge Bazaar in Nuwakot. This is near Tesuli area. Till yesterday, this was a road. 24 hours later, all that remains is muck. You see the Nepal Prahari, Vipat Uttakarmi. These are the disaster, state disaster management forces. There are the Nepalese scouts along with other teams who are out at work. There's a JCB which has been deployed to clean the muck and make this road motorable once again. But what is the situation? You see, that's the river that Rajesh Bhardwaj is now zooming in and showing you. That river has also changed its course. There was very little time. Locals speaking to CNN News 18 said that there were very little time that was given to them. These are Nepal police officials, disaster relief officials who are trying to take stock of the situation. They can't go beyond because the river changed its course and washed away this entire stretch of road from here right up till the Tibet-Nepal border. At least 34 bridges have been washed away. That's the version coming in from the locals. Hundreds are missing till now. Many dead bodies have been recovered. But let's show you the river once again. You see the river and all these buildings next to the river. There was the Agricultural Bank Development Limited. You see how the entire first floor has been broken. The curtains tell you the story where the mud brought in by the river went up to the first floor as well. The front porch is completely broken of that building. The building next to it also the same. The trees that were there covered in mud and muck. There are also trucks which are lying there. There's an ATM next to me again, half filled with mud and muck. These trucks which were lined up, all of them washed away, and these choppers that are making the sorties one after the other, these choppers are trying to rescue people stranded on the other side because bridges across this river have been washed away. Like I said, locals say 34 bridges have been washed away. So people on the other side have no other means of coming in, and that's why these choppers are carrying out sorties. The choppers are going out and seeing if anybody has been injured, requires any medicine, and these air sorties are very important in that sense.
So Arunima there with the latest from Nepal. But with that, it is a wrap on this edition of Business Lunch. Mid-Cap Radar will take all the market action forward. Stay tuned.
Good afternoon and welcome to Mid Cap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Vivek Iyer and with me today is Reema Tendulkar. Good afternoon, Reema, and good to see you in the studio at this hour. Well, you've actually seen a very soft start as far as September series is concerned. Markets continue to languish. We're not holding on to the gains. And today, too, very news-dominated and a large amount of equity supply is what we're grappling with currently.
So today, the count, like yesterday, we had close to about 6,000 crore of block deals. So today, what's the number?
Well, should be similar, maybe it's higher because of the Foseco deal as well, right? Because the Foseco deal, almost 15% of equity, and our sources tell us that demand there was almost 3x, so almost 40% of the total company.
So there's ICICI Pro AMC, there's iFinance, and there's Foseco.
And also Apollo Tyres, again,
that's the other one which happened in the morning.
That happened in the block deal window as well. But we have a lot lined up on the show, an important IPO conversation as well. So let's start off with the top headlines. Stocks trade soft ahead of F&O expiry on the BSE, even as global cues remain mixed. Nifty trades near 24,200 levels. Consumer durables see some green, while FMCG and PSU banks trade in the red. Mid-caps trade in line.
Juniper Green Energy sees profit booking despite reporting strong year-on-year growth in its first quarter FY27 earnings, with a sharp rise in operational capacity driving the performance.
In a new national emergency declaration, the US is restricting imports of gear for power grids. Analysts say the move is targeted mostly at China and will reduce competition for Indian exports. Stocks of power gear makers rally.
Pine Lab rallies on the back of a bullish note by Investec. The brokerage has initiated coverage with a buy rating and a target price of 200 rupees, expecting a 20% revenue CAGR over the next 3 years, along with significant margin improvement.
Welcome to Midcap Radar, and like we mentioned, it's quite a dull trading session. If you pull up the advanced decline ratio, very much skewed in favor of the declines, and the Nifty Midcap Index, as you can see on the side of your screen again, has moved quite decisively now towards the low point of the day. But this is our special segment, Midcap Movers. We are standing by the wall to take us through all of the midcaps that are moving around in the session.
Well, yes, a lot of movers in today's trading session. Let's start off with the gainers first. We have Travel Food Services seeing a strong gain today on the back of strong volumes as well. Nearly 7 times the monthly average volumes traded on this counter today. The stock is seeing a gain of over 5% at the moment. Whirlpool also seeing a gain of nearly 7% in today's trading session. But remember, this stock has been beaten down and declined nearly 38% just in the last 1 year. Apar Industries is another stock on the gainers list today. This stock, in fact, has more than doubled on a year-to-date basis, and we also have Delivery as well as Shipping Corporation seeing gains of nearly 2 to 4% in today's trading session. Let's also look at some of the stocks that have hit their 52-week highs as well as their all-time highs today. These include the likes of Welspun Corporation, Solar Industries as well as Anthem Bio. And on the flip side, looking at the losers in today's trading session, we have Manappuram Finance, Ramco Cements, KRBL, Capri Global as well as Sonata Software. All of these taking cuts in today's trading session, down anywhere between 2.5% to 5% today.
Well, thank you so much, Ria, for joining us and giving us all of the stocks that are moving around as far as the broader end of the markets are concerned. But moving on, Lumino Industries is the management joining us now. The company's 700 crore issue opens for subscription today. The price band is fixed at 78 to 82 rupees a share. We are now joined by Mr. Devendra Goyal, Managing Director at Lumino Industries. Well, good afternoon, Mr. Goyal, and thank you so much for joining us. Well, first up, we'll ask you why exactly you're raising funds for this particular IPO. What is the current debt on the books? Or what is the finance cost at which this particular debt is being serviced currently? And what will be the accrual to the P&L once you prepay these loans, as you've mentioned in the IPO documents?
Thank you for inviting me on this channel and sharing about my IPO with your viewers. So that's a great opportunity. So we have an IPO of 700 crores, out of which 500 is primary and 200 is the OFS. The primary fund that we are raising, 500 crores, would be used to repay debt. Debt would be repaid to the tune of 385 crores. 15 crores would be used for our existing manufacturing facility, wherein we'll be doing revamp of the existing manufacturing facility. And balance around 140 crores would be used for general corporate purpose. My cost of borrowing for debt is approximately 8.5%.
You know, the next question, that we'd like to ask you is, you're present in a very highly competitive industry, and most of the peers that you're currently, grappling with or competing with are much bigger in scale, size, capacity, as well as order book. Now, when we look at the financials of your company, from FY25 to FY26, FY25, you grew almost 36%. FY26, that has dropped down quite drastically to just around 6%. What is the reason for such a sharp drop as far as top line is concerned, especially for FY26? And going forward, what is the kind of steady state growth that we can expect? Because this is quite a large fluctuation that you're seeing on a year-on-year basis.
So if you allow me, I would like to introduce my company so that, from there you can get an idea of what exactly we are doing and how do we capture the market going forward. So to talk about it, my company, Lumino Industries Limited, is based out of Kolkata. We are headquartered in Kolkata and the manufacturing facility is in Kolkata. Our revenue as on FY26 was 2041 crores, which is 2041 crores, out of which 1440 crores was product and balance, which was around 670, was on the EPC side. Before that, our EPC, in the previous year, our EPC was approximately 800 crores. So what we have done is we have strategically reduced our exposure on EPC and we are increasing our exposure on product. So if you compare my revenue of FY25 for product, it was around 1250 crores, vis-a-vis 1440 crores in FY26. So there is a growth of 15% on my product side. And I've reduced my exposure on my EPCs because we feel that, EPC leads to a lot of elongated working capital cycle, and there's a lot of working capital that is needed in the EPC. So strategically, we are reducing our exposure on EPC and trying to become more of a product company.
Okay. Do you expect further reduction in the EPC revenues from the current 1450 crore rupees? If yes, are you looking to completely exit the business? What will be the size and scale? And going ahead, then what is the sustainable growth rate one should expect as wires and cables scales up and EPC comes down?
Yeah. So last year, my revenue was 70% from the product and 30% was from EPC. So going forward, we were definitely maintaining 70% on the product, between 70 to 75%, and EPC would be between 25-30% max. So our idea is to continue and grow on product and not on EPC.
And the sustainable balanced growth rate between the two, and what led to the margin improvement seen in the last 2 years?
See, the margin improvement led to because of the new products that we have introduced. We are amongst very few manufacturers of HTLS conductor, which is high temperature, low sag conductor. There are very few manufacturers in the country right now who has been able to design, manufacture, supply, install, and get the performance certificate. So this is a buzzword in power segment if we talk about HTLS. So we are amongst those 4 or 5 manufacturers in the country who are capable or who have proven their capabilities to supply the HTLS conductors. So this is a product where we see a lot of high margins, and this is a product where we see a lot of market. Going forward, we'll see a lot of demand in the market. So that led to a better margin. Secondly, we tried to reduce on the exposure on EPC, trying to reduce the exposure on distribution EPC and increase our exposure on EHV substations, which is up to 400 kV. So that is also helping us in better margins.
Okay, we understand that as well. Well, when we look at your current order book, almost 3,150 crore is the current order book. More than half of that is actually from the EPC side itself. So even as you try to scale down, the role of EPC or the contribution of EPC, at least for the next couple of years, it appears as though EPC might dominate a significant portion of your revenues. So going forward, order inflow and order mix, how will it look like? And EPC FY27, what is it that you will be executing?
See, as I said that, my ratios would always remain for the product 70 plus and EPC would be below 30%. And your second question was, what happens is the order book is 3,000 crore that you're talking about. So in EPC, the order tenure is approximately 24 to 36 months. So whatever order book that we have in hand right now would be executed over 24 to 36 months. And 1,200 crores of order book that we have in product, that would be executed in 3 to 4 months. So turnaround time for order book on product is much shorter than EPC.
Okay. And your trade receivables have also gone up. They've practically doubled. It was 460 crore in FY24, almost 900 crore in FY26. What is the reason for that? And is there a debtor day number? I think it stands at 145 days today. If you could give us a number with which you would end the year with, and then we'll ask you on the operating cash flow as well.
Okay. So what has happened in last 2 financial years, we did a lot of job in distribution EPC, wherein the elongated working capital cycle was there. a lot of working capital requirement was there. So if you see, my number of days will gradually be reducing. A lot of payments were due from electricity board as on FY26, which we believe that in this financial year in H2, we'll be getting a lot of payments back. So, and we are strategically moving from distribution EPC to EHV substation to reduce these elongated debts.
So you're saying that most of the elongation as far as working capital cycle was concerned was mainly due to delay in payments that you're getting, as far as EPC projects are concerned. So in such cases, typically, do you continue and finish the project, or do you wait for payments? Because especially, in the water space, something that, we've seen is that a lot of work has actually stopped over there. What is the on-ground execution looking like?
See, our revenue contribution from water is negligible. Whatever we are doing is more related to power sector. So last 2 years, we did a lot of job in EPC in power sector, because of which there was huge debtors as far as our books are concerned, which we are trying to reduce by getting all those payments. We have completed those jobs. So this financial year, we expect a lot of payments coming in and this number gradually going down.
And is that the reason why operating cash flow was negative last year of about 240 crore rupees and then turned positive in FY26?
Yes, that was the reason. So we are gradually getting our payments. So our cash flows will also improve.
One final question, Mr. Goyal. Give us a sense of, someone who invests in this company, what kind of growth should they expect? Yeah.
So going by my past record in the last 10 years, if you see, the company on a CAGR has grown by almost like 25-27% year on year. Our EBITDA margin has always been between 10 to 11% in the last 10 years, even including that 12-15 months of COVID period, where there was a blip in the revenue and the EBITDA margins. But still, on a track record of last 10 years, we have maintained a CAGR growth of 25+%, EBITDA margin of almost like 10+%. So going forward, we believe we would be able to maintain these kind of EBITDA margins. Or we, as a management, will always focus on improving those on margins. And as I said, that we are one of the few manufacturers of HTLS conductor. Very soon, we are coming up with HT cable in West Bengal, which will give me a possibility to manufacture cable up to 11, 33, and 66 kV. So I'm adding products in the portfolio which will give me better margins, reduced working cycle, capital, and improve my cash flow.
Well, thank you so much, Mr. Goyal, for joining us. We wish you all the best for our IPO. And, once you're on the channel, we hope to get a lot more forward-looking statements from you as well. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. The Nifty is now at 24,150. The IT index has slipped as the day has progressed. When it started trade, the Nifty IT index was up close to about 0.5%, and now it's dipped into the red. In fact, the dip happened in the morning, early part of the trading session. Some stocks where you are seeing correction today: Mastech, Birla Soft, Happiest Minds, KPIT Tech, Hexaware. Many of the mid-cap IT names are correcting, while large-cap IT names are also down close to about 0.5 to 1%.
Well, have a look at, two of the aluminium stocks, both Hindalco as well as Nalco. Both of these stocks, in the last half hour or so have fallen to the day's lowest point. Both of these stocks now trading at the day's low. The other stock on the radar, of course, is M&M. That particular stock too, after being flattish for a large part of the session, now has moved to the low point of the day.
Sale has also moved to the day's low.
That's right. So metals seeing quite a bit of selling pressure emerge as well. Aluminium prices too have fallen. Well, it's a good time to get a quick technical check on the markets. Let's welcome Dharmesh Shah from ICICI Securities. Good afternoon, Dharmesh, and thank you so much for joining us. Well, have a look and give us a sense as what do you feel as far as where Nifty is headed from this point on. Another 0.3% lower today.
Yeah, so good afternoon, Vivek. Yes, if you look at the market from the short-term perspective, yes, Nifty has been facing a stiff resistance near the 200-day EMA, which is placed at around 24,373. If you look for last 7 to 8 trading sessions, we have been trading in this range of 24,000 to 24,400. But what interesting point to highlight in this current corrective phase was that if you look at the Nifty from the medium-term perspective, Nifty seems to be defending 24,000. I would say the upward rising trend line of last 4 months has been hold on in this current corrective phase. The value for the same is currently placed at around 24,000. So we expect, I think, so Nifty should see some bit of a support in this range of 23,900 to 24,000, and eventually should challenge the upper band of the channel, which is placed at around 24,600. Some interesting point to highlight again will be again from the market trend perspective. If you look at the market trend, the percentage of stocks trading above the 200-day EMA of previous CNX 500 has improved from 48% to 58%. So indicating a more of a broad-based rally happening for the market in the current corrective phase. Yes, in the near term, maybe on the back of MSCI rebalancing couple of days, we could see some bit of a volatility in the market. But in the month of September, we remain pretty constructive, positive for the market, and a dip towards 23,900, 24,000 should be looked at a buying opportunity.
All right, we leave it here. Thank you very much for joining in. Before that, any stocks that you would like to recommend?
Yes, Rima, if you from the stock perspective, from the stock recommendation perspective, yes, real estate as a sector looks more positive from the current levels. In this current corrective phase, if you look as a sector, we really outperform. But inside the real estate space, DLF remains to be a top pick. Again, the stock, if you look from the weekly perspective, seems to be on the verge of a breakout of a consolidation range and forming a strong base above 52-week EMA, indicating, I think so, in the days to come, I think so DLF can be looked for a target from 732, keeping a stop loss of 632. Apart from DLF, again, metal space, yes, we are seeing a correction in today's trading session, but the current correction should be as a buying opportunity, while Steel Authority of India sale remains to be a top pick. Again, multiple occasions, if you look for the sale, has been finding a buying demand around 200-day EMA, supported by falling trendline breakout with strong sets of volumes, and a dip towards 180 to 186 should be looked as a buying opportunity for target of 209, keeping a stop loss of 184. So DLF and Steel Authority of India remains to be a top pick.
So this buy on sale has come because the stock has suddenly slipped about 4% because we're pretty close to that buying price of 186. So therefore now it's seen as a buying opportunity.
Yes.
All right. Thank you very much for joining in. Get into a break. We'll come back with more. Stay tuned. Welcome back. Bharti Airtel has suddenly slipped nearly 1% from the top in the last 10-15 minutes. In Singapore right now, the Singtel Investor Day is currently ongoing, and as a part of it, Singtel has reiterated its plans to equalize its shareholding in Bharti Airtel with Sunil Bharti Mittal. It's not that this is something new. It's been said before. In fact, even in May, when Sunil Bharti Mittal for a change joined the Bharti Airtel conference call, they had spoken about it, that Singtel and Sunil Bharti Mittal, the eventual goal is to equalize the stake. Currently, there is a difference of about 3.6% stake. Sunil Bharti Mittal has 3.6% more stake compared to Singtel in Bharti Airtel. No, I think I'm saying it wrong. Sorry.
I think they'll need to
Singtel has more stake than Bharti Airtel. Singtel has more stake than Sunil Bharti Mittal in Bharti Airtel. The difference between the two is 3.6%, which basically in a nutshell means in the next couple of years, Singtel will bring down their holding by 3.6% to equalize it. As I said, it's not new, but this is an overhang on Bharti Airtel because supply can come anytime. Block deals of $1 billion plus can keep coming through. And I think that's in a way putting a lid on the share price of Bharti Airtel. That headwind.
That's right. Thank you so much, for taking us through the details of the Singtel investor presentation that's happening as we speak. Well, with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
and welcome to MF Corner on CNBC TV 18. I'm Vinny Motiwala and thank you so much as always for tuning in. Now today what we're going to be discussing, actually we're deep diving furthermore into hybrid specialized fund strategies. That's SIF strategy but for the hybrid one. Now a quick recap in terms of what are SIFs. This is a category that SEBI has carved out to sit in the gap between the plain vanilla mutual funds and a PMS. Now what's the catch? That it's not for everybody. The entry ticket size for this is going to be rupees 10 lakh per PAN, and that is counted across every SIF strategy you hold within that single fund house. Now, the category AUM in barely 10 months, of the launch has gone from standing to around 0 to 23,000 crores over that amount actually by July 2026. That's the last data that we have. Now, let me break it down for you all furthermore today. Specifically, the hybrid book, and which is where bulk of the money has gone. Now, SIFs in general has three broad buckets, right? Equity, debt, and hybrid. Today, what is this hybrid category? Nearly 7 out of every 10 rupees in SIF universe has gone into hybrid strategies, not equity. So, rupees at 16,523 crores versus 6,653 crores is the breakup between hybrid and equity. This is as on 30th of June 2026 data that we're picking up. Investors writing these 10 lakh checks are seeming to buy the risk managed pitch, which is going first and where most of the launches also came in first. Now break the hybrid book and the AUM further down, seems more lopsided as well. 14 strategies in all that are there, but hybrid long short, that's where most of the money again is coming. 15,374 crore rupees over there, or you could say around 93% of that hybrid AUM pool is gone to this side, long short strategy. Then in that one subcategory is where 2/3 of the money is. The other one is the active asset allocator, where again 1/3 of the money is going, most of it. That's 1,149 crores, and it's still managing to get its feet on ground right now. Is the second strategy in the hybrid category for SIFs. Now, so the money has voted for it, but what is the performance indicator coming in here? And this is just a caveat for our viewers before we go into these numbers, that these are absolute returns and not annualized returns. Most of these funds are even just a few weeks old that have come in and that have launched recently, few months, few weeks. So do consider that this is absolute return that I'm talking about. Now, one of the 1 month view that we're looking at is ISIF, which is leading the pack with around a 5% uptick there in the last 1 month in terms of returns. Then you have Apex that's following the charts as well with 3.28% is the returns that have gotten there as well. This is for some of the funds there. On the other side, you have Arudha, which has got around 0.5%. Then you have Titanium with 0.91% as well. So the spread is quite large in this hybrid category itself overall as well. Different categories and different fund houses managing to do different performances over this period of time. So it's important to understand that in terms of the hybrid long short category. Now, when you move on to the active asset allocator category, bit smaller, but the numbers are quite sharp. Look at QSIF's active asset allocator performance there, right? 11.89%, and this is just in 3 months. Then you have 14.66% since its launch and inception date, but that was in April itself as well. So you're seeing a good performance coming in this as well, and vast variations across different funds. Obviously, the time period is different from all of them as well, and we've mentioned it on the screens for you all, the inception dates for all of this. So the history for these funds is very less, not even 1 year for overall as a category, but the growth has been vast. So let's break down this hybrid category furthermore, and we'll be discussing all of this on the show today. But this is our understanding in terms of what we want to discuss through the show. We'll be joined by Ketan Shah, founder and CEO at Truvanta Wealth as well. But we're going to sip into a short break and we're going to come back and discuss this with him. Welcome back to MF Corner on CNBC TV 18. Previously, I explained you all what are SIFs and the hybrid category, which has seen such a vast growth, especially in the last year. There are two types in that as well. So we're going to discuss all of this. And now we have Kirtan Shah, founder as well as CEO at Truvanta Wealth, joining us to explain us more on this front. What is he seeing on ground as well? Kirtan, good afternoon. Thank you so much for joining us on the show. Let's start by this, right? Within the SIF hybrid strategy, which has seen such a vast growth in terms of AUM over the just last 12 months that you could count of SIF overall coming into action, these two different categories, hybrid long short and active asset allocator category. Could you explain our viewers the difference between these two categories first to start off with?
Hi, Vinny. Afternoon. Thank you so much for having me on the show. So, Vinny, both of these categories are very similar to other categories that we see on the traditional MF side. So, on the traditional MF side, we have a category called Balance Advantage Fund or a Dynamic Asset Allocation Fund. Different version of that here is the hybrid long short. So, hybrid long short is a category in which, as per definition, 25% has to go to equity, 25% has to go to debt, and the remaining can be floating around debt and equity. So, it is very similar, like I said, the hybrid category long short on SIF side is very similar to the BAF and DAF at the traditional MF side. But of course, the caveat is that on the SIF side, you can do a 25% derivatives, which you cannot do on the traditional MF side in the BAF and the DAF category. Similarly, on the traditional MF side, you have a multi-asset fund, which is very similar to what you have on the SIF side, which is called the active asset allocator fund. So like the name suggests, you can move your asset allocation across equity, debt, REITs, InvITs, commodities, and we'll have a 25% derivative exposure that you can take. So look at it this way. Your hybrid long short on the SIF side is very similar to BAF, but with a 25% derivative. And your active asset allocator is very similar to your multi-asset on the traditional MF side, but with a 25% derivative opportunity.
You know, Kirtan, very well put and easy to understand, at least for our viewers. But I just want to understand, you know, we've seen so many of these launches coming more on the side of hybrid long short versus the active asset allocator. Why though, right? While when you look at it on the MF side, when you compare it to multi-asset allocation, that's where the trend is picking up, right?
I think, Vinny, as far as I understand, I think probably SIFs are structured in a way where they are trying to give you a solution rather than offering you a new product. I'll tell you what I mean. So if you look, the biggest challenge in the traditional MF community at this point in time is to be able to counter the tax incident that has happened on debt mutual funds. So originally, if you go back a little, debt mutual funds had the indexation advantage, and which is why a lot of money would flow into debt mutual funds versus the traditional products like an FD or a bond or an NCD. Now, as soon as that was taken away, today when you invest in a debt mutual fund, typically what happens is you end up paying taxes at slab rate irrespective of the time that you hold the product for. I think the easiest way to be able to, you know, kind of bring a solution to this problem that now exists on the traditional MF side is to be able to offer a product which is probably taking very similar risk to the debt MF category, and at the same time is able to offer probably a 12.5% if you hold more than 1 year. Now that is the solution I think that the hybrid long short category on the SIF side has actually given. So there are plenty of funds in the hybrid long short category today that I talked to you of, which offer a very similar solution where they take risk very similar to probably an arbitrage plus kind of category or a debt plus kind of category. But if you invest or hold on for more than 12 months, then you typically end up paying only 12.5% tax. So I think the industry is moved towards kind of bringing a solution to the tax problem that they saw on the debt side on the traditional MF with a little innovation on the hybrid side on the SIF. And which is why I think most AMCs have first launched a fund here to be able to offer that solution. And now as and when more and more products are approved by SEBI, I'm sure most of these AMCs will end up offering all kind of products.
Absolutely, you know, because we've seen those recent launches coming in from the active asset allocator side as well. Well put there as well. You know, what I want to understand now, if an investor has decided I want to put money in SIF. Investors said, I've decided hybrid category. Now, there are two categories, right? If they have to pick from both these categories, subcategories for hybrid, how does one judge both these categories? I mean, should you first look at hybrid long short? Should you be looking at active asset allocator? What are the factors that one should consider for both of these categories?
Winnie, I think that's a very interesting question, and I'll tell you why. Unlike your traditional MF, where when you invest in a large cap fund, you know that 80% of the allocation of that fund goes towards the top 100 market cap companies, because that's what the objectivity of the scheme says. Now, unlike what you see on the traditional MF side, SIFs are very different. So I would really want to urge everybody who's watching us that don't even look at these two as separate categories within SIF. You will have to look at each of these schemes independently, because every scheme is completely different from the other scheme. So to give you an example, let's say if there are 11 hybrid long shorts and there are 3 active asset allocator funds. Now, don't look at them as 11 of hybrid long short and 3 of active asset allocator. You'll have to look at all of these 14 schemes completely individually and not as a subcategory of probably a category. And I'll explain why do I say this. Out of the 11 schemes on the hybrid long short, you will see that there are 5 schemes who have one as riskometer. One on riskometer means that the opportunity of losing capital is relatively low. Now, there are approximately 2 schemes that have a riskometer of, 3 schemes who have a riskometer of 2. There is 1 scheme who has a riskometer of 3, and there are 2 schemes which have a riskometer of 5. Now, you see within the 11 schemes under a subcategory, there are so many schemes who have riskometer ranging from 1, lowest risk of losing capital, to riskometer 5, which have the highest of losing capital. So you cannot, simply say that I will go to an asset allocator or a hybrid long short. You will have to look at each of these schemes individually before investing. Now, what can you look at? First, of course, you can look at probably, let's say, the riskometer. So depending on the risk that you want to take, you will understand if the riskometer is 1, you go for those schemes. And if the scheme has 5, you go for that. Other way of looking at this is probably understanding that on the traditional MF side, what are you trying to invest in as a better product on SIF? So to give you probably an example of what I'm trying to say, you will probably be able to realize from the data that I've shared that you will have, let's say, an Altiva by Edelweiss or a Magnum by SBI or an Infinite by Kotak, who are typically following an arbitrage plus strategy, which means on the traditional MF side, if you wanted to invest in arbitrage, you probably might be able to invest in these 3 to get a slightly better experience than an arbitrage fund. But if you want a replacement to your debt investing on the traditional MF side, then you might want to look at an Aruda by Bandhan or a RedX by an HSBC. But if you want a replacement to your BAF on the traditional MF side, then you will have to probably look at a QSIF by Quant, a Titanium by Tata, or an ISIF by ICICI, because those are the ones that follow a BAF plus strategy. So the point that I'm trying to say is don't look at these as subcategories and then end up selecting a scheme basis the past returns. You will have to actually look at each of these schemes independently, because they are following strategies which are very different from each other.
So if they're following strategies which are so different from each other, then, do I have to, or an investor, does one have to actually see the tax component also, right? Because will that be a difference? Equity holding, debt, will that make a difference in each strategy then? And should I be, as an investor, looking at that?
I think that's an interesting question, because when these funds were launched, there was a lot of confusion whether the long-term and the short-term capital gains tax will happen at 24 months or 12 months. But I think now there is a lot of clarity that the long-term and the short-term is split for 12 months. So above 12 months, you will have long-term capital gains applicable, and below 12 months, you will have short-term capital gains applicable. Now, the good part is that the long-term is very clear. In all of these schemes, if you stay invested for more than 12 months, what you end up paying as tax is 12.5%. But in the short term, there is a difference between some schemes, because if you look at probably Altiva by Edelweiss or an Aruda by Bandhan or an Apex by ABSL or RedX by HSBC and Infinity by Kotak, These are the schemes in which when you stay invested for less than 12 months, you will have to pay tax at slab rate. The remaining 5 schemes or 6 schemes, which I have not taken names for, in them, you will be taxed at probably 20% in the short term. So you will have to be mindful of this also, and which is why I keep saying that you cannot paint using the same brush with all of these schemes. They have a lot of differences amongst themselves as well.
Absolutely, a lot of differences among themselves. This is not, just everything fits one kind of a basket. It's all different, even though the category name may be the same, but everyone is different and everyone you'll have to check and find out. So what is the checklist then? Kirtan, where should one start with? Because everyone's going to be so different, so it's time consuming. So what is it that the few things an investor has to check, and we don't have a big track record coming in here? Then how do we look at it right now?
I think the easiest way is, in my opinion, first to understand, like I've been saying, that each of these schemes are very different from each other, and you can't look at the past returns and judge on the past returns saying that, ABC fund has given me better returns, so let me end up taking investment in that. Please don't do that. First, that's not a great strategy. Second, very little time frame of returns available. I mean, the oldest scheme is just 10 months old, and looking at the returns and investing is never, in general, a great strategy. So I'm going to give you two, 3 ways, in my opinion, that you can look and decide what makes more sense. I think one way can be that you typically first, like I said in the last question, decide what you are trying to replace from the older MF that you are investing in. So if you, let's say in the older or the traditional MF ecosystem, you are investing in arbitrage funds, and you are looking at a replacement to arbitrage fund because arbitrage fund is only making 6% kind of returns, then you probably look at schemes like Altiva or a Magnum or an Infinity, because they are following a very similar arbitrage plus kind of strategy. So your risk is going to be slightly higher than arbitrage, but your return experience can also be probably, let's say, 2% higher than arbitrage. Similarly, if you're looking at replacing debt, so you basically look at an Aruda or a RedX, because what they are doing is probably an Aruda is doing an income plus arbitrage kind of strategy. A RedX is doing a credit fund kind of strategy. So if you're looking at a replacement to debt, look at these 2 schemes, but understand they are going to have slightly higher risk than what you have on the traditional side, and which is why a better return experience and specifically a better tax experience. And if you're looking at a solution to your traditional BAFs and you want to invest in an SIF where you are looking at a replacement to your BAF and DAF category, that is when you look at probably a titanium or an ISIF or a QSIF. Now that's one strategy. You understand what you want to do on the traditional side and you're looking at probably a differentiated product, then this is how you go about. Second that you can look at is very simple is understand what your risk profile is and try and map that to the expectation. So on the riskometer, wherever you see 1 or 2, you have to understand that probably your chances of losing capital are slightly lower. So if you're looking at low risk kind of strategy, you go for SIFs on the hybrid side, which have a riskometer of 1 and 2. And the other way around, you probably look at a 3 or a 5 when you're okay with volatility but expecting higher returns. But make sure that when you go for strategies which have a riskometer of 1 or 2, you have a minimum 18 to 24 month of time frame. And when you go for 3 to 5 on the riskometer, you have at least 36 months and upwards of time frame to be able to choose. I think this is a great way to probably look at. And of course, if you're a sophisticated investor, look at a Sharpe or a Sortino ratio, then it'll help you understand the risk-adjusted return of what scheme. But having said that, the oldest scheme is just 10 months old, so looking at a lot of quantitative data point may not make a lot of sense at this point in time.
Absolutely, it's fairly newer, but at least you give us a checklist in terms of how one should get started with this. Ketan, just a quick one. 14 funds as of now that we have on the hybrid category as a whole. When you are talking to your clients, which one is it that you are looking at?
I think, like I said, we are currently definitely looking at replacing debt as a solution because of the taxation bit that I spoke to you of. So we are currently looking at categories which are in the riskometer 1 and 2, because that we think is the perfect replacement for individuals who have been investing on the debt side on the traditional MF. Because first, like I said, probably the strategy is very similar in terms of volatility and downside, but having invested for more than a year, you get 12.5% as tax. I think that's a big big shift in terms of taxation as an advantage. So I think we are looking at more from a riskometer 1 and 2 kind of category to try and replace debt. And we are also looking at replacing arbitrage, because arbitrage is great. It has equity taxation, but arbitrage is very limited in terms of what return it can generate. So I think riskometer 1 and 2 is also able to solve that problem.
Okay, Kirtan, thank you so much for joining us on the show, explaining us how maybe we should look at this category individually as well. It's quite confusing when it's a fairly newer category, and in that you have so many things that you have to watch out for. Individual funds have to be looked at individually in terms of SIF. So thanks so much for explaining us as well as the viewers all of that as well. Thank you so much. On that note, we're absolutely out of time on this edition of MF Corner. Thank you so much for tuning in. Up next, we have Closing Bell to take you through the last hour of trade.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan index is one of those exceptions that are managing to hold on to a very strong green right now.
These frontier AI labs that are once in a generation companies.
Oil, by the way, is unchanged. We are at $87 yesterday. We are at $87 now.
Will join in. I'm told that this is something which is commonly done in the US.
So yeah, 1/3%, 24,280 on the Nifty. The Nifty Bank is up about 1/3%.
and therefore we have a positive stance on equities.
By 2030 to at least reach 50%.
Lower tribunal has now approved a repayment plan for Z Group founder and chairman Subhash Chandra.
There have been relative presence of the Chinese vendors.
We hope to further expand the PTA with Mercosur.
Well, you've actually seen a very soft start as far as September series is concerned. Markets continue to languish. We're not holding on to the gains.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Rima, and joining us in just a bit will be Prashant. For the day, in fact, the Nifty is still holding with a bit of a cut in today's trading session, but individual stocks are doing a thing of their own. I think today belongs to the jewelry companies. If you look at Titan, you look at Kalyan Jewellers, they have popped up in trade and they are holding on to those solid gains as well. Just take a look at that. Both of them at the day's high. I think a Lalita Jewelry as well, one of those recently listed companies, that one as well has perked up. And Kalyan Jewellers, I have numerous times in my FNO coverage as well have been indicating that there is a lot of long build up. Every time it goes to 570, 600 rupees odd, it's making a bit of a spot. I think this time around as well, you'll have some resistance at around 650 rupees odd. That's the next level of resistance on this counter. Hey, Rima.
Hi, Nigel, and afternoon. But it's been another very quiet, slow, grinding kind of a trading session. And once again, the markets are wedged in that band. 24,000 on the way down, 24,350 in the immediate term as the upside. Yesterday's intraday high was also closer to that 24,360, 370 mark from where markets saw their profit booking. So that for now remains the upper band. But if you extend the trading range, then 24,700 remains the upper bound. One more stock where you are seeing some buying today, DCB Bank. That was active yesterday, but I think it's seeing some follow-through action even today. So 2.5% up on DCB Bank. So that will come up for you, and you've seen a little bit of a lift. But other than that, it's a quiet trading session, 0.25% lower now on the Nifty and the Sensex. The mid-cap index is blinking red and green. But for now, the advanced decline ratio is in favor of more stocks declining. Let's tell you the headlines, how the next 1 hour shapes up. Markets near the day's low on Sensex expiry. Pharma, private banks hold out. Small caps remain resilient. ITC's chairman and managing director Sanjeev Puri tells CNBC TV 18 that further cigarette price hikes could be on the cards to minimize the tax hike impact. He also remains bullish on the hospitality sector. Excerpts from our interview follow shortly. Bharti Airtel under pressure at the Singtel Investor Day. The company reiterates it would like to equalize its shareholding in Airtel with Sunil Mittal, implying further stakes could be on the cards. A Singapore court has also ruled against Tata Power in a near $500 billion arbitration case. The stock under pressure falls 3%. The United States issues an order restricting purchases of some foreign-made power equipment. Analysts say the order seems primarily focused on China, and therefore Indian exports will face lesser competition, and therefore it's positive for stocks like GE Vernova, Hitachi, CG Power, and you can see the green on the screen. Vinny will join in for more. Before now, it's 2:30. How should you position yourself? 1 hour to go. Mitesh Thakkar, as always, joins in. Mitesh, afternoon. What's been the trading call today?
I think on the index, as I said, I think a trade will occur if we get close to about 24,050, 24,000 so on. That's where the support comes in. The indicator setup was slightly turned negative, so I think we might test those levels maybe in a day or two. But on the stock side, I have a sell on Britannia with a stop at 53.35 for targets of 51.90, and Adani Power is a buy. Keep a stop at 208.5. Look for a target of around 225.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Well, let's get you excerpts from an exclusive conversation with Sanjeev Puri, the chairman and managing director at ITC.
Whatever is being done or should be done should be in compliance with law. And whatever is not in compliance with law or it's not giving the right perspective, I think the regulator has very much a right to raise issues around it. As far as ITC is concerned, I think we are very committed to not only to go beyond compliance and make sure that we give the highest quality of products and services to our customers. And that's always been our focus.
So on the cigarette business, the taxation bit had an impact, and that was pretty evident in the numbers as well. How has ITC recovered from that, and would you say that this is temporary still? Will there be a bounce back from that?
Well, as we said that, given the magnitude of the tax increase, our strategy is going to be around calibrated increases with architecting or building on the portfolio, so that our biggest fear is losses to illicit. We don't want to lose franchise to illicit, so we want to minimize it. But given the magnitude of the tax increase, some movement is likely to happen. But we like to minimize it, and that's why we have staged the pricing increase. So this will be a journey that we will have to traverse.
Okay. Last question, sir, on the hospitality business. How is the market performing at this point? Premium travel has come back with a bounce. How has ITC, been through that in the last 1 quarter per se?
Well, I think the hospitality sector is doing well, and we are very optimistic. The Honorable Minister also spoke about it. I think there's a lot more potential than in India. And there had been some transitory issues on account of the geopolitical developments, in particularly with certain geographies in India. But overall, it continues to be buoyant. We are very optimistic. We continue to invest, building our own properties and working with our partners to expand our portfolios.
Okay, all right. Well, let's get in Deven Choksi, MD at DR Choksi Finserv, who joins us on the show. Hi, Deven. Good afternoon. Good to see you. And you heard what Mr. Puri had to say. What's your view on ITC? I recall that the stock had gone through a period where it was totally ignored. It was around 200, 210 rupees, good dividend yield. There was a valuation argument as well, but it was ignored. And suddenly the stock ran away. Then they did that 1:1, listing of the ITC hotels vertical as well separately. At 270 rupees, how much of the bad news is in the price? And are you all interested?
Yeah, Nigel, good afternoon. Well, I think I would like to believe that the value proposition is high as far as ITC is concerned. Yes, the market as a business to react on to any kind of taxation changes which happens time and again into this particular business of cigarettes. So market does react on it. However, the value franchises that they have been building, be it in the area of hospitality, be it in the area of FMCG business, I think this company is definitely, moving ahead with the game plan. So certainly corrected price, the bad news seems to be in the price already. Could be, a good opportunity for accumulation. Maybe, one can't rule out the value proposition that this company is offering at current price.
Okay, that's about ITC. Bharti Airtel should come up for you on your screen because the stock suddenly around 130 declined nearly 1%. And as we speak, I think Bharti Airtel is still down about 3/4 of a percentage point. The reason why we saw that sudden downtake in Bharti Airtel, because in Singtel, one of the key investors in Bharti Airtel had their investor day in Singapore post the numbers, where the company reiterated its plan that's, they will equalize their stake with Sunil Bharti Mittal in Bharti Airtel. So currently, if you look at the direct-indirect holding combined, Sunil Bharti Mittal's holding in Bharti Airtel stands at more than 26%. Singtel has about 23.2% stake. The difference between the two is about 3.6%. So effectively what Singtel, and this is not new, they've been saying that, but Singtel wants to bring down their holding. So Sunil Bharti Mittal and Singtel together have the same holding in Airtel. Basically, in a way, saying that there is a potential supply headwind. Singtel could come in the market periodically with block deal. It's not going to happen in the immediate term. When Sunil Bharti Mittal joined at the investor call in May in India, he had joined on the video call. He indicated that this should happen in the next 3 to 4 years, but that intention is to equalize the stake, and therefore the takeaway is that Singtel could bring down its holding in Bharti Airtel. So therefore there is more supply on the anvil, and in a way it caps the upside. At the investor call, this is from the Morgan Stanley note, they also went on to speak about ARPUs of 350 rupees, and this is something that's been reiterated by Bharti Airtel as well. So for now, it's a bit of this fear of supply coming through, and it will come in the next 3 years, 4 years, puts a lid on Bharti Airtel. Deven, this news aside, Bharti Airtel as a stock has gone very sideways. In the last 1 year, it's given you absolutely no return. This is on the back of maybe 4 or 5 years, of consecutive years of very strong growth. But is this an attractive accumulation opportunity, 1900, or do you think this will remain an overhang?
Well, I think on one side it may remain a little bit of an overhang given the kind of supply side situation. But at the same time, I think the demand for Indian stocks, I think, as they start improving among the global investors in particular, I believe that I think such kind of stake sell, whenever it happens, I think there will be value buyers as well. The more important point out here is the Indian markets, they are being seeing consistent improvement in the ARPUs. The last quarter, they have seen about 264 rupees ARPU. And I think they are on the course to go in the direction of 300 plus as ARPU is concerned. So the premiumization process, as far as Bharti Airtel is concerned, that is continuing. And that is a positive point in my viewpoint. Yes, market will have some amount of calm time, as I would call it as, having seen the rally for last few years. I would think that I think the current sideways movement to downside, it could possibly be an opportunity to buy into this stock because among the two players, Jio and Bharti, probably I think this is where you are also getting an opportunity. Jio, of course, is coming up for a separate listing, and that's where we are expected to see that particular company in the vicinity of around 12 to 14 lakh crore market cap, which could be among the first five in the country today. So from that perspective, you might see some shift in the money happening into Jio platform from current telecom operators. But nonetheless, the current fall, or maybe I think if the fall happens in Bharti, that could also be an equally good opportunity going forward, given the premiumization drive that they're following.
Got that. By the way, with still 60 odd points down, 24,150 is where the Nifty is at this stage. Let's just look at the sugar pack. I mean, if we can pull up a few of these names. But Rampur is still down 2%. That's a larger. But there's Dhampur and so many others, UP-based companies, which are not kind of doing anything. Dhampur is down very sharply. So let me just quickly see. Dhampur did actually have a bit of a rally. So from it was 135 on the 30th of July, and from 135 basically it moved up to about $200 and is now coming off to about 171. Guys, by the way, do you know where sugar prices are now?
65? Close?
Add
Off.
5 rupees to it. It's about,
I think I must have checked maybe a week back, or maybe it was 60 there.
$60. And it used to be, what, 40 rupees, right? 35, 40 rupees, about a month and a half or to go.
In 1 month, you're saying it's gone up from 40, 45
maybe
to 70?
a little more than a month, but not
Right,
much
then
more
yeah.
than that. I mean, we just checked on Zepto and Swiggy. So, and they're supposed to be the cheapest, right?
Yeah, the cheapest, yeah.
So, Devin, any thoughts? These sugar names?
Yeah, Prashant, I think the advantage to the sugar companies would have been much higher had they been carrying significantly large amount of warehouse inventory. However, I think having seen the inventory level coming down, maybe in this festive season on a part inventory that they now carry, definitely they stand gaining benefited out of, I think, this particular price rise that we are seeing currently. So majority of it, I think, probably would be seeing a better performance in the quarter September and thereafter also. But in my viewpoint, I think one will have to be a little bit more careful in trading this particular area, because on the other side, next year UP election is also coming in. Subsequently, down the line, I think the sugarcane prices, if they are increasing, then in such situation, again, I think the volatility in the stock price will happen. So a little bit more care is required. At this point of time, I would like to think that there is a tailwind which is strong, but at the same time, I think the upside could be probably limited, if not over at this point of time.
Yeah, the best of the gains perhaps behind. Deven, stay on. We want to talk about the capital goods space. United States is tightening the curbs on foreign-made grid equipment. But analysts say this move basically trying to restrict sales from China. But that opens up an opportunity for Indian equipment makers. So Vinny joins in with more and with her analysis. Vinny?
Hi. So yes, like you mentioned, right, there's an executive order that was signed around this morning where President Trump has actually said that they're going to be restricting U.S. purchase and imports of foreign-made power grid equipment. Now, obviously, this is coming in at a time when we're seeing so much demand that comes in for transformers, grid infra, BESS, generators. The demand for all of this is increasing because of whether you look at data center there's an increase. There's an increase in terms of defense manufacturing, increase in terms of grid infra. So this restriction is coming in, but mainly this seems like it's coming in for more of Chinese players. This is what analysts are highlighting. They think that this curb is only to crack down that China player coming into US and spanning across, whether you look at transformers, BESS, grid connected inverters, turbines, including some software side of industries as well. So because of all of this, this curb is coming in, and this becomes a benefit for Indian players, because Indian players, not all of them have so much exposure in the US, right? China is the one who was exporting more to the US in terms of all these products. So now Indian players, whether you look at GE Vernova TLV, Hitachi Energy, CG Power, APAR Industry still has a relatively bigger chunk in terms of US market share versus other players. But yes, all these will start benefiting from this one. Competition will start reducing, and that is why it is we're seeing that these players are buzzing in trade, though we're still waiting out for more clarification in terms of the list of vendors that are included in this US restriction list, as well as in terms of which are these equipments. Any clarity on that front as well? We'll wait out for that, but surely some bit of a positive sign seen for these players today.
All right, thank you very much for that. We also discussed this with Renu Baid Bugalia of IFL Institutional Equities. Listen into her views.
In terms of beneficiaries, the transformer manufacturers who are in a long lead time as an equipment supply in the US tend to be the first run of beneficiaries. CG Power already has orders from there. Siemens Energy also has some orders. And recently we had seen GE Vernova management also mentioning of some orders for the US data centers, which were under discussion as part of the RPT approvals which they had taken. So we definitely see these companies benefiting. So while this executive order doesn't specifically mention China, but this is implicit for Chinese vendors here. So this would impact the entire grid equipment value chain, where there have been relative presence of the Chinese vendors. Indian vendors' presence is still relatively limited, but they will definitely benefit with the 10-15% space which would be vacated by the Chinese vendors in forthcoming orders.
Devin, on many of these capital goods equipment makers, such a strong run they've had. And we were chatting with Harish Krishnan earlier, and he said there will be earnings growth. The AI theme is strong. It's not going to let off anytime soon. But his concern is only with the fact that most investors and funds are already overweight. So the space has become crowded. So even if you get strong earnings, the potential for re-rating from here on is limited and therefore upside capped. So he says, I like the space. It's not that I dislike it, but I would be cautious about putting incremental money into capital goods related spaces. What will your view be?
I think certainly there is a case to remain bullish about, I think, this particular space when you are having a view of at least 5 years, because I think the amount of business that most of the power ancillary companies are going to be executing in next 5 years, given the size of the orders that they carry, I think is going to be probably one of the best in their lifetimes, as I see it. And given that possibility, I think certainly the outlook remains very, very bullish. However, having said that, most of these companies are adequately priced today. Valuation-wise, I think they are not cheap. And at the same time, market does give opportunity in some of these companies, especially when I think the hands changes in the cap table. So given that kind of possibility, whenever I think one gets, that would be the right time to possibly pick up some of these companies. So I don't see the possibility of the larger fall into the stock prices, but even if I think it is 10-15% kind of a fall in a given situation in the market, would be a meaningful entry point into some of these companies.
Okay, all right. Devin, I wanted your view on Happiest Minds. You know, our sister concern, CNBC Awa, says that ITC Infotech is looking to get into a deal with Happiest Minds. Now, the stock has moved to the low point of the day because as per the report that they have put out, they are saying that the deal will be done at a discount to what the stock was at. That's why the stock is down 5%. I think they mentioned a price of around 400 rupees. What's your view on this name? The pricing will be interesting. And if the deal goes through, do you think it's a bit of a big event for shareholders? Or this, if it happens at a discount, you won't be too interested?
Well, I wouldn't know the price and the discount, at least at this point of time, because still it is, I think, a pure viewpoint. But the fact remains that I think Happiest Mind going in the fold of ITC Infotech sounding reasonably an exciting kind of an opportunity for ITC Infotech particularly. That company has been executing their game plans, I think, very systematically over a period of time. And Happiest Mind possibly needs, I think, a good amount of parentage support as I see it. So should that happen? Nothing like it. But as of now, since it is a guesswork, I believe, I think we will not be able to participate beyond the point in forming of a view.
The all-time high on Happiest Minds was closer to 1,500 rupees, I think 1450 thereabout. The recent 52-week low was about 330, but the stock has seen quite a bit of a correction from the top. 1450 was nearly the all-time high, and I think in the last 5 years, like we've seen with the rest of the IT pack, there haven't been any returns given by Happiest Minds to shareholders. But the street is always ripe with speculation because Ashok Soota is old at some point. There could be some change in the promoter and ownership structure of Happiest Minds. That's the stock for you are down 3.5%. Devin, ICICI Pru AMC 4% down on the back of that offer for sale where the promoters are selling about 2% stake for minimum public shareholding compliance. Is this an opportunity at 3,000 rupees?
I would think so, Rima. I think this is a company where probably one would like to latch on to such kind of possibilities. Whenever the cap table change happens and I think the offer is available, this business, I think, definitely remains among the topmost businesses in the AMC space. Given the kind of size, given the kind of profitability that they have been executing, I would like to think that any corrected price is a buy opportunity for this stock.
Got it. Okay, all right. Thanks, Devin, for joining in and giving us your view on all of those stocks. Have a good remainder of the day. Well, let's do a quick check on the FNO market then. The call writing has been continuing very, very aggressively. And because of that, the PCR now has come down. A few sessions ago, it was closer to around 0.9. That's come down to around 0.75 or thereabouts. And just take a look at the open interest built up at around the 24,200 call. The premium's down to around 115 rupees. At the end of yesterday, it was around 200 rupees. So sharp downtick is what we're seeing out there. And close to around 80 lakh shares getting added. 24,300 call as well. Premium's down to around 70 bucks. And out there, the premium, in fact, was at around 134 rupees just yesterday. So it appears, as of now at least, the PCR is heading towards that 0.67, 0.69 odd level from normally where we do see a bit of a bounce. So we'll have to keep an eye out on that front. In short, the bears believe that they are going to defend this 24,500 or thereabouts mark because there is a bit of exhaustion that's creeping in. But I think closer to around the 24,050, 24,000 mark, probably you get a bit of a bounce. So we'll have to see how that goes. Individual stocks, two stocks on the radar. Numerous times have been mentioned that Kalyan Jewellers, something's going on there with regard to the kind of long build up that we're seeing. Is it euphoria? Is it, people being too euphoric on the stock? We'll have to see. But every time it goes to around 580, 590 rupees odd, the stock is seeing a bit of a bounce. 650 rupees, that's the level from where it did retrace the last time around. So you want to keep an eye out on that. CG Power, the stock saw a sharp correction, shorts are getting built up, and now gradually you're seeing signs of those shorts covering out. The stock is moving to the high point of the day, open interest is a little bit lower. And one of those stocks that's actually been a big underperformer, if you look at it in comparison to the headline index in the last 18 months to around 24 months, has been Kotak Mahindra Bank. But last few days, good amount of buying is what you're seeing, delivery-based buying as well. So I'll keep an eye out on this name, one of those that hasn't really participated in the rally that we've seen in the last few years. And this one has been seeing a good amount of long build-up. I'm not sure about whether or not there's news to follow through, but it seems the street is building in some expectations, which explains why that stock, in fact, is seeing a fair bit of long build-up, particularly in the last few trading sessions. Well, I'll tell you what, we'll slip into a short break. On the other side, though, our Alpha Manager of the Day, Deepak Shenoy of Capital Mind Mutual Fund, is waiting for us. Stay tuned.
Welcome back. Deepak Shenoy is with us. He's CEO, Capital Mind Mutual Fund. Deepak, good afternoon. Good to have you with us here. Thanks very much for joining us. You know, it's a space, at least I've not brought up with you in my memory, is sugar. And I don't think it's like a institutional favorite or anything of that sort. You know, every couple of years you have this price surge which happens, perhaps a bit pronounced this time around. Have you looked at the space? I mean, has it showed up in your quant models, for that matter, or in any of the other evaluations?
So, Prashant, firstly, I think sugar is a political favorite, not so much an institutional, and perhaps they're linked. That's why it's probably not, institutionally such a favorite. The problem in this space is, I mean, there is so much uncertainty. It's not because your plant is more efficient or that you're able to, process more or anything like that. The whole input and output prices seem to have political ramifications. Prices of your product, of your inputs are determined by whatever the government decides is the price that you need to pay. The farmers have to give you their sugar. It's one of the rules of what it the rules of the land are, and then international sugar prices also determine what you can price your product at, and sometimes that's de-linked to what you can do locally because there are other impacts to it. So therefore, it's not a great industry to kind of look at from a long-term perspective. There are short-term moves in this industry which kind of help a few players. A lot of bankruptcies also that happen in this industry that causes some other players to buy more capacity and therefore grow inorganically. That would be the only kind of interesting data point in the sector, if you may. They do appear sometimes in our quant models because if you base something on price momentum, they score relatively higher. The quality of earnings, not so much. They tend to become value stocks at the worst times in the up cycle because their earnings goes up on a cyclical basis. The prices tend to not go up so much because everybody knows this is not going to last too long. And, some of them show up in quant models, but I think if you ask me fundamentally, I would just be not wary of taking them as a long-term position. In the short term, news, politics, things like that drive a lot of the attention towards these stocks. They have traditionally not been great long-term stories.
Deepak, two stocks which seem to have made an entry into your flexi-cap portfolio, not there before. I think one is Capri Global and the other one is Radico Khaitan. So correct us if we are wrong. But if you have indeed added these, can you tell us the reason behind it?
Yeah, the reasoning of why they come into our flexi-cap fund is more quantitative in nature. So it's a combination of their price momentum, the value criteria that we look at, and also in some way the profitability. So I think all of those scores, when they become relatively higher than the rest of the players, these stocks will show up in our portfolios. They are not necessarily stocks that we would have said, oh, we've done a lot of ground level research and talk to their customers or talk to the suppliers and so on, because the quantitative model just assimilates data from various sources and brings it forward to us, scores them relatively higher than the other stocks. On these stocks, one of them is a liquor stock. So there has been an improvement in the financials in the last few years, and the prices also of the stock show price momentum over the last year, and that has also caused it to become better in our models, and therefore we look at it as one of the stocks that we have in our portfolio. We have more around 30 to 40 stocks always in our portfolio. So there is a combination of a lot of such stocks that will add up. I won't necessarily comment on the specific fundamentals that have driven us because that is not exactly what would have driven us to buy it. If you continue to show profits growing at where you are, if the stock market continues to price your stock at the levels they are, if the valuations continue to be attractive compared to the rest of the pack, they will continue to be in our portfolios. If there are other stocks that come and become better than them, in likelihood, they might get replaced by someone else. So in that sense, we are a little agnostic towards the stocks themselves, but more concentrating on the data that shows us they're continuing to be what they currently demonstrate, that we keep them in our portfolios.
Hi, Deepak. Good to see you in. Deepak, talking about the few stocks that you'll have in your portfolio, and thinking the Flexi Cap Fund, you have Welspun Corp as well, right?
We do.
What do you make of the news flow? A pessimist would say promoter entity is coming and selling it, but promoter entity has put in a lot of work, to get the business to where it is. They have scaled down on the India capex. They focus more on the United States. Then they turn their attention more to the Middle East rather than trying to push up Syntex. So I think strategically they have been right as well. Market capitalization was 1,500 crores approximately 6 years ago. And the entire company now is more than 50,000 crores. They're doing a block of 2.5% and taking off 1,500 crores. You think that's par for the course? Because, the EBITDA is expected to go up. So that's what an optimist would say. But a pessimist would say, why is the promoter coming and selling? How you feel as a holder?
So as a holder, it's not a major problem when the promoter sells. And remember, the stock price, while it kind of corrected on that particular day, there was news flow before that as well, where they were getting an order from the AI part of the US universe, where they were getting a fairly large order for the pipes that they were making. And then there was that itself adds a lot of heft to the fact that hopefully in the long term their earnings will grow. Again, like I said, we have no it's a quantitatively run portfolio, so it's a combination of their past financials and their past price performance that would give us the confidence that this is going to beat in the longer term. But if it doesn't, it will move out. However, this promoter sales in general do not cause us a lot of consternation. If the promoter was to say, I'm no longer going to be a promoter, that may be a cause of concern in general, right? So I would say at this point, if you're taking out a small percentage of what you invest or what the investment is, this is not a major concern. And this has happened in a lot of stocks. There are stocks which do instant commerce, where the promoter has sold multiples of this in the market. And of course, they haven't announced it as a block deal, but it has happened slowly on a day-to-day basis over years. And that stock continues to be loved, and nobody says that, that this is going to be a big problem. And there, the promoter owns substantially lower stakes as well. It's not really that when the promoter takes out money, that it would be the end of that business. And where they are, the positioning is interesting because they're in the US, so they get hit less by American tariffs.
Correct.
Because they're already in the US, right? So that gives them that little bit of a structural advantage.
In fact, it works to their favor because they have a business that's set up in the United States. Deepak, another one of the stocks in your portfolio is RR Kabel. You can correct me if I'm wrong on that one. RR Kabel, the cables and wires player. Oh, what a dream stock to have, right? I mean, everyone's talking about the markets moving sideways or a little bit with a negative bias. This stock is up 80-90% in this year itself. Now, in the next 10 days or so, Ultratech will be coming into the cables and wire space. The news could be discounted. When they announced it first, all these stocks sold off. But that turned out to be the best buying opportunity because all of them have moved up from here. What would you do sitting on these sort of gains? Will you ride it longer, or do you think now, why do you take that situation where you have a large name coming in there, conglomerate with reach, with good amount of money power as well? How do you approach the space from here on?
The promoter group there, to be honest, Nigel, have come in and they've disrupted the paint industry at some level, right? So there is possibility that they could come and disrupt over here as well. However, I think I would rather respond rather than predict that they will take over the space. This has been a very interesting space. It used to be like a Havells that used to almost have a primary big leadership there. And now it's a combination of Polycab and KEI and RR Cable that's come in now, and a lot of other players also that have been able to get in. The demand in this industry has increased quite substantially. And overall, I think, the space has grown by itself. So will a new player coming in come and destroy the industry itself? Remember, the paint industry wasn't growing to that magnitude when a new player came in, and then, of course, market share had to be divided. Here, you've got a space that is actually growing quite substantially, 25-30% a year in many cases, in many of the sub-industries there. So you actually have the potential for a new player to come in and for current players to also do quite decently. Having said that, let us wait and see if there is an actual impact on the ground in terms of the financials, in terms of the margins, in terms of growth. If there is no such impact, then we should continue to hold it. It will score high in our models anyway, and we will hold it. But if it were to get impacted, automatically the data would reflect that this has deteriorated, then we'll have to sell it and buy something else. We are more not fans of predicting what will happen because the news itself is not what's going to drive the financials. It is eventually going to be the data, the earnings, the numbers, the revenue, and the PAT that is going to be driving, at least for us. Even if you have to react late, that's fine, but it's a response that's better than the prediction.
All right, we will leave it here, Deepak. Thank you very much for joining in. Get into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. Stay tuned.
Okay, welcome back. It's past 3 o'clock. Markets are still down, sulking 60 points lower. And market breadth is pretty negative as well. 2,100 down and about 1,260 stocks which are higher. It's at least headline indices have been in a tough spot. And now, of course, over the last couple of days, the broader market is has started to run out of steam in that sense. Well, Nimish is now joining in with the D Street Chatter, what he's picking up from his conversations. Nimish, take it away.
Hi, Prashant. Another lackluster day of trade. And again, the volumes have actually fallen as well in the broader market. So it looks like there is a lack of participation from the retail and HN investors. Even on the institutional side, of late, the focus seems to be largely on the blocks and the supply of paper. Every day we are hitting at least 2 or 3 large blocks, which is sucking a lot of liquidity as well. So that's the reason why, on the Nifty and in the large caps, it looks like the upside is capped. In the broader markets, it's basically on a sector rotation, so to speak, on a daily basis. Today, we are seeing a bit of profit booking in the NBFC, gold NBFC names, as well as the metal stock, which have seen a bit of a rally of late. So, kind of profit booking in those sectors. But broadly, there is lack of participation with the volumes on the lower side, and there is a bit of fatigue as well because there is lack of momentum in the broader market. So, the supply of paper seems to be our biggest worry, at least in the near term, from a momentum point of view.
Indeed, even today we've had more than, I think, 4,500 crore in terms of a supply, the large one being ICICI Group, but Fuseco, Finance, and some others were also a part of the block deal. But what about stocks, Nimish? What are you looking at?
So the first stock is SAIL. That's been under pressure today. We've seen a bit of momentum building up, and finally, and today we've seen a bit of a sell-off as well. A bit of profit booking, I would say, but again, there is a fear of a supply of paper coming in SAIL. So government owns 65%, and we've seen the kind of OFS which has come and hit the PSU companies. So that's the fear as far as SAIL is concerned. The second stock is Alchem Labs. After results, we saw a bit of a pullback rally. But again, in this pullback, my sense was one of the domestic mutual fund was a seller. Large part of the selling seems to be largely over, and the big supply has been absorbed by some other domestic mutual funds. So that's the reason why you might see a bit of a pullback rally in Alchem Labs. The third is Paytm. We've been covering Paytm for a very long time now. Big rally in that name. Some domestic mutual funds have added as well of late. Even in the last block, some larger FIs and DIs bought. Interestingly, after the recent up move, one of the long FI long only fund is a seller in Paytm, and purely on profit booking, but a bit of supply has come in from larger FIs in Paytm. And the last is Segility. Been an extremely range bound stock for almost a year now. Been in that range between 40-45. Now the city is anticipating a corporate development, a potential big global tie-up could be on the card. So that's a buzz as far as Segility is concerned.
Yeah, Sagility again has been around that 40-45 mark for a long time, right?
Yeah.
This one is, I think, PE owned, right, Nimish?
Yeah, yeah.
So
correct. And
yeah, go on.
No, so PE owned, part of the PE selling has also been done with. So large part of the selling also has been done as far as Segility is concerned. Now the buzz is that maybe there could be a large global tie-up. So something to watch out for in Segility in the very near future.
Is it a M&A or like a business tie-up?
It's a business tie-up. It's a business tie-up, not an M&A. It's a business tie-up.
Okay, all right. Well, we'll keep an eye. Sagility, there's Paytm, Alchem, and SAIL. That's D Street Chatter. And these names, two of these names are essentially actually got a bit of a sell side kind of skew, and the other two perhaps on the other side, Alchem and Sagility, on the positive side. Well, we have Mitesh now back with us with what he wants you to buy, sell for a reverse trade tomorrow. Mitesh, what do you have?
Yeah. So, Prashant, two sell calls actually. RVNL is breaking down and making a fresh low. So STBT with a stop at 218.5 or 212 as the target. Little bank, I have negative here. The stock still looks weak and corrective. So STBT here with the stop just about 346 for a target of 338.
Okay, all right. Thanks very much, Mitesh, for that. Sudeep Bandyopadhyay is with us, and we're just sort of, running into the cash session in about 2 minutes' time. So that's a closing auction session. So 315 regular prices will stop, and you've got the rest of the market, which will, at 320, start trading. I mean, stocks with F&O contracts on them, which starts trading at about 320. Sudeep, good afternoon. Just talk about exchanges. So they seem pretty divergent. MCX is coming off the highs today, but it's done well. The other one listed for now, before, of course, NSE is listing, the only one is BSE, which has come off quite sharply lately. Any thoughts here?
Well, we have been liking, Prashant, MCX for a very long time, and we still believe that MCX is worth picking up from a long-term investor's portfolio. This is on the back of the fact that there are multiple opportunities for growth at MCX, with newer contracts and newer types of contracts getting launched over the next few years. So MCX definitely should be in the buy list of people wanting to participate in the entire BFSI space. As far as BSE is concerned, there's nothing fundamentally wrong, except the fact that there was a lot of excitement built around it, thinking that NSE will get only listed there and the entire trading volume of NSE will be at BSE. But now I understand from reports that I think NSE is trying to list themselves on the permitted category in NSE itself. And that will probably take some steam away from the excitement at BSE. But having said that, I think the NSE listing will create excitement in this entire exchange space. And we may see, again, valuation moving up as far as BSE is concerned.
Okay, all right. Hi, Sudeep. Good to see you, Ben. Sudeep, what about Kalyan? You have been positive. Going from strength to strength, what level would you be satisfied and take your money off the table?
Well, Nigel, I've been liking Kalyan for a very long time. And, I'm not comparing with Titan. Leave that aside. And, that should be in your stock list always. But Kalyan are doing multiple things right, including the franchising model for expansion, both in India as well as West Asia. That kind of preserves capital and the margin improves overall. They also are moving into Northern India as well as West Asia, where the margins are higher compared to southern part of India, which was their core area. And the third and most important thing is the Scandia brand, which they have launched, will compete now with the other brands of Titan, which is affordable jewelry. So I think the expansion of Scandia will give them one more lever to play with. So we are positive as far as Kalyan is concerned. We think even if you have kind of 1 year kind of time horizon, even now if you are invested in Kalyan, remain invested. We are looking at about 750 1 year target.
By the way, the recent listing, Lalita Jewelry, have you looked at it?
I have, Prashant. I think it's a fantastic company. The promoter is very, very dedicated as far as gold is concerned. He has built a fantastic business. But remember, I don't want to compare them with a Titan or a Kalyan. They are a regional player focused on a region. So maybe comparing with Thangamile or a PN Gadgil will be more appropriate because they are in that region. They want to expand a little bit in and around the region, but they are region focused. It's a good company, again, as far as Lalita is concerned. They got the listing pop as well. If somebody has to buy it, maybe hold for some time before you take a bite.
Okay. I mean, if you were to compare it against Thangamile, it's if you give the Thangamile valuation, this is it's got a lot of room to run. Some of the others are more reasonably priced. Thangamile, of course, at some 2 times sales as compared to some of the others. I wanted to ask about Dhoot Transmission, which is the other recent listing. But before that, let's just address Tata Power as well. So the stock is in focus after losing a $490 million arbitration challenge in the Singapore arbitration court. And Vivek is here with details. Vivek, take it away.
Well, that's right. So, late last evening, the company updated the exchanges. What they said is that the Singapore International Commercial Court ruled in favor of the company that Tata Power was actually fighting against in court. This particular company name is Scleros Capital Partners, and Tata Power has actually lost this particular arbitration. Now, remember, to give some context as to what exactly is this particular case, as far early as 2013, both Tata Power as well as Scleros Capital Partners had jointly bid for a coal mine in Russia. And post which, things went sour between both of the parties. Post which, Scleros actually had gone ahead and reached out to the Singapore court for getting an arbitration award. Initially too, they won. Tata Power had appealed that particular verdict. The verdict that has come in yesterday, again, has not gone in favor of Tata Power, implying that Tata Power will now have to pay an arbitration award of $490 million. And additionally, there will also be legal fees as well as interest that is involved. But Tata Power still does have a way out. Now, what they can do is they can file an appeal against this particular decision to the Singapore Court of Appeal within 28 days. We spoke to the management earlier today. They said that yes, that they would most likely be filing this particular appeal as well. And another thing to keep in mind is that even in an arbitration award, it will not go out as one chunk as far as Tata Power is concerned. It's likely to go out in tranches, but still a setback as far as Tata Power is concerned.
Okay, all right. Thanks a lot for that, Vivek. Explains why the stock is down, but as Vivek says, they will appeal. But let's also get in, a soundbite from the management of TD Power. Earlier today, they joined us and they gave us a sense in terms of business. They are looking at bigger generators, and they also went ahead and upped their guidance. Let's listen in to Mr. Nikhil Kumar.
We have been upgrading guidance simply because we give guidances only when we are 100% sure that we're going to be able to hit those numbers that we guide. We don't give a guidance and then we say, hey, you know what, we're going to be below that number. So we have been seeing a very positive trend in the order inflow, and there's also extraordinary demand coming from all parts of the market, not just for data centers, but it's also from grid stabilization, basic power generation, waste to heat energy. We're seeing demand coming from all sectors of the market. So we've been forced to, customer deliveries are really forcing us to make more machines within this year and also for next year, and therefore pushing up the sales, and therefore we push up the guidance. The order inflows are extremely strong. There's no let up, and right now we're in a very, very exciting period of growth in the organization. 2.7 is what I have given as the guidance, and that will be 100% met. Any further upgrades, if possible, I will call it out in November when we next have the earnings call.
Well, that is TD Power for you on the guidance upgrade. But let's get you some opinion on the markets now. Earlier today, we had a chat with Harish Krishnan, CIO Equity at Aditya Birla Sun Life AMC. He was telling us things that he's cautious on, or he would think twice about putting incremental money. And all of them are consensus trades that people are very bullish on. Like capital market players have done very well, defense, capital goods. But he thinks otherwise. So he would be cautious about putting money over here. And where he sees opportunities, new age companies. One particular one. Listen in.
Three areas that I think where we are a bit hesitant to commit more capital towards. Those three areas, to my mind, are one is capital markets, the area that we are all in. Of course, we are all very big beneficiaries of the same. There is financial penetration, all of those possibilities ahead. But there is just way too much of supply of paper. And over the course of the last 5 years, profit pools have gone up almost 20x, which meant that there is a whole host of competition coming our way as far as capital markets is concerned. The second area where I think we are a bit hesitant in deploying more capital is in defense. That's again a space which, for all the right reasons, ordering has kind of come through. Given the nature of government being the largest paymaster out here, we do think that working capital is significantly stretched as a whole. So while near-term growth is good, we are a bit wary of very high working capital, and therefore this requiring significant amount of dilution. This is very similar to what railways was, say, about 18-24 months, and therefore that's again an area where we are not wanting to commit capital towards. The third is, of course, the capital goods space, especially those that are large beneficiaries of the AI trade. And of course, it is something which has taken the world by storm. Auto angs, I still think that there is still a reasonable amount of steam out there in some very well-run companies out there which are doing differentiated work. And there is a lot of, we've done a lot of FTA agreements with Europe, with UK, with, the Oceania segment, Middle East. I would think that, markets have opened up for India, and a falling currency has kind of further strengthened our competitiveness.
right, welcome back. Well, Welspun India, they're saying that the operation at Vapi has resumed. There's an assessment by insurance companies appointed surveyors, which is currently underway. Oh, interesting. The stock has been a big outperformer. If I look at it in the last, 4-5 months, the entire textile group, the entire pack, whether you talk about Welspun or you look at a KPR Mills, Indocount, all of them have done pretty well. Sudeep, what's your view on these stocks and Welspun Living, if at all?
Well, I think, as you rightly said, these companies have kind of outperformed the market. I think a lot of things have gone in their favor, whether it's a UK free trade agreement or the forthcoming EU agreement, which I think the minister is saying that by December it will get executed. This all does benefit these companies. Of course, the US agreement is kind of under still not sure when it's going to happen, and that can create some confusion. But they are good companies with a solid business, strong client base, and these agreements, FTAs, are helping them in a big way. So I'm positive. A little bit of risk is there because of the US FTA not getting signed in the near future, or some incremental tariffs getting levied on India by the current US administration. But I am definitely positive. Of course, the valuation is not cheap. So if somebody has to buy one of these stocks, I think I will go for Indocount.
Okay, all right. Got that, Sudeep. Well, that's the one on Welspun. Okay. Sudeep, one quick word with regard to the Vedanta Group companies. A lot of news reports. The management says that they're not looking at selling any of them. What's your pick? Because you liked it as one entity. Now, after demerger, what do you like?
Well, forget the transaction and inorganic, what they may or may not do. Fundamentally, Vedanta Aluminium as well as Vedanta Limited, which is basically the Hindustan Zinc. I think these two are my favorite stocks, and they are definitely going to do well. All the factors indicate to that. Vedanta Aluminium, the aluminum prices globally are strong and are expected to remain strong. The cost benefit which Vedanta Aluminium will get through integration of their facilities, completely is going to be significant, and their cost and their margins will improve significantly. So Vedanta Aluminium, definitely, it went up and then came down after correction. Now it has moved up a bit, but still it's worth buying at current levels. Vedanta Limited, of course, Hindustan Zinc. We all know the zinc story, the silver story, and I think the company itself is doing very well. The dividend flow is very strong and expected to remain strong. There is a bit of an overhang on, as far as when the government will sell.
I think we're losing the line with
in Hindustan Zinc, and that may pull down the Hindustan Zinc prices.
Yeah, we're losing the line a little bit, really. The Sensex, that's the graphic. With the Sensex, there is a 290-odd point, change. So what? I mean, 0.7% change, which is not how much? It's not a 0.5% change.
So we were down to 90 points, and now we're down 540 points. So I think at close, it's a cut of 540 points.
Yeah, difference is 250 points, basically.
Yes, because at 315, we were down to 90 points on the Sensex. So the difference is
which is not small, right? So I'm assuming, on Sensex, option prices again, because futures and options will trade till 340. You look at the price at 320, 325, and you look at the price now, which is as soon as the price is discovered, the final price is discovered, you'd see swings. We've seen this before. And I suspect, Nigel, today, have you looked at the prices?
Yes, 77,100 put. Let's get that up for you on the screen. At 315, it was around 36 to 37 rupees. Now, after this CES session has got done, that premium has spiked up to 202 rupees. Oh. So 37 rupees becoming 202 rupees. 77,200 put. The premium was around 66, 67 rupees. I think Divya is going to pull two of these plates up for our viewers on the screen. And you have the premium now, which has moved from around 66 to around 130 rupees or thereabouts. So that's the swing factor that we're seeing. And obviously, I don't think we should get that one up. We'll just correct that, I think so. So we'll get that shortly up for our viewers on the screen. But there's a big surge in terms of a premium. 77,100 put premium spikes up, 77,200 200 put as well, the premium spikes up. We're looking at this contract, which is 27th of August. So that should come up for you on the screen as well. So cash session goes to the bears yet again. Sensex ends actually lower, which in turn has led to a big spike on the put side because today was the expiry for the Sensex. Well, we'll thank Sudeep on that note, and we'll wrap up on this edition of Closing Bell. You stay with us. The team of Markets Forward comes up next.
Markets remain under pressure to hit one-week low. Nifty slips below 24,100. Selling is seen across key sectors, with investors remaining cautious amid mixed global cues.
Tata Power faces court setback in a $490 million arbitration case. The Singapore International Court dismisses Tata Power's challenge of the award in favor of Kelleros partners. Tata Power says it will appeal the verdict, but the stock takes a hit.
US power grid import curbs spark rally in Indian power gear stocks. The US declares a national emergency to restrict import of power grid equipment. Move seen as targeting China, with analysts saying it could reduce competition for Indian exporters.
and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear up for the next trading day. I'm Ritu Singh. With me is my colleague Vinny Motiwala. Hi, Vinny. Let's kick things off with the day's market action. And it was a weekly low almost for the Nifty, below that 24,100 mark to close the session. And there was selling pressure across most sectoral indices. If you look at individually where the drags were, whether that was the IT pack or the banking pack, all of that seeing pressure in trade today. Even in the broader markets, the mid-cap index closed down with a cut of 65 points. The small-cap index also closed in the red, and the advanced decline ratio shows you that the market breadth was not so positive. You had almost 2,100 stocks that were on the decline versus about 1,163 that advanced in trade today. Vinny.
Hi, absolutely, Ritu. Rounded up the market well. The only sector that was managing to hold on to some bit of a green was pharma as well as realty. That's the only green today on the screen for us. But, well, here's a lineup for y'all of what we have in store for y'all today. We'll start off with the top movers and shakers of the day with Vivek Iyer. Then from Tata Power's legal setback to the US boost for power equipment players. We'll decode all of that as our top stories for today. And last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session.
Well, with that, let's get to our first segment of the day. And Vivek Iyer joins us now from the big wall with the top movers and shakers. Vivek.
Well, thank you so much for that. Once again, in another session, quite volatile, not doing so well as far as September series is concerned. In terms of individual stocks and sectors, what is it that we are tracking? Well, today you couldn't take your eyes off the entire power equipment space, the capital goods space. A sentiment boost coming in as far as the US action is concerned is something that helped most of the capital goods stocks end the session significantly higher. BHEL up almost 4.5%. CG Power, Hitachi Energy, all of these names up anywhere between 1% to 5% each. The other set of stocks that did very well was the entire Vadia group. Some positive news flow coming in over there. So BBTC did very well, almost 12% higher. National Peroxide, Bombay Dyeing. All of these stocks on good volumes did very well in the session. NMDC Steel, continued to hold on to its gains through the trading session. So that was another stock high up almost 8.5%. Towards the end of the trading session, you did see a pop come about as far as most of the pharma names were concerned. So in the last hour, you did see some buying emerge in names like Xylus Life, Loris, Torrent Pharma, Cipla, all of these stocks ending anywhere between 1% to 4%. And lastly, especially looking at some of the pipe and tube companies in the steel space, names like Welspun Corp, Jindal Saw, Ratnamani, all of these stocks managed to end the day with gains. On the other hand, quite a few drags as well. Gold Finance yesterday took it on the chin among the top drags, even as far as the FNO space is concerned. Manappuram down almost 5%, Muthoot down over 4%. Tata Power, the arbitration setback coming in as far as Singapore court is concerned, led to a bit of a sell-off over there. Hindustan Copper continued to languish in trade, has been a significant underperformer in the recent past, down over 3% today. And Ramco Cement, that particular stock in the broader end of the markets, underperforming its peers, down over 5% on decent volumes as well.
Vivek, thank you so much for that, for highlighting the stocks that were moving around today. But one of the things Vivek highlighted is also the power equipment company names, right? They were all surging in trade. And this came in after US declared and, has signed an executive order, President Trump. This is mainly to restrict US purchase and imports of certain foreign-made power grid equipment players as well. So that is what we are talking about. Now, this details of who are the vendors, who are the equipment players, the list of all of this, we're still waiting out for that. But what are analysts saying on this front? This is primarily for China. They believe that this is for snapping and closing down on China's imports that come in to the US. So across transformers, generators, BESS, then you have grid connected inverters, turbines. China has a lot of exposure here. So they want to cut down on that exposure is what analysts are highlighting. And especially at a time when you're seeing an uptick coming in for data centers, manufacturing in defense is increasing, grid infra is increasing. So at such a time, who will benefit in India if China has given a restriction over there? So we would see players like GE Vernova at TNT, Hitachi Energy, CG Power, Apar Industries. They already have some bit of an exposure there, but this gives them a chance to increase their exposure to the US market. And in turn, less competition obviously is something that will benefit them. And that is why we saw an up move coming in all these stocks. But let's move on and also bring on board our guests for today. We have Sudeep Bandyopadhyay from Indie Trade Capital as well as Ruchit Jain of Motilal Oswal Financial Services joining us on the show right now. Ruchit as well as Sudeep, thank you so much for joining us on the show. Sudeep, let's take a quick check in terms of all these capital good players. They've already seen a very good run. Now, if this restriction is coming, we're still waiting out for details, obviously, on who these restrictions are for. But if this comes in, it's surely a bit of a positive sign that comes in from Indian players. But is there room for more upside from here on as well, given the valuations?
Well, you're absolutely right. Given the valuation, a lot of it is already baked in. And in fact, we've been talking about for quite some time that some of these companies with a global parentage are in a unique position to cater to global markets. Of course, this executive order will expedite that process as far as US is concerned. And because assuming the Chinese equipments get banned, so the competition will be reduced. So this is good news for GE Vernova, Hitachi Energy, and the others. But yes, the valuation is rich. And if somebody wants to enter these stocks, there's no harm, but they should plan for a little longer duration. It's not that you will get a big upside immediately. These things do take time. So if you have, 1 year plus kind of time horizon, you can look at entering some of these stocks. I would prefer GE Vernova.
All right, Sudeep, Ruchit, do hold on because it was the Sensex expiry today. Let's first go across to Nigel to understand the impact on options premiums under this closing auction settlement. Nigel, take it away.
Well, Ritu, the CAS session, for the Sensex today played out in favor of the bears because, at around 315, the Sensex rate was around 77,183. By the time we wound up, well, we went out closer on 260 points approximately. So the session went in favor of the bears. And take a look at what happened to the premiums. Obviously, the call premiums will come down to zilch, because they get totally eroded. Since the direction was down, you won't make any money on the call side. So that's where that 16 and 28 rupees, that came down to nil. But on the put side, just take a look at the moves. Because the CAS session ended lower, the premium on the 77,100 put was approximately 37 rupees. If those were the buyers, well, in fact, those that bought that went all the way to around 267. And the other strike that you're looking at is 77,200 put. The premium was around 67 rupees. Because the CAS session went in favor of the bears, that as well saw a big spike up. So the put buyers, well, they had a good time today, particularly in the last 15 minutes or so. The expiry went in favor of the bears. In fact, as is, the Sensex was lower, and the last 15 minutes further, put pressure, and that's why, in fact, you had another 200 points on the downside. Back to you.
Okay, Nigel, thank you so much for that, for explaining us about what happened in the last 15 minutes. And surely in the favor of bears today is where this expiry session ended. But on that note, let's actually take this conversation with Ruchit as well. Ruchit, what's your thought coming in terms of levels that one should watch out for now? Today's expiry, again, in the favor of bears as well. So what are the levels you're watching out for Sensex as well as the Nifty now?
Hi, very good afternoon to everyone. Well, if you look at last 7 or 8 trading sessions, what you've seen on the indices is more of a consolidation only. So the Nifty 24,000 is the immediate support, and we have ended right above that support level. And on the higher side, 24,350, 400, where the 200 EMA for the Nifty lies, that is not getting surpassed. So 24,000 to 24,400, this has become the range where time-wise correction is going on in the market. So while we do not expect any big direction move on the either side immediately in the short term, but yes, this consolidation could continue with 24,000 on a closing basis. It would be very important to watch out, especially tomorrow, because it will be the weekly close as well.
Ruchit, what are the charts telling you on Bank Nifty as well?
So overall, I think there has been sideways trend in the banking space also. But the good thing is that unlike Nifty, where this entire consolidation has taken place below its 200 EMA, the entire consolidation in the Bank Nifty is right above its 200 EMA. So which indicates that relatively Bank Nifty stands much better than what we are seeing Nifty right now. So 57,000, 5600, 800 is the major support for the banking index as well. So till this is intact, the downside should be limited for the banking space. And 58,250, once that level gets surpassed, then we should see a resumption of the momentum. So the setup that has been there on the banking and the Nifty both charts, I think whatever directional move that we'll get after this consolidation, the leadership would come from the banking space itself.
All right, take that point, Ruchit. Hold on, we have another story to focus on. We had shares of Tata Power, which were in focus today after a Singapore court dismissed the company's challenge to a $490 million arbitration award. Vivek Iyer joins us now for more details on this one. Vivek.
That's right. So, Late last evening, the company updated the exchanges. What they said is that the Singapore International Commercial Court ruled in favor of the company that Tata Power was actually fighting against in court. This particular company name is Scleros Capital Partners, and Tata Power has actually lost this particular arbitration. Now, remember, to give some context as to what exactly is this particular case, as far early as 2013, both Tata Power as well as Scleros Capital Partners had jointly bid for a coal mine in Russia, and post which things went sour between both of the parties. Post which Scleros actually had gone ahead and reached out to the Singapore court for getting an arbitration award. Initially too they won. Tata Power had appealed that particular verdict. The verdict that has come in yesterday again has not gone in favor of Tata Power, implying that Tata Power will now have to pay an arbitration award of $490 million, and additionally there will also be legal fees as well as interest that is involved. But Tata Power still does have a way out. Now what they can do is they can file an appeal against this particular decision to the Singapore Court of Appeal within 28 days. We spoke to the management earlier today. They said that yes, that they would most likely be filing this particular appeal as well. And another thing to keep in mind is that even in an arbitration award, it will not go out as one chunk as far as Tata Power is concerned. It's likely to go out in tranches, but still a setback as far as Tata Power is concerned.
Okay, Vivek, thank you so much for that. But from legal battles to fresh order wins, there were plenty of stocks specific action that we saw coming in today and stocks that were in focus. Devyani is here joining us to take us through those stocks. Devyani.
Well, first up is HDFC Bank. Now, the bank faces a US shareholder securities lawsuit over alleged 45 crore MSRDC linked payments. The complaint alleges that the payments were routed through marketing arrangements to offer higher effective interest rates, but the bank has denied any wrongdoing and will defend itself vigorously. Now, next up is GK Energy. Now, the company has received a letter of empanelment for 1 lakh grid-connected rooftop solar PV systems. The total capacity of which is about 100 megawatts, and the order value sits at around 455 crores. So that's a positive for the company as well. Coming to BEL. Now, the company has secured additional orders worth roughly around 730 crores since August 10th. The orders include communication systems, radars, avionics, tank subsystems, electro-optics, cybersecurity, as well as other defense equipment. Now, last up is Pine Labs. Now, Investec has initiated a buy rating with a target price set at 200 rupees per share. Now, the brokerage highlights strong growth, improving monetization, as well as margin expansion potential for the company, and expects 20% CAGR during FY26 till FY29 and PAT margins reaching 14% by FY29.
Devyani, thanks very much for joining in with that list. Sudeep, anything in that stands out for you from BEL, Pine Labs, HDFC Bank? HDFC, of course, the woes don't seem to end. Pine Labs, some hope with this MDR, even the likes of PTM running up.
Well, definitely, I think there is a lot of excitement around this MDR, and we know what's happening in Paytm. Pine Lab also is, I think, going to be a beneficiary of that, and I think that's why there is some excitement. But I do like BEL, and I've been liking BEL for the last couple of years, and I still believe that defense electronics is the place to be in. And yes, the valuation is not cheap, but still, if you're a long-term investor, please have BEL in your portfolio. You just can't go wrong. Whether it's the order book, whether it's execution, whether it's the potential, I think whichever way you look at it, whichever angle you want to look at it, BEL comes out winner. So BEL definitely. As far as HDFC Bank is concerned, it's a little unfortunate. A lot of things are, kind of thrown at HDFC Bank. Things are not looking too good. There is not yet stability as far as the top of the bank is concerned, with the CEO's appointment not yet being ratified by the RBI. So I would be a little cautious as far as HDFC Bank is concerned.
Okay, point taken there, Sudeep. Ruchit, coming to you. A couple of charts I would like you to check, right? One is Pine Labs. Now, Pine Labs over the last year, since, the listing that we would say on 14th of November last 2025, we've seen a fall coming in the stock. There is no respite or recovery. I know there's not much to read because it's less than a year, but given in the last 1 month, we're seeing some bit of an uptick. How are the charts looking like for Pine Labs? And also for the side on BEL and HAL, what is the view there as well on the charts and technicals?
So finally, if you see last 2.5 months, the stock has been consolidating in a range. 175 has not been surpassed since second half of May. So the first major trigger for the stock would be to surpass that and close above that 175 mark. If that happens, then we can expect a gradual recovery towards 190, 195 in the short term. But no signs of any big trended phases coming in. Whereas from the defense space, I think HAL had already recently given a breakout. But again, what is missing is the follow-up move, follow-up buying. Or we can see that recently, wherever the outperformance is there from the defense space, it has been more from the private sector stocks. You look at stocks like Adani Engineering, which has done well. Even Bharat Defense has given very good returns. So comparatively, we think that if the momentum continues for the defense space, then one should look out for opportunities within the private sector defense rather than going with PSU. The relative outperformance compared to PSUs can be seen from private ones.
Sudeep, some of the jewelry names were also in focus today. I mean, Kalyan and so on and so forth. Do you see a further upside from the run-up that we've already seen in some of these names? Any thoughts there?
Well, from a long-term perspective, we definitely like Kalyan. I'm not bringing Titan into the discussion. That is definitely a good stock. But Kalyan definitely has many more levers. The Candier brand, which they have launched for the affordable jewelry segment, will compete with Mia, CaratLane, and the others from the Titan fold. And the expansion of Candier will give them incremental heft as far as the overall market is concerned. And of course, Kalyan's model of expanding through franchisees is capital light, so it doesn't strain the balance sheet. So we are very hopeful of Kalyan moving to about 750 levels in about a year's time. We do like the recently listed Lalita Jewelry. If you compare, it's a regional pair. We should not compare with Kalyan or Titan. But if you compare with the Thangamile and the other regional players like P and Gadgil, it is still available at an affordable valuation post-listing pop as well. I think it came with an IPO at a very reasonable price. It's a good business, very focused in a particular region down south, and the scope for expansion is huge.
Okay. Point taken there. Sudeep as well as Richard, thank you so much for joining us on the show as always and taking us through individual names and what we could expect from them going going forward as well. But on that note, we're going to slip into a very short break. After the break, we'll come back and we'll get you the top corporate voices along with the key market events to watch out for in tomorrow's trading session.
Welcome back. You're still watching Markets Forward. Let's get you some corporate voices of the day then. Aadhar Housing Finance says it is not seeing any early signs of stress in its loan book. Its MD and CEO Rishi Anand says rise in credit costs in stage 2 assets in the first quarter was mainly because of seasonal factors. He also adds bounce rates have remained stable.
Next up, we have Indigo Paints that expects strong demand to continue in Q2 as well and is targeting September end for its Jodhpur plant to be fully operational. Speaking to CNBC TV18, the company's management said that the trial production has started with a new wood coating product to be rolled out soon. The company also plans to buy another 11% in Apple Chime, but is not looking to acquire the full business.
All right, so that is some of the big corporate voices we had on the show today. But as we had promised, before we wrap, we'll get you all of the key market events you need to watch out for to be ready for tomorrow's trading session. And there's a whole long list of that. So let's bring in my colleague Devyani Vibhute, who's standing by with some of these key events that you need to focus on.
Well, let me start with the domestic events. Now, first up, the July industrial production data is set to be released tomorrow, with investors tracking whether the manufacturing momentum has improved and what it signals for the overall economic growth. Now, in the IPO space, ESDS Software Solutions 720 crore IPO opens tomorrow. Now, moving to the global markets, the key event to watch out for is the Fed Chair Kevin Warsh's speech at the Jackson Hole Economic Symposium. Now, markets will be looking for signals on the Fed's interest rate outlook, the inflation concerns, and the future path of the monetary policy. Now, also on the calendar is the US preliminary payroll benchmark revision, which could reshape the expectations around the strength of the US labor market as well as influence the Fed rate cut bets. Now, in other events, investors will keep an eye out on the MSCI India rebalancing position ahead of the August 31st effective date for it. So these will be all the events that we'll be watching out for in trade tomorrow.
Okay. Devyani, thank you so much for that. But with that, it's a wrap on this edition of Markets Forward. Thank you so much for tuning in. Up next, we'll get you more news and updates on the other side. Stay tuned in.
Good evening. Thanks for joining us on Business 360. I'm Shriram Finance. The top stories that we're tracking for you this evening. More than 270 people dead. 1,600 are missing after flash floods ravaged Nepal. 288 Indians are among those unaccounted for. Entire villages swept away as a glacial collapse triggers flooding in the mountainous region. An oil tanker comes under attack at the Strait of Hormuz, testing President Trump's claim that the waterway is functioning. Shipping traffic remains largely at a standstill. Crude oil prices down 7% this week. Qatar's Prime Minister visits Tehran in a bid to revive diplomacy. India set to host the BRICS summit on the 12th and 13th of September. China's Xi Jinping, Russia's Putin, along with Iran's president expected to be in attendance. This comes amidst U.S. efforts to isolate Iran by threatening sanctions on its trading partners. Sensex down over 500 points. The Nifty declines over 100. The Lal Street remains under pressure. The rupee weakens against the dollar, moves closer to the 96 mark. Z promoter Subhash Chandra's bankruptcy settlement sparks controversy. The company law tribunal approves a 99.97% haircut to creditors, allows Chandra to pay just over 6 crore rupees to settle claims worth more than 22,000 crore rupees. A 45 crore rupee payment to the Maharashtra Road Corporation comes back to haunt HDFC Bank. The lender faces class action lawsuit in the US over allegations of violating securities law and causing losses to investors. Bank says the lawsuit is without merit and intends to vigorously defend itself. The stock hits a 52-week low. Shares of Tata Power hitting a 7-month low after a $490 million legal setback. Singapore International Court has upheld an arbitral award in favor of Kleros Capital in a decade-long dispute. Tata Power plans to appeal against the verdict. The environmental clearance to Google and Adani's proposed data center in Visakhapatnam faces legal scrutiny. Affidavit filed by the state regulator shows the approval exempts the project from central government approval, environmental impact assessment, and public consultations. Nvidia reports blowout quarterly earnings with profits doubling to nearly $54 billion. Shares rally after Nvidia expects revenue to grow 70% next year. Facebook and Instagram agreed to enforce a 2-hour daily limit for American users under the age of 18. The apps will also go dark from midnight to 6 a.m. All of this is part of a $17 billion settlement over child safety. Meta also writes an open letter to rivals YouTube and TikTok, asking them to accept the same restrictions. Well, the top focus this evening is the conflict in West Asia and the impact on global energy markets. Let's bring you up to speed with the latest developments. Now, an oil tanker came under attack by an unknown projectile overnight, according to the British Maritime Agency. Traffic at the strait remains largely standstill. According to Kepler, only 10 vessels have managed to transit the strait yesterday. Crude oil prices are down 7% this week, with Brent hovering around the $85 mark. And all of this is really on account of the hope that there will not be a military escalation. Now, in a bid to revive diplomacy with the United States, Qatar's Prime Minister is set to visit Tehran. According to a statement by the Qatari Foreign Ministry, the visit comes in line with Qatar's position that diplomacy is the best way to resolve differences and ensure stability in the region. Iran has also confirmed the visit, saying that talks will be a continuation of Qatar's mediation efforts. However, Washington appears to be in no hurry to get back to the negotiating table. In an interview to Al Jazeera, President Trump said, and I quote, "I have no time schedule, none. I'm not in a hurry," end of quote. President Trump continued to claim that Washington is winning in the conflict. Now, India is set to host the BRICS summit on the 12th and 13th of September. China's Xi Jinping, Russia's Vladimir Putin, along with Iran's president, are expected to be in attendance. Now, this comes amidst U.S. efforts to isolate Iran by threatening sanctions on its trading partners. Aishwarya is standing by with what we can expect. Aishwarya, the BRICS summit will take place in New Delhi in the backdrop of Operation Economic Outcast. What is the Indian government's position on what the likely outcome is going to be?
India has formally announced that it will host the BRICS summit on September 12th and 13th at the Bharat Mandapam in New Delhi. Along with BRICS members, invites have also been extended to partner countries and regional groupings like the GCC and the African Union. Sources say that the response has been positive, with leaders from Iran, Russia and China expected to be in New Delhi for the summit. This comes at a time when the US is threatening what it's calling the economic asphyxiation of Iran and also threatening secondary sanctions on China and Russia. For India, the summit is the culmination of a year-long diplomatic exercise. The MEA has said that more than 350 meetings and high-level discussions have been conducted across 25 cities in India. This includes 22 ministerial-level meetings and 10 meetings involving the heads of agencies. These engagements have broadly been around three main pillars, which is political and security issues, economic and financial cooperation, and cultural and people-to-people exchanges. The task for New Delhi now is to take this diplomatic exercise and turn it into a consensus at the leaders' table. This has not always been easy. If you may remember, during the foreign ministers' meeting in May, no joint declaration was reached. Sources have said that work is ongoing on a joint declaration, with Sherpa-level talks also underway. On the economic front, India is pushing for practical outcomes, which is cheaper cross-border payments, greater use of national currencies, more balanced trade within BRICS, and a stronger role for the New Development Bank. New Delhi insists that these discussions are not targeting the dollar or any other third country, but they are more about reducing transaction costs.
Ishwarya, many thanks for joining us at the BRICS Summit to take place in New Delhi on the 12th and 13th of September. Let's talk about the day's market action. The markets remained under pressure today, with the Nifty and the Sensex closing at one-week lows. The Nifty slipping below the 24,100 mark, down 0.5% low on the Nifty Bank as well. HDFC Bank down to a 52-week low, down about 2%. This on the back of the latest developments with respect to a class action suit in the US. The Nifty Mid-Cap Index closing flat, but with a red tick. So that was the story for the markets, but let's talk about the big corporate story. Zee's promoter, Subhash Chandra's bankruptcy settlement has sparked a controversy, and that is because the creditors would recover just about 0.03% of what was owed. The Company Law Tribunal has approved a repayment plan of just 6.5 crore rupees against claims of over 22,000 crore rupees. Now, this implies a haircut of nearly 99.97%. The Congress party took a jibe at the settlement, calling it a mundan and not a haircut. Ritu's here with the details. Ritu, unusual and bad news for the creditors here. What do they intend to do?
Well, a shocking outcome for the lenders involved, with the NCLT approving this repayment plan for Zee Group's founder and chairman Subhash Chandra, under which creditors are going to get only 6.5 crore rupees against admitted claims of more than 22,000 crore rupees, which amounts to a haircut of 99.97% for the lenders. Now, this case goes back to a loan that was given to Vivek Infracon, for which Subhash Chandra had given a personal guarantee. So when the loan was not repaid, Indiabulls Housing Finance, which is now Samman Capital, had moved against Subhash Chandra in 2022, with the NCLT finally admitting the case in 2024, after which other lenders who held his personal guarantees also joined in. Now, the plan had already received almost 81% voting support from creditors when it was put to vote in November 2024, but there were several large lenders that controlled almost 20% of the voting share. So LIC Housing, HDFC, Axis, Canara, RBL, Union Bank, they had all objected, arguing that almost 62% of the voting is controlled by 5 entities that are linked to Subhash Chandra. But NCLT has rejected allegations that creditor voting was skewed, and creditors also question, in fact, how Subhash Chandra's net worth could have fallen so sharply. So his certified net worth was around 45,888 crore rupees in 2017 versus the current disclosed net worth of 31.8 crore rupees. But again, NCLT says historical net worth figures by themselves don't really establish any concealment or diversion of assets. So the matter now goes back to the original NCLT bench for formal orders. But for lenders, it is an extraordinary outcome. I mean, 99.97% haircut means creditors are virtually recovering nothing. Now, the case has even prompted a jab from none other than Vijay Mallya, who's taken to social media with some visible sarcasm. He called it the Indian debt resolution justice, pointing to the more than 200% recovery that was claimed in his own Kingfisher airline case, and contrasting it with what he says is a pattern of other borrowers settling their debt at a fraction of what they owe.
All right, many thanks for joining us. HDFC Bank has already said that it intends to launch an appeal against the NCLAT order. Now, 45 crore rupee payment to the Maharashtra Road Corporation has come back to haunt HDFC Bank. The lender and 2 senior executives are facing a class action lawsuit in the US. Now, the lawsuit alleges that HDFC Bank made misleading disclosures and camouflaged around 45 crore rupees of payments to MSRDC. as marketing expenses to facilitate above-market interest on deposits. The lawsuit covers investors who purchased or acquired HDFC securities between July 2023 and May of 2026. The bank said the lawsuit is without merit and intends to vigorously defend itself. The stock fell over 2% in trade today, hitting a 52-week low on the back of those developments. And speaking of a stock under pressure today, Tata Power, the shares declined nearly 4% after a Singapore court dismissed its challenge to a $490 million arbitration award in favor of investment firm Kleros Capital. Now, this dispute dates back to 2013 when Kleros approached Tata Power to jointly bid for a coal mining project in Russia. Vivek is standing by with the details. Vivek, take us through what impact this is likely to have as far as Tata Power is concerned.
That's right. So, late last evening, the company updated the exchanges. What they said is that the Singapore International Commercial Court ruled in favor of the company that, Tata Power was actually fighting against in court. This particular company name is Kleros Capital Partners, and Tata Power has actually lost this particular arbitration. Now, remember, to give some context as to what exactly is this particular case, as far early as 2013, both Tata Power as well as Kleros Capital Partners had jointly bid for a coal mine in Russia, and post which things went sour between both of the parties. Post which Kleros actually had gone ahead and reached out to the Singapore court for getting an arbitration award. Initially too they won. Tata Power had appealed that particular verdict. The verdict that has come in yesterday again has not gone in favor of Tata Power, implying that Tata Power will now have to pay an arbitration award of $490 million, and additionally there will also be legal fees as well as interest that is involved. But Tata Power still does have a way out. Now what they can do is they can file an appeal against this particular decision to the Singapore Court of Appeal within 28 days. We spoke to the management earlier today. They said that yes, that they would most likely be filing this particular appeal as well. And another thing to keep in mind is that even in an arbitration award, it will not go out as one chunk as far as Tata Power is concerned. It's likely to go out in tranches, but still a setback as far as Tata Power is concerned.
Vivek, many thanks. Now, the Gujarat High Court has pulled up a state tax officer for relying on AI-generated case laws in a GST order. The court has quashed and cancelled the appellate proceedings against Fairs Enterprise, finding that the officer had relied on non-existent or irrelevant judgments. The probationary officer acknowledged using AI and tendered an unconditional apology, citing his lack of experience. The court also directed tax authorities to verify AI-generated case law against primary sources and warned that violations could amount to contempt of court. This is not the first time that we're seeing this happen. There have now been repeated instances of orders using AI and basically resorting to AI-driven hallucinations as part of legal orders that are being put out by courts. Now, this is a big one. Google and Adani's proposed data center in Visakhapatnam is facing scrutiny in the Andhra Pradesh High Court after public interest litigation questioned the environmental clearance granted to the project. An affidavit filed by the state regulator shows that the approval exempts the project from central government approval, environmental impact assessment, as well as public consultation. Ashmit is here with the details. Ashmit, take us through what the affidavit says. What are the points of contention that the litigants are raising in this matter, and what seems to be the cause of concern?
Well, let's break it down into 5 broad questions. Number one, why is Google facing concerns, facing challenges, facing scrutiny in the first place? Well, to begin with, there were protests on the ground that had raised concerns about environmental compliances, on what this will do as far as the local water supply is concerned. It's flagged to be a water deficit area. There were concerns raised how it sits on the edge of a forest reserve. And it is on the back of these concerns that we had a PIL that was filed before the Andhra Pradesh High Court, which again raised similar questions and also importantly sought the cancellation of the environmental clearance and also sought some kind of stay as far as the proceedings are concerned. Now, no stay has been granted, but nonetheless, the proceedings are underway. We managed to gain access to the affidavit that was filed before the High Court. Now, that is what led to answering of some questions. So that brings us to the second question. Is this facility actually near a forest reserve? Well, as per the details that have emerged in the court documents, yes, this facility that has been shortlisted for construction of that data center sits less than 1 kilometer away from a wildlife sanctuary. But nonetheless, the divisional forest officer has given the NOC, so at least in that respect, Google appears to be in the clear. Now, with respect to water consumption, this was another issue flagged in the PIL, flagged by the locals as well. To that end, The data is quite interesting. As per the environmental clearance, Google is allowed to use up to 300 kiloliters of water every day. But importantly, it will be sourced from the rural supply. There's a water reservoir just 120 meters away. And this is again something that had been flagged by various locals in their protests. Their argument essentially was, look, we can't drink data, we need the water, which again leads to the next question. Is there an impact assessment that has been done for grant of environmental clearance? Was there a public consultation? Now, importantly, the environmental clearance was granted by the state level authority, but in doing so, the state level authority exempt Google from conducting any impact assessment, from any public consultation, and also from seeking a nod from the center, from the Ministry of Environment and Forest. So no nod was required there. That's as per the state's regulator. Now, all of this will be subject to the court's scrutiny. The court's scrutiny, the court's hearing is not very fast. September 2nd is when the Andhra Pradesh High Court will resume hearing in this case. And mind you, at the last hearing, there was a word of caution that the court had issued saying that there needs to be compliance with the law of the land. The state government will have to explain its position on the 2nd of September.
All right, 2nd of September is the next date as far as this matter is concerned. Ashmit, many thanks for joining us. The devastating flash floods in Nepal have left a trail of devastation. More than 270 people dead, 1,600 remain missing. Entire villages have been swept away. Homes, roads, bridges have been damaged. The death toll is expected to go up further as rescue operations continue. As per the Ministry of External Affairs, 288 Indian nationals are among those unaccounted for. These include 73 Indians who are working on the Trishuli power project. The MEA said that 86 people are from Tamil Nadu are among those missing, while 32 are from West Bengal, 33 from Kerala. 21 Indian nationals from Tamil Nadu who travelled for the Kailash Mansarovar Yatra have been rescued in Nepal. As per Nepal Tourism Board, 517 foreigners are still unaccounted for. These include 65 from the US, 53 from Ukraine, 35 from Australia and 33 from the UK. The Nepal Army says it has rescued more than 350 people so far today from areas affected by the flooding. The US Geological Survey said that a glacial collapse may have caused the disaster and there was no earthquake. Scientists said a huge chunk of ice plunged into the valley below, picking up sediment that was already waterlogged during the ongoing monsoon season. Global aid has been heading to Nepal to support the disaster relief operations. India has sent 2 aircraft with humanitarian assistance to Nepal along with 47.5 tons of emergency supplies. The US is sending a disaster response advisor to Nepal and providing funds worth $500,000. China has also coordinated emergency supplies and cash assistance to Nepal. The rescue efforts continue.
We have received information that a number of Indian nationals who had gone on the Kailash Mansarovar Yatra are currently stranded on the Chinese side. Our embassy in Beijing is making all efforts for their safe evacuation. There are approximately 200 Indian nationals there who have sought our assistance for evacuation. Of them, 95 are in Darchen and currently proceeding to Hilsa to cross over into Nepal. 4 are in Geelong city, 13 Zutulpuk, and they are en route to the town of Saga, and 60-70 others who are also heading towards Saga.
This is the Dhunge Bazaar in Nuwakot. This is near Tesuli area. Till yesterday, this was a road. 24 hours later, all that remains is muck. You see the Nepal Prahari, Vipat Uttakarmi. These are the disaster, state disaster management forces. There are the Nepalese scouts along with other teams who are out at work. There's a JCB which has been deployed to clean the muck and make this road motorable once again. But what is the situation? You see, that's the river that Rajesh Bhardwaj is now zooming in and showing you. That river has also changed its course. There was very little time. Locals speaking to CNN News 18 said that there were very little time that was given to them. These are Nepal police officials, disaster relief officials who are trying to take stock of the situation. They can't go beyond because the river changed its course and washed away this entire stretch of road from here right up till the Tibet-Nepal border. at least 34 bridges have been washed away. That's the version coming in from the locals. Hundreds are missing till now. Many dead bodies have been recovered. But let's show you the river once again. You see the river and all these buildings next to the river. There was the Agricultural Bank Development Limited. You see how the entire first floor has been broken. The curtains tell you the story where the mud brought in by the river went up to the first floor as well.
Well, devastating impact there of the flash floods in Nepal. We'll head into a break, but up next, Facebook and Instagram agreed to enforce a 2-hour daily limit for American users under the age of 18. The apps would also go dark from midnight to 6 a.m. This and more once we return. The chairman of ITC, Sanjeev Puri, supported the food regulator's move to crack down on misleading labels. FMCG companies are being forced to change several claims on labels after the FSSAI sent more than 150 notices. Now, Puri said the regulator is right to raise these concerns. He also signalled more hikes in cigarette prices, citing tax changes. Take a look.
I won't want to comment because I don't have access to all the issues, and whatever is being done or should be done should be in compliance with law, and whatever is not in compliance with law or it's not giving the right perspective, I think the regulator has very much a right to raise issues around it. As far as ITC is concerned, I think we are very committed to not only to go beyond compliance and make sure that we give the highest quality of products and services to our customers. Our biggest fear is losses to illicit. We don't want to lose franchise to illicit, so we want to minimize it. But given the magnitude of the tax increase, some movement is likely to happen. But we like to minimize it, and that's why we have staged the pricing increase. So this will be a journey that we will have to traverse.
Well, that's Sanjeev Puri there of ITC on the FSSAI's crackdown, many companies resorting to relabeling. Now, Japan has committed to investing 10 trillion yen in India over the next decade. Speaking to CNBC TV 18 exclusively, Commerce Minister Piyush Goyal said the investment could materialize over the next 5 years ahead of the original timeline. He also said the legal scrub-off of the India-EU trade deal is complete, with the pact likely to take effect between February and March next year.
Fructify the 10 trillion yen, which is about 70 billion US dollar investment that Japan has committed to do in India over the next decade, may actually happen in less than 5 years.
What can be the timeline for these agreements to come into force, which is possibly going to be a force multiplier for India's exporters?
Well, recently Oman came into force. After that, UK came into force on 15 July. Very soon, New Zealand will enter into force. Around the end of this year, calendar year, we will execute defining documents. The legal scrub is over with European Union, and the 27-nation bloc will enter into force in the first quarter of calendar 27, sometime February, March 27. So all the 38 countries we are hoping to cover, including the US, where we will get preferential market access, will provide a huge $60 trillion additional GDP to the $10 trillion that was finalized during the UPA government. That 10 trillion before 14, 60 trillion in the last 4 years, collectively open us $70 trillion GDP to us.
Well, that is the Commerce Minister Piyush Goyal. NVIDIA is smashing Wall Street estimates across the board in the second quarter. Revenues up 106% year-on-year to a record $96.2 billion. Data center revenue more than doubled as demand for AI chips remained robust. NVIDIA also gave a strong outlook for the current quarter, forecasting revenues of $108 billion, well above Wall Street expectations. The company's CEO Jensen Huang said demand for AI infrastructure remains strong, while the company flagged rising memory costs as a headwind to margins. Take a look.
Return cash to our shareholders. We're going to buy back stock and buy back stock. All the excess cash net of what we need for strategy and operations. And we are going to generate a lot more free cash flow next year than this year. Furthermore, this year we have several very large investments. And those large investments in the AI labs are not going to repeat. You know, the opportunity for me to invest in these frontier AI labs is not going to happen again. And the reason for that is because I expect them to go public.
Well, that's Jensen Huang there on NVIDIA's numbers. Facebook and Instagram are set to change for American users under the age of 18. This after Meta agreed to settle a landmark lawsuit by U.S. states over allegations that its platforms failed to protect children. Now, the tech giant will not only pay up to $17.1 billion over 10 years, it will also make significant tweaks to how young people use its apps with new caps and curfews. Rachna is standing by to break this down for us. Rachna, of course, there is that significant cash payout, but let's talk about the restrictions. What kinds of restrictions come in along with the settlement, and Meta asking others like YouTube and TikTok to also go forward with similar plans?
That's right. The first bit is Meta paying up to $17.1 billion to settle the child safety case brought against it by the American states. Now, that money is also spread over 10 years. Around $12 to $13 billion of it is guaranteed. The balance is contingent, and it depends on whether TikTok and YouTube agree to similar terms. Now, the states can direct the money to youth mental health programs, crisis helplines, and after-school schemes. Each state gets to decide how they use their share. Now, the settlement also rewrites how Facebook and Instagram work for anyone under 18. Those accounts get a 2-hour daily limit by default, counted across both the apps together. Now, the apps are blocked from midnight to 6 in the morning. Notifications are muted at night, and during school hours, like counts are hidden on their posts, and cosmetic surgery filters are barred. And teenagers can ask for a feed that is not run by the algorithm, and only a parent can change those settings. But there are gaps as well. Direct messages do not count towards the daily cap. Neither does long-form video, and this first phase of the time rules runs 5 years and not 10 unless rivals sign up. Because the argument here in the court was when you stop kids from using one app, you push them technically to another, which is why the rivals also need to sign up. Now, Meta must also appoint an independent auditor with access to its systems and a direct line to the attorneys general. Now, Meta denied all the allegations in this trial, which was expected to run over weeks, but it has been settled in just a week, and the settlement carries no admission of guilt.
All right, Rachna, appreciate you joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more. Hello and welcome to the Editor's Playbook. I'm Shriram Finance. Iran and the United States have been locked in a stalemate for 6 months. We've seen retaliatory strikes, a tenuous ceasefire, a short-lived deal, and a double blockade of the Strait of Hormuz. Iran is still pushing back against Washington's much-wanted pressure campaign. Now, earlier this week, the Trump administration unveiled what it calls Operation Economic Outcast, threatening Iran's trading partners with dire consequences if they continue to keep its economic machinery running. But, as has often been the case with the White House, there was little clarity on how exactly Washington intends to execute the threat. The result, Iran has doubled down. And China, which accounted for roughly 90% of Iran's oil exports last year, has warned that such pressure tactics risk fueling further conflict. Meanwhile, traffic through the Strait of Hormuz as we speak is barely a trickle of what used to be. Tehran's defiance is a major challenge for the White House, with U.S. debt crossing $40 trillion and the midterm elections looming in November. Closer home, Delhi is bracing for an all-important BRICS summit next month, with Vladimir Putin, Xi Jinping and Iran's president all expected to attend. Now, Washington will be watching the BRICS summit closely. So today we ask, will the U.S.'s efforts to isolate Iran work? Is the inflationary risk rising, and is a rate hike on the anvil? And can the BRICS grouping muster a show of strength in New Delhi? I'm joined by my usual suspects, Prashant Nair, Nimesh Shah and Shriram Finance. Gentlemen, appreciate you joining us here on the program. As always, it's Operation Economic Outcast, and that is where the story has now moved to. But so far, the oil markets have actually pretty much shrugged it off. In fact, if anything, oil prices have come off. Commodities is another story altogether. But I think the larger message the market seems to be taking from what has happened is that the risk of military escalation, perhaps that is abating. That's less of a risk today. Prashant, would you agree?
Absolutely, Shireen. I think, as you began by saying, right, it's no longer military, it's economic. That itself is basically, in a way, pulling back because, I mean, it's regressing in that sense. And I think that is the starting point here that I think the US for some time perhaps has known that it's reached the limits of what it can do militarily. It's now come to a point where the question now comes, what next? Can you do more militarily? And the answer, I think, has been clear for some time, that unless you are willing to commit boots on the ground, which, of course, I mean, the MAGA base of President Trump in the US is completely opposed to. I mean, actually, one of the core factors, and I think we've discussed this when we started this program, and it was around the time when President Trump had taken over in the US, one of the basic pillars was no more wars, especially no more Middle Eastern wars, right? So while, they've kind of, this particular war has been essentially conducted through the air, feet on the ground is a very, very different kind of thing. So unless you're willing to go there, which I think is very clear, they're not, perhaps they won't or they don't want to, and there is a fair bit of opposition. I mean, I think if that, I think if it were to come to that, it's pretty risk negative as well. I'm talking from a financial market perspective. Now, of course, we're not talking about that, but I'm just saying this is regressing from kinetic military kind of action to now what is economic. And now, Shireen, the point is, even this economic, the D-Day and all those, the bombast, right? Iran has been perhaps the most sanctioned country for the last 4 decades, 3 decades, 4 decades, right? So there's been sanctions after sanctions after sanctions. So how much will these new set of sanctions really achieve is the question, which perhaps we can discuss and debate as well. And that's the reason why. I mean, I think these set of sanctions are basically secondary sanctions, right? I mean, of course, on Iran, but on anyone who kind of trades with Iran or kind of, buys their oil or I mean, there are that entire thing which the US put out. So there's a bunch of things there, but these are essentially secondary sanctions because the country itself has been under severe sanctions for decades now.
No, you're absolutely right. And so far, I mean, at least China has unequivocally come out and said that the U.S. is in no position to dictate terms to trading partners and unilateral action will not be taken lightly. So China has at least gone on the record. We had that interview with the U.S. Treasury Secretary Scott Bessent here on CNBC, where he did tell our colleagues in the U.S. that President Trump was going to make calls to global leaders, getting them to support Operation Outcast. But at this point in time, as you rightly pointed out, it looks unlikely that we're going to see any significant or dramatic, meaningful change over what is already in place. But, let's set that aside. Let's talk about the interesting trends that the commodity markets are throwing up, that the oil markets are throwing up. Brent, as I pointed out, is now trading below 90. Yeah. But the US, November elections, diesel prices, that's the big one, isn't it, Prashant?
That is what matters, right? I mean, when you and I are, in our case, it's different because prices are controlled. In the US at the pump, I mean, people are not buying oil, right? Crude oil, they're buying diesel. That is essentially the real, in that sense, geopolitical hedge, if I can put it in that sense. And by the way, diesel is a traded commodity. Diesel futures are traded. So it's a market out there as well. So let me quickly run you through why perhaps, and when you think about it, right, I mean, the Strait of Hormuz, it may open, I mean, it's one of those things like Schrodinger's cat, right, is open and closed at the same time, depending on who you ask and where you look.
It's open and double closed. It's open and double closed.
So let's assume that tomorrow the Strait of Hormuz opens, right? If you think about it, what is, in a way, the scar tissue which will remain, even if the Strait of Hormuz were to open tomorrow, I don't think it is oil. It perhaps is diesel. Because oil, I think there's enough consensus. We saw a brief sort of trailer with in that sense that when there was a ceasefire, oil prices fell from 100 to 70 very quickly. So there's enough oil. There's no doubt about it in anyone's mind. It's just not getting through. But if this were to open tomorrow, I mean, I think the lasting impact in that sense perhaps is diesel. And let me just quickly tell you why. And this is not new because, so let's, by the way, let me just tell you where diesel cracks are right now. Diesel cracks are nothing but the price of diesel minus the price of oil, right? Diesel, so this difference right now is $100. At the average for August perhaps is a little lower, but it's right now at $100, which is the highest we've had in a while. You go back to when the conflict started, Iran-US, this number was about $73. You go back to, in 2023, it was about in the 30s. When Russia-Ukraine started, it jumped to about 73. 73 fell to 30, back to 73. Now it's about, in August 2026, it's basically at $100 or so. And the reason why diesel essentially is the commodity to watch out for and is the pain point for consumers, and then it feeds into inflation, economies, etc., are 4 reasons, right? Very simply put. Coming into the Iran war or coming even into the Russia-Ukraine war, diesel refining was far tighter. And the reason is pretty obvious. We were moving to a world without fossil fuels. It was all going to be renewables. So generally, there was less capacity addition as far as new refining capacity is concerned. Whereas if you look at oil, there were lots of new discoveries in Brazil, I think in the US as well. Shale has been a big phenomenon in other countries as well. That is one. Second, if you look at Middle East and Russia, the two shocks, they've hit diesel much harder. And why is that? That is largely because, I mean, it's the nature of the thing. I mean, oil is underground, whereas refining capacity is on ground, above ground, and it's a target rich. It's target rich in that sense. We've seen, I've spoken to people from energy consultancies, and they've said very interesting things. They've said, the nature of attacking these refineries has also changed. Earlier, what I heard was these attacks by drones, etc., cheap drones, used to be on the, outskirts, the outer perimeter of these refineries. Now the attacks that you're seeing, especially by Ukraine on Russian refineries, it's basically hitting things which will take much longer to repair and kind of bring these refineries back on track. By the way, Russia's diesel exports are down 40 to 50%, right? So this is the second point. I mean, I don't know if you guys saw, there were these in UAE. I saw over the weekend these visuals where they are netting these these large storage of diesel and refined products, because to prevent against these drone attacks. Number 3, seasonality. You're entering the winter season. Demand for heating oil, etc., goes up. So that's pretty. And by the way, it's also the hurricane season in the US, right? It runs all the way from August to October. And so there's a demand push, but perhaps there is a supply thing as well. And the Chinese are the biggest buyers of oil. And we saw them back, I think, in June, July, because prices had gone up to about $100. They just simply decided to buy less because they had a lot of inventory. I think they cut their purchase by some 5 million barrels and prices cooled off. What will they do with regards to diesel? The only way they can cool diesel prices is by exporting a lot of diesel out, which I don't think, it's not the plan. I mean, they want to have as much of this fuel for themselves, energy security and all of that stuff. So I think 4 basic fundamental factors, starting, of course, from the fact that the starting point was much tighter for diesel as compared to oil. So when you think about what is the lasting impact of this, even if the Strait of Hormuz were to open tomorrow, perhaps I think diesel should be on the top of the list.
Speaking of Schrodinger's cat.
Absolutely, and I like the way that you framed it as a geopolitical hedge. I think that's an interesting point to ponder on. Shriram, you wanted to make a point.
Two points. Because you called it the Strait of Hormuz, the Schrodinger's cat. It's a quantum problem. Yeah. The problem is not whether the Hormuz is open or not.
Superposition.
Whether something, the quantum of oil that passes through is so just adding to that. The second point is that diesel is not the only compulsion, only geopolitical hedge. Bond yields have emerged as the US 10-year bond yield has emerged as a much bigger hedge. And now in journalism, we have this rule of 3. If something happens 3 times, then you can assume that it's a pattern. And this is the third time for when Trump has folded to the pressure from bond markets. First was the Liberation Day tariff on China. The moment it went closer to 5%, he paused it for 90 days. The second was in June, when we were in May, we were talking about US bond yields and the likelihood of the spike. And soon after that, he announced, the moment it reached near 5%, he announced a ceasefire. Now that this was ending, the yield spiked again. And now what he seems to have done with this D-Day is essentially a last roll of dice. And this is not my term, it's a column somebody wrote, a retired colonel wrote on our platform. Please do check it out, this economic D-Day. So to that extent, I think the fear of what Trump can do to Iran is increasingly or rather decreasingly less significant, it seems, at this stage. And that's what the oil markets are showing. But at the same time, the risk aversion that it may cause, which is reflected in the bond yield, is a genuine risk even for India. The cost of capital, how much of the fund flows do come into India. If US bond yields get very attractive, then a lot of capital flight might happen. Then you have commodity price inflation and all of that, which these guys spoke about. And I guess, Nimesh, you have that point to make.
Yeah.
So again,
absolutely, and I think the bond market is, of course, telling you a story and has been telling you a story, as you point out, through the course of the last 6 months, as we've seen this conflict escalate and then de-escalate. But Nimesh, on the risk of inflation, on the risk of a potential rate hike coming in as early as the end of this year, and what's happening with commodities, let's piece all of that together, because let's also remember the MPC minutes that came in after the MPC met, were far more hawkish than the MPC commentary itself.
Right. So, Shriram, I'll come to the India part later, but, while we all talk about crude, diesel, for that matter, the hard commodities like copper, gold, silver and all, quietly this year, it's been a return of these softer commodities. Y2D, look at the kind of moves you've seen in the soft commodity performances. Cotton is up 37% Y2D. Wheat is up 36%. Rubber is up 31%. Sugar is up 15%. And so is soybean up 17%. So clearly, it's not only about...
Iske graphics ke saath, there should be a feels like also, like on Google Maps.
Okay.
Temperature. Sugar definitely feels more than 15%.
No, so clearly, the softer commodities have seen a big comeback, so to speak. And there are obvious reasons. Obviously the geopolitical risk is there, but the fact that there are weather concerns as well, the fact that the import and export has get impacted in many countries because of this war. So clearly that's playing out. From an India perspective, look at what happened to the stock prices in sugar, because that's a clear play from the global surge prices as well. The sugar prices in India has actually been on a tear, and now government has taken some actions as well. But sugar stocks are at a new highs. Stocks are up in the last 1 month. The sugar stocks are up between 25 to 40%, and we've seen a big rally in all the sugar names. Every name will come up. Dwarikesh to Dalmia to Dhampur to Mawana. Everybody's up 25, 30, 40%. Interestingly, this has got a lot of implications on not only on macros but on micros as well, on inflation as well. Goldman today actually put out a note, and they are actually a bit worried about the consumer companies with regards to this sharp increase in wheat prices, sugar prices, palm oil prices. So it's going to have a clear impact on Britannia. That's the most impacted stock from the consumer names. So is Nestle and Varun Beverages, which got impacted because of higher sugar prices. So that's the micro impact on some of the Indian companies and Indian sectors. Macro-wise, everything feeds into inflation, right? And that's going to be a big concern. You rightly pointed out the MPC minute was quite hawkish. Interestingly, Citi put out a note just few days back. The Citi economists had said that they are actually, bringing up their expectation of rate hikes. They're expecting by December at least 50 basis points and a possible another 25 basis points rate hike, depending upon how inflation pans out.
What's going on as far as sugar prices are concerned, and is it likely to remain elevated?
Looks like it, Shireen. So the sugar season runs from November to October, right? I mean, that's the production season. And it's a simple kind of math that the production this time around was, the estimate is lower than what we thought earlier. I mean, that's the industry estimate which came through. There is the carryover stock from last year, which is the inventory, also perhaps was not as robust. You add to the fact that there is, of course, now, a policy push for ethanol. So there is some diversion which has been happening towards that. And you add all of this together, you got this surge which has happened in that sense. So, we were just looking at sugar prices on platforms like Zepto and whatever else. And I think if you talk to your Kirana wala, I think it's north, around 70 or depending on where you look. Yeah. So which has been actually pretty sharp. And the point is you got 2 months more, right? So that data we don't have for the next 2 months. So, but the government has allowed imports in, etc. And of course, the effort, of course, will be to ensure there is enough. This is also the busy season. So in any case, there is a bit of a price increase which you see because of festive demand and all of that stuff. It's just that it perhaps has been on top of that a little bit more.
We'll put out this video of yours and then say, "Kuch kam meetha ho jaye."
I was having this tea right now. I was wondering where is sugar in this. I wanted some sugar.
Let's move away from sugar and focus on the big summit that's coming up, a summit that's going to be watched very closely by the folks in Washington, D.C., and that is because the BRICS will be meeting here in New Delhi. So a lot of the current adversaries, and I say current adversaries because you don't know when the relationship is actually going to turn with the U.S., but China, Russia, the president of Iran, they're all going to be here in New Delhi. The BRICS grouping and whether this can in fact be a show of strength in the current environment. What is the market, if anything, taking away from this and the possibilities, Prashant?
It'll be closely watched, Shireen. That's for sure. But how much will really come out of it, in a meaningful way, which will make a difference to asset prices, to financial markets? I think it kind of remains to be seen. The one thing from a market perspective, which people have talked about for a while, it's not new, is this currency, common currency, right? And every now and then, President Trump, since he's taken over, has lashed out. Said, well, I'm going to impose 50%, 100%, whatever, if anybody is part of this. And he's, of course, gone after BRICS as well. And it's not as if the original grouping was small, and of course it's a much larger sort of set of countries now which are part of this, but a common currency was never really the base case or was never really likely.
I was just plotting the previous BRICS meetings and when they happened. So 2015, July was, so it's either BRICS or SCO or the one that happened in Kazakhstan, whatever, right? The multilateral group meetings where China and India are participants. 2015, there was a meeting where Prime Minister Modi and Xi Jinping met in July. September, we had a border clash. 2016, September, they met. This was again a BRICS summit. 3 months later, in November, there was a Demchok clash. 2017, July, And 2016, by the way, there was 2019. So there is a pattern. Every time they meet, within a few months, there is China engages us in the border, and then we are forced to respond. And in June 2017, for example, it happened within 10 days of it. They're meeting in June, and then within 10 days there was a clash. Then that was the Doklam one. So since 2020, obviously the interactions have gone down a bit. This is the first time I think they're going to meet, in a bilateral summit. No, not the first time, the second time I think in post 2020.
Yeah.
So that is one thing I think the market should watch out for and see if, again, I'm coming back to the rule of 3. This time it's happened 5 times. So it is definitely a pattern. We don't know if they'll follow it up again this time. That's definitely worth noting.
Well, with the National Security Advisor, Ajit Doval was in China, meeting with Foreign Minister Wang Yi, and they did, of course, they are the 2 representatives to work out the border mechanism and on either side. So there have, of course, been active conversations between China and India. And, of course, this meeting was significant because it does come ahead of that BRICS summit that takes place. But both are actively engaged on putting that border mechanism in place. And, of course, that re-engagement on the economic front has already taken place. We've amended press note 3 and so on and so forth. So that has already happened. But yes, as I pointed out, Washington will be watching what happens at the BRICS summit very closely. And of course, there is also that specter of the Russia sanctions bill, right? And we have to recognize the fact that Washington doesn't agree on anything currently. I mean, you cannot get agreement, consensus on anything. Look at the Russia sanctions bill, bipartisan support, 86 votes in favor. And I would imagine that is going to be something that India and Russia will also have to sort of look at and consider. And perhaps that could be an issue that does come up in the backdrop
we were talking before the show.
Meeting. And of course, China is a affected party as well.
So I'm saying, Shriram, we were talking about this before the show, that a lot of things that are moving right now are, what's his name? Ian Bremmer tweeted saying a lot of these world leaders are acting like, they're going to stay there, they're going to be there post-Trump as well. I think BRICS summit is important.
Not acting like. He's saying that they realize that they do have, I mean, Trump's term ends, but until he changes the constitution, he cannot run again. But many of the leaders, including Prime Minister Modi, don't have that problem. And President Xi doesn't have that problem. And I think that's an important point that Ian Bremmer is making. That's an important point that I think Canada is also sending out the message, saying that they'll ride out the Trump administration and ride out the Trump presidency and hold off as far as this whole tariff business is concerned.
I don't know about the others, but Carney is definitely making the right noises, and I think he's gaining the most political mileage out of this. But I want to say this for the markets and for global capital watching this space. I think BRICS summit is important, but right now there is no one event that can take outsized attention. Right now things are, I mean, this week in particular, we have sent Piyush Goyal to Japan. You mentioned the National Secretary Ajit Doval in China. Minister Jaishankar was in Russia. And this has been the most...
Finance ministers in the US.
Finance ministers in the US. And this is true for every country. Yeah. Everyone is... Asim Munir is in Iran. CIA chief is in Moscow. And some of these visits are unprecedented. Like, you can't expect... nobody expected a CIA chief in Moscow, for so long, and it happened. So there is no point in watching just one thing. I think people need to have their eyes on, and I want to highlight some of the key events that have happened in the last 3 months, which have been defining and which has brought us to this point. First, US moving its assets away from Asia towards the Middle East, that allowed China to sort of, finish its construction in Vietnam. Russia, the Putin is suddenly landed up in an island, and a disputed island with Japan. There is Korea and China decide to take the Arctic route to send stuff. Mecca Joint Defense Agreement, the Arab countries coming together to form, some kind of a NATO, kind of an alliance. Japan opened up its military exports, which, again, we have been the first to jump at that opportunity, which I think was a huge opportunity for us, and I think we've taken the right moves. Japanese parliamentarians are in China this week, by the way. Again, unheard of, and it was so unlikely last year when the government changed, nobody would have expected this. Then, like I said, and Ukraine has taken the war well into Asia. Now, some of these things, the impact of these things are like Ian Bremmer says, are likely to last well beyond Trump and any other world leader for that matter.
Prashant, Nimesh, Shriram, as always, thanks very much for joining us. Thoda kam meetha khaiye on that.
Exactly.
It's goodbye. It's goodbye. And thanks for watching.
Hello and welcome to News Center. I am Ashmit Kumar. Now, West Asia tensions continue to have major economic implications for the world, while the war continues to take a heavy toll on the region itself. While the physical damage to infrastructure is significant, the bigger concern is the mounting loss of income and economic activity. Take Brent crude, for example. It surged to around that's $120 a barrel in the month of April and has remained elevated at around $90 a barrel compared with roughly $70 a barrel in 2025. That's before the conflict started. Now, while higher crude prices have supported revenues for some oil producers, they have not fully offset the lost export volumes. Higher freight and insurance costs, along with the weaker investor confidence, are adding to the economic pressure. Now, among the Arab states, Qatar is among the worst affected. The conflict's biggest economic casualty, many are calling it. Its liquefied natural gas exports have been slashed by as much as 96%. According to data cited by Reuters, Qatar has lost an estimated $24 billion in gas sales. That's equivalent to about 5 months of the country's income, and that's based on 2025 data. Now, it has exported just 18 LNG cargoes. That's compared to 509 during the same period a year ago. Qatar is also among the countries playing a key role in the efforts to broker a diplomatic resolution between Iran and the United States. Elsewhere, the economic pain is also becoming increasingly visible. Saudi Arabia's exports shrank by as much as 10% between the first and second quarters, while Dubai's property sales have reportedly plunged sharply. Financial markets are also reflecting this strain. Qatar and UAE stocks have both fallen by around 14%. That's an underperformance of the world stocks by as much as 20 percentage points. While the cost of insuring their debt against default has been rising. Bahrain, however, has been hit the hardest, with its credit default swap prices up by nearly 40%. The IMF has also revised down growth prospects for several West Asia economies, including Bahrain, Oman, Qatar, Saudi Arabia and the UAE. And as the conflict continues to disrupt trade, energy exports and confidence, the situation, many say, is likely maybe to get worse before it starts to get better. Now, Qatar has suffered the sharpest downgrade among the Gulf economies. The IMF has slashed its 2026 growth outlook by a massive 14.7 percentage points from its October forecast, with the economy now expected to contract 8.5%. Now, to help us understand the exact toll that this entire conflict has taken over the last 6 months in the region, we have with us Cornerstone Global Associates Ghanem Nusibi. We have West Asia strategist. Also with us is Milad Rabbani, a former Iranian diplomat. Also joining us is Farshid Bagherian. He's an independent political analyst. To all of our guests, thank you so much for joining us. Mr. Nusibi, let me come to you first. How bad is it on the ground? Give us a picture from the ground. Is the extent of the damage restricted to the visuals that we saw in the first part of this conflict, which is port infrastructure, critical infrastructure being hit? Is it only limited to perhaps the export of oil being stopped on account of the tensions, or is it becoming more structural for these Gulf countries, especially now that the conflict has dragged on for 6 months?
Thanks for having me. There's no real physical damage, beyond obviously what's been published. The real loss is the economic one as a result of both import and export. So the Straits of Hormuz, countries that rely on the Straits of Hormuz obviously are the worst hit, as you've mentioned in your report. Bahrain and Qatar and Kuwait. The UAE and to a lesser extent Saudi, but mainly the UAE, have been able to sort of circumvent the damage. They've been planning for this scenario for many years, and now are working to reduce, ultimately remove their reliance on Hormuz, both for exports and imports. So the economic damage there has really been factored in the UAE. Saudi is doing something similar, but it's going to be much more expensive for them to deal with the damage. Where the greatest damage has happened in Qatar, both hitting the infrastructure, the LG, the Kufad natural gas infrastructure, has obviously affected income, and obviously Hormuz is affecting them now. They will become like Bahrain and Kuwait, more and more reliant on other Hormuz or their neighbors in order to export or import into their countries.
Also with us is Mr. Milad Rabbani. He's a former Iranian diplomat. Speaking of the economic hardship and the economic damage, Mr. Rabbani, if you can give us, to a sense, the situation on the ground in Tehran, in Iran in general. We've seen Scott Bessent, the U.S. Treasury Secretary, launch what he called is an economic offensive that will have severe consequences for Tehran and its trading partners. How bad is the situation on the ground?
Thank you for having me, Mr. Kumar. Regarding of your question, if I want to address your question, I can tell you the situation in Iran is bad, was bad, and will be bad because of this region, because this is what is going on that they want. So, first of all, we should know United States is not in the situation to put embargo or sanction on Iran 100% actually. So Iran has got many options to bypass this, and this is what Russia and China are waiting for them to undermine the supremacy of dollar. And they have many options like cryptocurrencies, like barter, and the options that they are very professional in that. But the situation will be hard. The Arabic countries, they traditionally they depend on two resources. First, their oil and gas and mineral or fossil resources, and the second is tourist industry. But both of them are in the target of Iran. Iran target both of them. Before the war, Iran never threatened openly and publicly. But now, after this war, Iran understand two things, that they can push even to US, they can target US and its allies in the region. There was a scare about that, but Iranian regime now knows they can. And the second is they can go for nuclear weapons, and this is now their policy. So I believe this is what is going in the region is the economic chaos. It is bad for everyone, but Iran will go for a security dilemma. Iran will make the status unstable.
We have Mr. Nasibi coming back to you. In terms of the fallout that we're beginning to see again, I just want to get your perspective. A lot of effort was put in by the countries in the Gulf region to separate themselves, their image, their identity from merely being oil suppliers. They were wanting to see themselves as hubs of finance, of culture, of trade. But just as Mr. Narayan, we had a recent conversation with Mr. Narayan of DP World. He said that the situation has gone so bad that for it to fix itself will take a lot of time. Things will get a lot worse before they start to get better for the Gulf countries.
Well, I mean, it depends. Gulf countries, they're not all the same. Obviously, there are several, and they have different models, and they have different dependencies economically. So, for example, if you look at the UAE, they've really, it's back to normal. It's business as usual now. I was there recently, and hotels are busy, flights are full. The country is functioning as if it was, before the war. They've managed to sort out the logistics, transport logistics, and increasingly less and less dependent on Hormuz. So they've really are on the rapid way to recovery if they haven't fully recovered, and the net increase in the Dubai population has also increased this year. Of course, there's been damage as a result when the war started, but I think they've managed to claw back a lot of it. It's a different situation for other countries, for example, like Qatar, as you've said, Saudi, Bahrain, Kuwait. They all have different dependencies economically and different models, so it's difficult to generalize, but yes, obviously it's not pain free, and it depends where, which country you're talking about. That really matters here.
Sure, Mr. Nasibi, I just want to also get a sense. Oil, of course, is something that is the direct victim here in terms of shipments going out. There are countries who are trying to find ways and means around the Strait of Hormuz. What about the other sectors, such as aviation, tourism, logistics, trade? How much of an impact, a spillover, is this conflict beginning to have in the region?
Well, obviously, at the beginning of the war, there was a major impact on the aviation sector. But things have gone back to normal. As I said, I've recently been in the UAE on several occasions, and all the flights were full between Europe and the UAE. Not just people coming into the UAE, also going to Europe, going to Asia, going to India. It really is business as usual now. Obviously, many foreign airlines have not fully returned, and that's for two reasons. One is not only because they don't feel it's unsafe, that's not the case, but it's also the UAE authorities obviously working with their own local national airlines. They're giving them priority, obviously, as you'd expect. But as I understand it, next month most European airlines will be back resume their schedules. I think British Airways is one of the last ones in October of this year. They'll be flying back to Dubai. Many other airlines have already started again, and they're busy. So if you miss those first 2 or 3 months of the war, and you just appeared now, you wouldn't feel that anything has really changed.
Sure. On that note, let's slip into a very short break. We'll come back and we'll continue this conversation on the other side.
Welcome back. You're watching News Center. India is set to host the BRICS summit on the 12th and 13th of September. China's Xi Jinping, Russia's Putin, along with Iran's president, are expected to be in attendance. This comes amid U.S. efforts to isolate Iran by threatening sanctions on its trading partners. Aishwarya is here with what we can expect. Aishwarya?
India has formally announced that it will host the BRICS summit on September 12th and 13th at the Bharat Mandapam in New Delhi. Along with BRICS members, invites have also been extended to partner countries and regional groupings like the GCC and the African Union. Sources say that the response has been positive, with leaders from Iran, Russia and China expected to be in New Delhi for the summit. This comes at a time when the US is threatening what it's calling the economic asphyxiation of Iran and also threatening secondary sanctions on China and Russia. For India, the summit is the culmination of a year-long diplomatic exercise. The MEA has said that more than 350 meetings and high-level discussions have been conducted across 25 cities in India. This includes 22 ministerial-level meetings and 10 meetings involving the heads of agencies. These engagements have broadly been around three main pillars, which is political and security issues, economic and financial cooperation, and cultural and people-to-people exchanges. The task for New Delhi now is to take this diplomatic exercise and turn it into a consensus at the leaders' table. This has not always been easy. If you may remember, during the foreign ministers' meeting in May, no joint declaration was reached. Sources have said that work is ongoing on a joint declaration, with Sherpa-level talks also underway. On the economic front, India is pushing for practical outcomes, which is cheaper cross-border payments, greater use of national currencies, more balanced trade within BRICS, and a stronger role for the New Development Bank. New Delhi insists that these discussions are not targeting the dollar or any other third country, but they are more about reducing transaction costs.
All right, Aishwarya, many thanks for those details. On to the day's market action then. Markets remained under pressure with the Nifty and Sensex closing at one-week lows. The Nifty slipped below the 24,100 mark. The Nifty Bank fell in line with the blue chips, while the mid-cap index fared slightly better but also in the red. HDFC Bank was the biggest drag on the Nifty after it fell to four-year lows. Z promoter Subhash Chandra's bankruptcy settlement sparked a controversy. 0.03%. That's how much the creditors would recover after the company law tribunal approved a repayment plan of just 6.5 crore rupees against claims of over 22,000 crore rupees. This implies a haircut of nearly 99.97% for the creditors. The Congress party took a jibe at the settlement, calling it a mundan and not a haircut. Ritu Singh is here with all of those details. Ritu?
Well, a shocking outcome for the lenders involved, with the NCLT approving this repayment plan for Z Group's founder and chairman Subhash Chandra, under which creditors are going to get only 6.5 crore rupees against admitted claims of more than 22,000 crore rupees, which amounts to a haircut of 99.97% for the lenders. Now, this case goes back to a loan that was given to Vivek Infracon, for which Subhash Chandra had given a personal guarantee. So when the loan was not repaid, Indiabulls Housing Finance, which is now Samman Capital, had moved against Subhash Chandra in 2022, with the NCLT finally admitting the case in 2024, after which other lenders who held his personal guarantees also joined in. Now, the plan had already received almost 81% voting support from creditors when it was put to vote in November 2024, but there were several large lenders that controlled almost 20% of the voting share. So LIC Housing, HDFC, Axis, Canara, RBL, Union Bank, they had all objected, arguing that almost 62% of the voting is controlled by 5 entities that are linked to Subhash Chandra. But NCLT has rejected allegations that creditor voting was skewed, and creditors also question, in fact, how Subhash Chandra's net worth could have fallen so sharply. So his certified net worth was around 45,888 crore rupees in 2017 versus the current disclosed net worth of 31.8 crore rupees. But again, NCLT says historical net worth figures by themselves don't really establish any concealment or diversion of assets. So the matter now goes back to the original NCLT bench for formal orders. But for lenders, it is an extraordinary outcome. I mean, 99.97% haircut means creditors are virtually recovering nothing. Now, the case has even prompted a jab from none other than Vijay Mallya, who's taken to social media with some visible sarcasm. He called it the Indian debt resolution justice, pointing to the more than 200% recovery that was claimed in his own Kingfisher airline case, and contrasting it with what he says is a pattern of other borrowers settling their debt at a fraction of what they owe.
All right, Ritu, many thanks for those details. A 45 crore rupee payment to Maharashtra Road Corporation comes back to haunt HDFC Bank. The lender and two senior executives are facing a class action lawsuit in the United States. The lawsuit alleges that HDFC Bank made misleading disclosures and camouflaged around 45 crore rupees of payments to MSRDC as marketing expenses to facilitate above-market interest on deposits. The lawsuit covers investors who purchased or acquired HDFC securities between July 2023 and May 2026. The bank said the lawsuit is without merit and intends to vigorously defend itself. The stock fell over 2% in trade today and hit a 52-week low on the back of those developments. Shares of Tata Power declined nearly 4% after a Singapore court dismissed its challenge to a $490 million arbitration award in favor of investment firm Kleros Capital. The dispute dates back to 2013 when Kleros approached Tata Power to jointly bid for a coal mining project in Russia. Vivek Iyer is here with all of those details. Vivek?
That's right. So, late last evening, the company updated the exchanges. What they said is that the Singapore International Commercial Court ruled in favor of the company that Tata Power was actually fighting against in court. This particular company name is Kleros Capital Partners, and Tata Power has actually lost this particular arbitration. Now, remember, to give some context as to what exactly is this particular case. As far early as 2013, both Tata Power as well as Kleros Capital Partners had jointly bid for a coal mine in Russia. And post which, things went sour between both of the parties. Post which, Kleros actually had gone ahead and reached out to the Singapore court for getting an arbitration award. Initially too, they won. Tata Power had appealed that particular verdict. The verdict that has come in yesterday, again, has not gone in favor of Tata Power, implying that Tata Power will now have to pay an arbitration award of $490 million. And additionally, there will also be legal fees as well as interest that is involved. But Tata Power still does have a way out. Now, what they can do is they can file an appeal against this particular decision to the Singapore Court of Appeal within 28 days. We spoke to the management earlier today. They said that yes, that they would most likely be filing this particular appeal as well. And another thing to keep in mind is that even in an arbitration award, it will not go out as one chunk as far as Tata Power is concerned. It's likely to go out in tranches, but still a setback as far as Tata Power is concerned.
So we'll have to wait and watch what happens with Tata Power. Many thanks for those details, Vivek. Japan has committed to investing 10 trillion yen in India over the next decade. Speaking to CNBC TV 18, Commerce Minister Piyush Goyal said that the investment could materialize within 5 years, well ahead of the original timeline. Goyal also said the legal scrub of the India-EU trade deal is complete, with the pact likely to take effect between February and March of next year.
Fructify the 10 trillion yen, which is about 70 billion US dollar investment that Japan has committed to do in India over the next decade, may actually happen in less than 5 years.
What can be the timeline for these agreements to come into force, which is possibly going to be a force multiplier for India's exporters?
Well, recently Oman came into force. After that, UK came into force on 15 July. Very soon, New Zealand will enter into force. Around the end of this year, calendar year, we will execute defining documents. The legal scrub is over, with European Union and the 27-nation bloc will enter into force in the first quarter of calendar 27, sometime February, March 27. So all the 38 countries we are hoping to cover, including the US, where we will get preferential market access, will provide a huge $60 trillion additional GDP to the $10 trillion that was finalized during the UPA government. That 10 trillion before 14, 60 trillion in the last 4 years, collectively open us $70 trillion GDP to us.
And with that, it is a wrap on this edition of News Centre. More news and updates continue right here on CNBC TV 18.
I think there is unanimity on this panel and in this room that India does stand at the cusp of doing something wonderful at population scale, using the benefits of technology and marrying that with the social goals that we've talked about. Indian innovators in the social space have addressed market failures and market gaps, but it's not just in the ecosystem of innovators or impact investors. We've seen corporate India step up to many social challenges, whether it's tuberculosis, it is AIDS, or it is even other issues around education outside of healthcare. There have been solutions that we brought to bear at scale. But the question that's been raised here this evening by the innovators is the questions that we ought to focus on. The journey has been great, a lot has been achieved, but where do we go from here? And what is required at this point in time to do this at scale? How do we take this beyond India? How do we take this to the world? And how do we create meaningful impact? Those are some of the issues that we want to discuss and address here this evening. Mark, you talked about Bill's memo on AI. I have to say it's a bit of an AI warning. So as we talk about all the wonderful things that AI is doing this evening, I'll give you a quick cheat sheet of what Bill has said in that memo today. He's basically called for slowing things down. He said if somebody has a credible plan to slow things down, he would vote for it. He's also called for a robot and a token tax. He believes that the tax system nudges you towards replacing humans with machines, and I think that is going to be a challenge that policymakers are going to have to contend with. He's also talking about reserving some tasks, some jobs for humans. Humans reserved is the term that he is going with, so we'll address all of those issues, and I think they're important in the context of countries like India, where we do, of course, have large populations and a young population as well. But without further ado, Mr. Raghavan, let me start by asking you, I think one of the innovators here left us with a very interesting question. And he said, can we ensure that Indian technologies developed in India, made in India for the world, compete in the world on the back of the beauty of the technology, the magic of the technology, and not on price? What is the role that you believe the government can play there? We have the production-linked incentive scheme in India, which champions manufacturing across 13 different sectors in India. Is it time for the government of India to look at an innovation-linked incentive scheme, an impact-linked incentive scheme? What do you believe is the way forward? Is that even an idea that the government ought to consider?
Thank you very much, Shireen. This is a very important question. And before we started this evening, I was sitting next to an innovator who pointed out that increasingly their market is global, and we heard that over here too. The principal challenge in growing innovations in India and in the world is not the innovative capability, it's not the economic need for it, but it's the pipeline from innovation to market through the regulatory hoops. The regulatory hoops have so far been constantly applied across scale, one size fits all, and that provides one kind of a hurdle. And the other hurdle is, till recently, the regulatory requirement was, if it hasn't been done before elsewhere, we are more wary of it, and you need to go through greater hoops to do it over here. Those are being constantly challenged by industry, by scientists, by other groups, and they are breaking down. So I think we're going to see increasingly Indian innovations going globally. Now, last point, how is that going to happen, right? Because there's always a constant talk about let's catch up with China, let's catch up with someone else, and so on. And by definition, if your goal is to catch up, then you're not going to be truly innovative. You're looking at something which has happened elsewhere, and you want to repeat that here. But over the last several decades, we've got institutions in India which have the capability to do wonderful new things and to scale, and that ability has been transformed by current technology, which actually miniaturizes many aspects and allows the feasibility of new ideas and innovations to come. So you asked what the government needs to do. It's one simple thing. Institutional flexibility is all that is needed. The institutions are there, the talent is there, the people are there, but so far the concern that somehow you need to have whether it's a small institution or a new institution or a state institution or a central institution, the same kinds of rules apply. If they're removed and we have different kinds of regulations for different classes of institutions, then they will be liberated to do wonderful things. That's happening. There's a lot of discussion at the Niti Aayog, at the Prime Minister's office, in different ministries. The One Health mission is a good example of bringing multiple 17 ministries together. So as more and more of this happens and compounds, we're going to see greater impact.
Mark, leave the regulation to the government and provide the risk capital. That's your job. You talked about $4.5 billion. That's what the Gates Foundation has invested in India over the last 2 decades that you've been working here. Of the $200 billion that you have to spend in the next 20 years, how much is going to come to India?
Well, I think that depends on how innovative India is. No,
it's been established that we're at the leading end of the innovation
we like
cycle.
To provide a challenge. You are absolutely at the beginning of the cycle. And in fact, Vijay was being too modest and stuff. I think the nature of our investments in India have actually changed materially just even over the last 5 or 6 years. So, 10 years ago, our investments in India were primarily focused on actual direct service delivery or direct support to the governments around how you get vaccinations out or treatments out for pregnant women or nutritional supplements. Now, a growing portion of our investments, call it 20 to 30%, and our aspiration is that it could go up over 50% of our investments, are actually investments in research and development technology. The One Health mission that Vijay modestly didn't claim for, but helped put together some ideas, and his leadership at DBT, or the work of the ICMR today, or some of the research funding that's been pooled in the latest budget for the government of India, is about enabling and catalyzing the private sector to do things and to drive innovation that wasn't the case of it, and it's built on the platforms that I talked about in my remarks about the 10 years of universal payments, the Aadhaar identity system. Aadhaar, just to take one example that obviously is a core Indian innovation, the MOSIP partnership that we've helped develop with Nandan Nilekani and others now operates in 29 other countries, building on that Indian platform. And so we actually see that investment in India, don't regard our number of what might be in India as not necessarily investments in India for India, it's investments in India for Indian innovation that is also global innovation. If you take something like tuberculosis, and Sri Mulyani and I were getting a presentation earlier today. We've helped with some of our support, with governmental support. There's been the development of a new diagnostic that can be, it can diagnose tuberculosis for essentially $2. That's a fifth of the traditional price of a TB test. That is going to make an enormous impact in India. It already is. And there are also innovations taking place in tuberculosis treatment. And in tuberculosis, we have a partnership with the ICMR around a potential new tuberculosis vaccine, which would be the first new tuberculosis vaccine in a century. But those are also going to be global public goods. They help address tuberculosis in Indonesia or South Africa, my home country, or anywhere around the world. And so these are really both and investments. And so in that context of our Gates Foundation portfolio, is all in pursuit of that goal of measurable human impact. And we are committed to absolutely be in India for the lifetime of the foundation, which is through 2045. And I'm very excited to see how those investments can continue to grow.
Well, speaking of investments, Prashant, let me ask you this from a venture capital point of view. Sri Mulyani was talking about blended finance. The ability to take risks, and what we've seen impact investors do is to take, in their words, extraordinary risks without really visibility on guaranteed returns. Now, is the ecosystem in India ready to take bolder risks than we have previously? You've got some experience with ACT grants that you set up through the course of the pandemic. What is the ecosystem telling you in the ability to take bigger, bolder risks?
Yeah, Shireen, I think it's evolving. It's evolving significantly. I think venture capital in the early days focused largely on urban issues and making urban convenience their primary goal and make money out of that. But I think there's a real shift towards technology and science and some of these areas, and they're leveraging that to also serve Bharat. So, and the next opportunity that a lot of venture funds also see is how can you address not just the 50 million, 90% of venture capital has gone into serving just 50 million Indians. So even if you want to shift not, let's say, to the billion, but the next 300-400 million, then you would have to look at how do you, and in many cases, I think there has to be a convergence of capital across the board. And RDI, which is 11 billion fund and complements a lot of what Gates is doing to be able to scale, these innovations from early to where they can be deployed at scale. I think that's where this convergence will start to happen. If you see globally, nowhere has technology had large impact, institutional and large population impact, without the government also coming forward for research and development. And we are a decade late, but still I think 11 billion is a significant amount of capital to be deployed in the next just 5 years. And I think, and venture philanthropy will complement that. And Gates, what the Gates work has inspired something like ACT, and we see many such folks, and this is where it's going to become a collective. And once it becomes a collective, then it's not really about just philanthropy or venture or government funding. I think all of them will go towards solving solutions, creating solutions for the next 300, 400, 500 million people. And the last thing I'll say is that a lot of these solutions, some of them will be just government support and funded by the government, but we are starting to see a lot of services that can profitably be delivered because of AI, and that could never be delivered before. So market models will start to take over, and that will then just create a more virtuous cycle of more funding from venture capital coming into this whole Bharat opportunity.
Sangeeta Reddy, we're moving to this evolution of, as I said, addressing some of the market gaps, but also market failures, bridging some of the access deficits from education to healthcare. Apollo Hospitals, of course, has been at the forefront of trying to bring to bear experiments in the healthcare space now at scale. Take me through some of the key learnings and insights from what you've been able to do, and you're also at the forefront of using AI to be able to address some of these issues.
So thank you, Shireen. I think it's an exciting time to be alive in the world simply because of our ability to make disproportionate impact compared to any other time in the world. But in 1983, when Apollo Hospital started, nobody perceived that a private hospital could do advanced healthcare, could obviate the need for Indians to go abroad, could have healthcare outcomes on par with global benchmarks and do it at 1/10 of global prices. But that system was proven in one hospital, scaled across many of our own. Today we have 73. But the beauty is that the whole healthcare ecosystem has evolved. And today India does not need to go abroad for care. In fact, patients from 150 countries come to India for treatment. And then we come to the access, because no conversation in a beautiful forum like this can we talk about not having access. And I think insurance and the government-sponsored Ayushman Bharat is creating that access or enablement. Of course, there are many gaps, many things to do. But at the core and the heart of this is a lot of innovation. How did India do bypass surgery at 1/10 of global prices? How did you innovate so that you do off-pump surgery simply because we wanted to save that 10,000 rupee oxygenator, and finally came out with a better surgical technique? There are hundreds of untold stories happening at the back end of healthcare. But I want to jump off, move 30 years, move by fast, and now everybody takes healthcare for granted, or the treatment of advanced problems, whether it's, heart attacks, better care going slowly into global or into village environments, telemedicine, which we began 26 years ago, also pervasive. The government has done 93 crore teleconsultations. It's amazing. So these platforms are being used at scale to bring care within the access. But I want to switch to a completely new paradigm, which we must use, and like I said, dare to dream. How do we keep people healthy? The question which is coming to our mind, we've been doing health checkups for the last 50 years. We've built AI models, risk prediction models. We're trying to change the paradigms. But when we're opening up 5 vessels of an individual who's blocked, the question is, where was this man when his first vessel was blocked? When 60% of India comes to our hospitals with stage 3 and stage 4 cancer, all cancer patients we find at that time. How do we find them at stage 1? So innovation to create biomarkers so that your blood can give you the precursor of having cancer. These are the kind of things, but here I want to flip completely to say, we can't do it alone. We can give the data, we can give the clinical knowledge, we can validate. We need scientists, institutions, innovators. This is the point of time for a collaborative initiative, far greater than we've ever been able to collaborate before. So my request to this panel and to everyone in the audience, let's dream big, let's create some moonshots. What we've done, we're proud of, we want to do a lot more. But what we can do, if we think differently and work on the paradigm of prevention, that's what's exciting me and keeping our organization. This year we did 4.2 million health checkups. In the next 24 months, we want that pace to move to 10 million health checkups a year. We have a background data of over 23 million health checkups and a follow-up data of almost 22% of those patients or those healthy individuals. So we can tell you precursors which can lead up to representation of disease. We have genetic profiles on many of them, not all, but there's so much waiting to be unlocked. So this is the innovation imperative, the collaboration imperative, the dream big imperative, and the think win-win and together time. So that's
the do big imperative, which captures all of that together. Sri Mulyani, speaking of not having fear, at this point in time, I think people are feeling anxious of what the world
driven by AI is going to look like, what this does as far as the jobs market is concerned, and what kind of safety nets governments need to put in place. Bill Gates is talking about a robot tax. He's talking about a token tax. As a former finance minister, what would your remedy really be for governments to start to create the process of putting some safety nets in place?
Well, the first global governance today is actually in a very shaky situation. Many of the...
That's an understatement, I would say.
we call it... Okay. That is the Indonesian way. It's always like, try to... Okay. Many or almost all the global institution which is created post-World War II is now under a very, very difficult situation because the initial shareholder, they maybe have a different way of thinking, seeing how the relationship between countries need to be defined or designed. This is more complicated than saying that. Now, when this kind of situation with geopolitical fragmentation, with all this competition, you combine this with the AI as the technology which is moving so fast, coming from Bill Gates saying that this is going to create much more complicated because threshold has been passed, whether this is on a humanity, whether this is in terms of the abuse of using this AI. I think we really need to think about what kind of governance that need to be designed or redesigned, combining these two thinking about globalization, which is being seen by country as not working, serving each country, even big country like United States, feel suffering from globalization, not only India, Indonesia, or any other emerging country. And also this combined with the changing of this technology. But the question is what kind of new governance? And unlike the situation after World War II, in which then we learn from this tragedy and we want to build world better by creating a certain principle of relationship that is not going to zero sum. I think today we are not yet agree, especially related with the AI, what kind of relationship that is going to be mutually benefiting for all parties to engage. Whether this is the inventors or the governments, the people in general, I think many of the younger generation feel that this is going to threaten them, but not only the younger generation. I'm an older generation, I also feel this very high anxiety regarding what does it mean for our life. You mentioned about taxation, like the robot tax. Well, if source of income is coming from a party, which is currently is going to be like an AI or robot in this case, then if you are trying to design and collect revenue, especially then you try to link with what kind of social safety net that can be built. If you build social safety net to protect people, in this case at least has the level that they can secure their life, that will require revenue. As a finance minister, I know very well many requests regarding I want to have a clean water, safety net, security, and
not pay any tax, and not pay any tax,
and doesn't want to have new debt. So it's like, so where can I have the money in this case? So I feel sorry for all finance minister in the world in this case. So
I think our finance minister would agree with you.
That's true. So that's why within the context of what tax regime that is going to be seen as fair, just, and at the same time addressing the issue not only today and in the future, all the policymakers, especially all my former colleague finance minister, really have to discuss about this. And to be honest with you, within the G20 and all those international forums, that we discuss what is the just and more fair, what you call it, collection tax, preventing the avoidance of tax and tax evasion. Now, if it is the robot which have the AI, when the people, the human want to tax them, what I'm afraid is how you are going to collect those robots who can then redesign AI to actually analyze aborting or, yeah. I really don't know. I mean, in terms of, but in principle, that is makes sense. Yeah. That is makes sense. I mean, whatever that can generate revenue, they should also pay their due. Yeah. But whether you can collect them is another problem.
Is another problem altogether. You're absolutely right. I don't think anybody has the answers or at least a complete picture of what needs to be done going forward. But
until governance is going to be designed, or at least there is a initial clarity about what governance that can and could be established.
Ladies and gentlemen, many, many thanks for joining us here this evening. I think there is unanimity on this panel that while we do have complex issues to contend with in the near term, if we do the right things and we do get our ecosystems to work collaboratively, for that I believe that we do need more women in positions of power. So I would like to add that to the list of things that we do need to do. But hopefully if we do the right things, with the right purpose and the right intention, we should be able to ride out the storm. Thank you very, very much for joining us here this evening. Thank you very much, ladies and gentlemen. Appreciate your time.
Good evening. Thanks for joining us on Business 360. I'm Shriram Finance. The top stories that we're tracking for you this evening. More than 270 people dead. 1,600 are missing after flash floods ravaged Nepal. 288 Indians are among those unaccounted for. Entire villages swept away as a glacial collapse triggers flooding in the mountainous region. An oil tanker comes under attack at the Strait of Hormuz, testing President Trump's claim that the waterway is functioning. Shipping traffic remains largely at a standstill. Crude oil prices down 7% this week. Qatar's Prime Minister visits Tehran in a bid to revive diplomacy. India set to host the BRICS summit on the 12th and 13th of September. China's Xi Jinping, Russia's Putin, along with Iran's president, expected to be in attendance. This comes amidst U.S. efforts to isolate Iran by threatening sanctions on its trading partners. Sensex down over 500 points. The Nifty declines over 100. The Lal Street remains under pressure. The rupee weakens against the dollar, moves closer to the 96 mark. Zee promoter Subhash Chandra's bankruptcy settlement sparks controversy. The company law tribunal approves a 99.97% haircut to creditors, allows Chandra to pay just over 6 crore rupees to settle claims worth more than 22,000 crore rupees. A 45 crore rupee payment to the Maharashtra Road Corporation comes back to haunt HDFC Bank. The lender faces class action lawsuit in the US over allegations of violating securities law and causing losses to investors. Bank says the lawsuit is without merit and intends to vigorously defend itself. The stock hits a 52-week low. Shares of Tata Power hitting a 7-month low after a $490 million legal setback. Singapore International Court has upheld an arbitral award in favor of Kleros Capital in a decade-long dispute. Tata Power plans to appeal against the verdict. The environmental clearance to Google and Adani's proposed data center in Visakhapatnam faces legal scrutiny. Affidavit filed by the state regulator shows the approval exempts the project from central government approval, environmental impact assessment, and public consultations. NVIDIA reports blowout quarterly earnings with profits doubling to nearly $54 billion. Shares rally after NVIDIA expects revenue to grow 70% next year. Facebook and Instagram agreed to enforce a 2-hour daily limit for American users under the age of 18. The apps will also go dark from midnight to 6 a.m. All of this is part of a $17 billion settlement over child safety. Meta also writes an open letter to rivals YouTube and TikTok, asking them to accept the same restrictions. Well, the top focus this evening is the conflict in West Asia and the impact on global energy markets. Let's bring you up to speed with the latest developments. Now, an oil tanker came under attack by an unknown projectile overnight, according to the British Maritime Agency. Traffic at the strait remains largely standstill. According to Kepler, only 10 vessels have managed to transit the strait yesterday. Crude oil prices are down 7% this week, with Brent hovering around the $85 mark. And all of this is really on account of the hope that there will not be a military escalation. Now, in a bid to revive diplomacy with the United States, Qatar's Prime Minister is set to visit Tehran. According to a statement by the Qatari Foreign Ministry, the visit comes in line with Qatar's position that diplomacy is the best way to resolve differences and ensure stability in the region. Iran has also confirmed the visit, saying that talks will be a continuation of Qatar's mediation efforts. However, Washington appears to be in no hurry to get back to the negotiating table. In an interview to Al Jazeera, President Trump said, and I quote, "I have no time schedule, none. I'm not in a hurry," end of quote. President Trump continued to claim that Washington is winning in the conflict. Now, India is set to host the BRICS summit on the 12th and 13th of September. China's Xi Jinping, Russia's Vladimir Putin, along with Iran's president, are expected to be in attendance. Now, this comes amidst U.S. efforts to isolate Iran by threatening sanctions on its trading partners. Aishwarya is standing by with what we can expect. Aishwarya, the BRICS summit will take place in New Delhi in the backdrop of Operation Economic Outcast. What is the Indian government's position on what the likely outcome is going to be?
India has formally announced that it will host the BRICS summit on September 12th and 13th at the Bharat Mandapam in New Delhi. Along with BRICS members, invites have also been extended to partner countries and regional groupings like the GCC and the African Union. Sources say that the response has been positive, with leaders from Iran, Russia and China expected to be in New Delhi for the summit. This comes at a time when the US is threatening what it's calling the economic asphyxiation of Iran and also threatening secondary sanctions on China and Russia. For India, the summit is the culmination of a year-long diplomatic exercise. The MEA has said that more than 350 meetings and high-level discussions have been conducted across 25 cities in India. This includes 22 ministerial-level meetings and 10 meetings involving the heads of agencies. These engagements have broadly been around three main pillars, which is political and security issues, economic and financial cooperation, and cultural and people-to-people exchanges. The task for New Delhi now is to take this diplomatic exercise and turn it into a consensus at the leaders' table. This has not always been easy. If you may remember, during the foreign ministers' meeting in May, no joint declaration was reached. Sources have said that work is ongoing on a joint declaration, with Sherpa-level talks also underway. On the economic front, India is pushing for practical outcomes, which is cheaper cross-border payments, greater use of national currencies, more balanced trade within BRICS, and a stronger role for the New Development Bank. New Delhi insists that these discussions are not targeting the dollar or any other third country, but they are more about reducing transaction costs.
Ishwarya, many thanks for joining us at the BRICS Summit to take place in New Delhi on the 12th and 13th of September. Let's talk about the day's market action. The markets remained under pressure today, with the Nifty and the Sensex closing at one-week lows. The Nifty slipping below the 24,100 mark, down 0.5% low on the Nifty Bank as well. HDFC Bank down to a 52-week low, down about 2%. This on the back of the latest developments with respect to a class action suit in the US. The Nifty Mid-Cap Index closing flat, but with a red tick. So that was the story for the markets, but let's talk about the big corporate story. Zee's promoter Subhash Chandra's bankruptcy settlement has sparked a controversy, and that is because the creditors would recover just about 0.03% of what was owed. The Company Law Tribunal has approved a repayment plan of just 6.5 crore rupees against claims of over 22,000 crore rupees. Now, this implies a haircut of nearly 99.97%. The Congress party took a jibe at the settlement, calling it a mundan and not a haircut. Ritu's here with the details. Ritu, unusual and bad news for the creditors here. What do they intend to do?
Well, a shocking outcome for the lenders involved, with the NCLT approving this repayment plan for Zee Group's founder and chairman Subhash Chandra, under which creditors are going to get only 6.5 crore rupees against admitted claims of more than 22,000 crore rupees, which amounts to a haircut of 99.97% for the lenders. Now, this case goes back to a loan that was given to Vivek Infracon, for which Subhash Chandra had given a personal guarantee. So when the loan was not repaid, Indiabulls Housing Finance, which is now Samman Capital, had moved against Subhash Chandra in 2022, with the NCLT finally admitting the case in 2024, after which other lenders who held his personal guarantees also joined in. Now, the plan had already received almost 81% voting support from creditors when it was put to vote in November 2024, but there were several large lenders that controlled almost 20% of the voting share. So LIC Housing, HDFC, Axis, Canara, RBL, Union Bank, they had all objected, arguing that almost 62% of the voting is controlled by 5 entities that are linked to Subhash Chandra. But NCLT has rejected allegations that creditor voting was skewed, and creditors also question, in fact, how Subhash Chandra's net worth could have fallen so sharply. So his certified net worth was around 45,888 crore rupees in 2017 versus the current disclosed net worth of 31.8 crore rupees. But again, NCLT says historical net worth figures by themselves don't really establish any concealment or diversion of assets. So the matter now goes back to the original NCLT bench for formal orders. But for lenders, it is an extraordinary outcome. I mean, 99.97% haircut means creditors are virtually recovering nothing. Now, the case has even prompted a jab from none other than Vijay Mallya, who's taken to social media with some visible sarcasm. He called it the Indian debt resolution justice, pointing to the more than 200% recovery that was claimed in his own Kingfisher airline case, and contrasting it with what he says is a pattern of other borrowers settling their debt at a fraction of what they owe.
All right, many thanks for joining us. HDFC Bank has already said that it intends to launch an appeal against the NCLAT order. Now, 45 crore rupee payment to the Maharashtra Road Corporation has come back to haunt HDFC Bank. The lender and 2 senior executives are facing a class action lawsuit in the US. Now, the lawsuit alleges that HDFC Bank made misleading disclosures and camouflaged around 45 crore rupees of payments to MSRDC as marketing expenses to facilitate above-market interest on deposits. The lawsuit covers investors who purchased or acquired HDFC securities between July 2023 and May of 2026. The bank said the lawsuit is without merit and intends to vigorously defend itself. The stock fell over 2% in trade today, hitting a 52-week low on the back of those developments. And speaking of a stock under pressure today, Tata Power, the shares declined nearly 4% after a Singapore court dismissed its challenge to a $490 million arbitration award in favor of investment firm Kleros Capital. Now, this dispute dates back to 2013 when Kleros approached Tata Power to jointly bid for a coal mining project in Russia. Vivek is standing by with the details. Vivek, take us through what impact this is likely to have as far as Tata Power is concerned.
That's right. So, late last evening, the company updated the exchanges. What they said is that the Singapore International Commercial Court ruled in favor of the company that, Tata Power was actually fighting against in court. This particular company name is Kleros Capital Partners, and Tata Power has actually lost this particular arbitration. Now, remember, to give some context as to what exactly is this particular case, as far early as 2013, both Tata Power as well as Kleros Capital Partners had jointly bid for a coal mine in Russia, and post which things went sour between both of the parties. Post which Kleros actually had gone ahead and reached out to the Singapore court for getting an arbitration award. Initially too they won. Tata Power had appealed that particular verdict. The verdict that has come in yesterday again has not gone in favor of Tata Power, implying that Tata Power will now have to pay an arbitration award of $490 million, and additionally there will also be legal fees as well as interest that is involved. But Tata Power still does have a way out. Now what they can do is they can file an appeal against this particular decision to the Singapore Court of Appeal within 28 days. We spoke to the management earlier today. They said that yes, that they would most likely be filing this particular appeal as well. And another thing to keep in mind is that even in an arbitration award, it will not go out as one chunk as far as Tata Power is concerned. It's likely to go out in tranches, but still a setback as far as Tata Power is concerned.
Vivek, many thanks. Now, the Gujarat High Court has pulled up a state tax officer for relying on AI-generated case laws in a GST order. The court has quashed and cancelled the appellate proceedings against Fairs Enterprise, finding that the officer had relied on non-existent or irrelevant judgments. The probationary officer acknowledged using AI and tendered an unconditional apology, citing his lack of experience. The court also directed tax authorities to verify AI-generated case law against primary sources and warned that violations could amount to contempt of court. This is not the first time that we're seeing this happen. There have now been repeated instances of orders using AI and basically resorting to AI-driven hallucinations as part of legal orders that are being put out by courts. Now, this is a big one. Google and Adani's proposed data center in Visakhapatnam is facing scrutiny in the Andhra Pradesh High Court after a public interest litigation questioned the environmental clearance granted to the project. An affidavit filed by the state regulator shows that the approval exempts the project from central government approval, environmental impact assessment, as well as public consultation. Ashmit is here with the details. Ashmit, take us through what the affidavit says. What are the points of contention that the litigants are raising in this matter, and what seems to be the cause of concern?
Well, let's break it down into 5 broad questions. Number one, why is Google facing concerns, facing challenges, facing scrutiny in the first place? Well, to begin with, there were protests on the ground that had raised concerns about environmental compliances, on what this will do as far as the local water supply is concerned. It's flagged to be a water deficit area. There were concerns raised how it sits on the edge of a forest reserve. And it is on the back of these concerns that we had a PIL that was filed before the Andhra Pradesh High Court, which again raised similar questions and also importantly sought the cancellation of the environmental clearance and also sought some kind of stay as far as the proceedings are concerned. Now, no stay has been granted, but nonetheless, the proceedings are underway. We managed to gain access to the affidavit that was filed before the High Court. Now, that is what led to answering of some questions. So that brings us to the second question. Is this facility actually near a forest reserve? Well, as per the details that have emerged in the court documents, yes, this facility that has been shortlisted for construction of that data center sits less than 1 kilometer away from a wildlife sanctuary. But nonetheless, the divisional forest officer has given the NOC, so at least in that respect, Google appears to be in the clear. Now, with respect to water consumption, this was another issue flagged in the PIL, flagged by the locals as well. To that end, the data is quite interesting. As per the environmental clearance, Google is allowed to use up to 300 kiloliters of water every day, but importantly, it will be sourced from the rural supply. There's a water reservoir just 120 meters away, and this is again something that had been flagged by various locals in their protests. Their argument essentially was, look, we can't drink data, we need the water, which again leads to the next question. is there an impact assessment that has been done for grant of environmental clearance? Was there a public consultation? Now, importantly, the environmental clearance was granted by the state level authority, but in doing so, the state level authority exempt Google from conducting any impact assessment, from any public consultation, and also from seeking a nod from the center, from the Ministry of Environment and Forest. So no nod was required there. That's as per the state's regulator. Now, all of this will be subject to the court's scrutiny. The court's scrutiny, the court's hearing is not very fast. September 2nd is when the Andhra Pradesh High Court will resume hearing in this case. And mind you, at the last hearing, there was a word of caution that the court had issued saying that there needs to be compliance with the law of the land. The state government will have to explain its position on the 2nd of September.
All right, 2nd of September is the next date as far as this matter is concerned. Ashmit, many thanks for joining us. The devastating flash floods in Nepal have left a trail of devastation. More than 270 people dead, 1,600 remain missing. Entire villages have been swept away. Homes, roads, bridges have been damaged. The death toll is expected to go up further as rescue operations continue. As per the Ministry of External Affairs, 288 Indian nationals are among those unaccounted for. These include 73 Indians who are working on the Trishuli power project. The MEA said that 86 people are from Tamil Nadu are among those missing, while 32 are from West Bengal, 33 from Kerala. 21 Indian nationals from Tamil Nadu who travelled for the Kailash Mansarovar Yatra have been rescued in Nepal. As per Nepal Tourism Board, 517 foreigners are still unaccounted for. These include 65 from the US, 53 from Ukraine, 35 from Australia and 33 from the UK. The Nepal Army says it has rescued more than 350 people so far today from areas affected by the flooding. The US Geological Survey said that a glacial collapse may have caused the disaster and there was no earthquake. Scientists said a huge chunk of ice plunged into the valley below, picking up sediment that was already waterlogged during the ongoing monsoon season. Global aid has been heading to Nepal to support the disaster relief operations. India has sent 2 aircraft with humanitarian assistance to Nepal along with 47.5 tons of emergency supplies. The US is sending a disaster response advisor to Nepal and providing funds worth $500,000. China has also coordinated emergency supplies and cash assistance to Nepal. The rescue efforts continue.
We have received information that a number of Indian nationals who had gone on the Kailash Mansarovar Yatra are currently stranded on the Chinese side. Our embassy in Beijing is making all efforts for their safe evacuation. There are approximately 200 Indian nationals there who have sought our assistance for evacuation. Of them, 95 are in Darchen and currently proceeding to Hilsa to cross over into Nepal. 4 are in Geelong city, 13 Zutulpuk, and they are en route to the town of Saga, and 60-70 others who are also heading towards Saga.
This is the Dhunge Bazaar in Nuwakot. This is near Tesuli area. Till yesterday, this was a road. 24 hours later, all that remains is muck. You see the Nepal Prahari, Vipat Uttakarmi. These are the disaster, state disaster management forces. There are the Nepalese scouts along with other teams who are out at work. There's a JCB which has been deployed to clean the muck and make this road motorable once again. But what is the situation? You see, that's the river that Rajesh Bhardwaj is now zooming in and showing you. That river has also changed its course. There was very little time. Locals speaking to CNN News 18 said that there were very little time that was given to them. These are Nepal police officials, disaster relief officials who are trying to take stock of the situation. They can't go beyond because the river changed its course and washed away this entire stretch of road from here right up till the Tibet-Nepal border. At least 34 bridges have been washed away. That's the version coming in from the locals. Hundreds are missing till now. Many dead bodies have been recovered. But let's show you the river once again. You see the river and all these buildings next to the river. There was the Agricultural Bank Development Limited. You see how the entire first floor has been broken. The curtains tell you the story where the mud brought in by the river went up to the first floor as well.
Well, devastating impact there of the flash floods in Nepal. We'll head into a break, but up next, Facebook and Instagram agree to enforce a 2-hour daily limit for American users under the age of 18. The apps will also go dark from midnight to 6 a.m. This and more once we return. The chairman of ITC, Sanjeev Puri, supported the food regulator's move to crack down on misleading labels. FMCG companies are being forced to change several claims on labels after the FSSAI sent more than 150 notices. Now, Puri said the regulator is right to raise these concerns. He also signalled more hikes in cigarette prices, citing tax changes. Take a look.
I won't want to comment because I don't have access to all the issues, and whatever is being done or should be done should be in compliance with law, and whatever is not in compliance with law or it's not giving the right perspective, I think the regulator has very much a right to raise issues around it. As far as ITC is concerned, I think we are very committed to not only to go beyond compliance and make sure that we give the highest quality of products and services to our customers. Our biggest fear is losses to illicit. We don't want to lose franchise to illicit, so we want to minimize it. But given the magnitude of the tax increase, some movement is likely to happen. But we like to minimize it, and that's why we have staged the pricing increase. So this will be a journey that we will have to traverse.
Well, that's Sanjeev Puri there of ITC on the FSSAI's crackdown. Many companies resorting to relabeling. Now, Japan has committed to investing 10 trillion yen in India over the next decade. Speaking to CNBC TV 18 exclusively, Commerce Minister Piyush Goyal said the investment could materialize over the next 5 years ahead of the original timeline. He also said the legal scrub-off of the India-EU trade deal is complete, with the pact likely to take effect between February and March next year.
Fructify the 10 trillion yen, which is about 70 billion US dollar investment that Japan has committed to do in India over the next decade, may actually happen in less than 5 years.
What can be the timeline for these agreements to come into force, which is possibly going to be a force multiplier for India's exporters?
Well, recently Oman came into force. After that, UK came into force on 15 July. Very soon, New Zealand will enter into force. Around the end of this year, calendar year, we will execute defining documents. The legal scrub is over, with European Union and the 27-nation bloc will enter into force in the first quarter of calendar 27, sometime February, March 27. So all the 38 countries we are hoping to cover, including the US, where we will get preferential market access, will provide a huge $60 trillion additional GDP to the $10 trillion that was finalized during the UPA government. That 10 trillion before 14, 60 trillion in the last 4 years, collectively open us $70 trillion GDP to us.
Well, that is the Commerce Minister Piyush Goyal. NVIDIA is smashing Wall Street estimates across the board in the second quarter. Revenues up 106% year-on-year to a record $96.2 billion. Data center revenue more than doubled as demand for AI chips remained robust. NVIDIA also gave a strong outlook for the current quarter, forecasting revenues of $108 billion, well above Wall Street expectations. The company's CEO Jensen Huang said demand for AI infrastructure remains strong, while the company flagged rising memory costs as a headwind to margins. Take a look.
Return cash to our shareholders. We're going to buy back stock and buy back stock. All the excess cash net of what we need for strategy and operations. And we are going to generate a lot more free cash flow next year than this year. Furthermore, this year we have several very large investments. And those large investments in the AI labs are not going to repeat. You know, the opportunity for me to invest in these frontier AI labs is not going to happen again. And the reason for that is because I expect them to go public.
Well, that's Jensen Huang there on NVIDIA's numbers. Facebook and Instagram are set to change for American users under the age of 18. This after Meta agreed to settle a landmark lawsuit by U.S. states over allegations that its platforms failed to protect children. Now, the tech giant will not only pay up to $17.1 billion over 10 years, it will also make significant tweaks to how young people use its apps with new caps and curfews. Rachna is standing by to break this down for us. Rachna, of course, there is that significant cash payout, but let's talk about the restrictions. What kinds of restrictions come in along with the settlement, and Meta asking others like YouTube and TikTok to also go forward with similar plans?
That's right. The first bit is Meta paying up to $17.1 billion to settle the child safety case brought against it by the American states. Now, that money is also spread over 10 years. Around $12 to $13 billion of it is guaranteed. The balance is contingent and it depends on whether TikTok and YouTube agree to similar terms. Now, the states can direct the money to youth mental health programs, crisis helplines and after-school schemes. Each state gets to decide how they use their share. Now, the settlement also rewrites how Facebook and Instagram work for anyone under 18. Those accounts get a 2-hour daily limit by default, counted across both the apps together. Now, the apps are blocked from midnight to 6 in the morning. Notifications are muted at night and during school hours. Like counts are hidden on their posts and cosmetic surgery filters are barred. And teenagers can ask for a feed that is not run by the algorithm. And only a parent can change those settings. But there are gaps as well. Direct messages do not count towards the daily cap. Neither does long form video. And this first phase of the time rules runs 5 years and not 10 unless rivals sign up. Because the argument here in the court was when you stop kids from using one app, you push them technically to another, which is why the rivals also need to sign up. Now, Meta must also appoint an independent auditor with access to its systems and a direct line to the attorneys general. Now, Meta denied all the allegations in this trial, which was expected to run over weeks, but it has been settled in just a week, and the settlement carries no admission of guilt.
All right, Rachna, appreciate you joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
"25 years in the business, I feel like it's been a lifetime." You know, a little bit of reinvention helps.
That is true.
Women thought that men bought them jewelry out of love, but they've used women as conduits to money launder and store black money multiple times.
Moving away from the wedding business, aren't you?
No, the wedding business is still there. I don't need to advertise it anymore. It's a very secure category for us. The room has got too crowded because of social media. And everybody says कि मुझे भीड़ में नहीं मरना है. So everybody is looking for identity. In the global stage, what really sets your identity is where you come from and where you belong, which is one of the reasons I think that, you know, I did a very smart thing by putting the tiger on the logo because the tiger is a national emblem.
Were you confident when you launched it, and have you been surprised?
No, I was surprised. I was really surprised. You know, I'm never confident because I have imposter's complex all my life. I can't make clothes that make you look like Cinderella stepsisters. The luxury existed in this country because people needed to create distance with money for social status. People who live outside India, they use the accessory as an ammunition to tell people that they come from India. So it becomes...
India has arrived.
When I want people to wear my clothing, I do not want them to represent me. I don't want them to feel that they are representing the country.
You said that you have a difficult relationship with couture.
I see Cinderella in a shirt and jeans.
So you will not need a van to pick up a Sabyasachi outfit? No, never.
I'll kill myself. If I have to make clothing, you would rather fit into an Uber.
What does it truly mean to say that the brand is now going global?
I don't think the brand has really gone global. There needs to be a generational shift in the way people look at India. And India's soft power is India's hard power.
You're right in pointing out that you see this as a 10, 15, 20-year journey.
I'm not really building Sabyasachi for myself, and a lot of what will become of Sabya, I might not even be alive to see it.
Are you feeling a little bit like a startup all over again?
You have to be a startup every day.
How hard is it to step away from the herds?
It takes one trick. Nothing
Really?
else.
One trick.
Just get off Instagram. Why we don't find our voices is because of FOMO.
Is there a piece that you would never sell? A Sabyasachi that you would never sell?
My integrity.
Very few Indian brands have turned Indian identity into a language of global luxury. Fewer still where the designer becomes synonymous with the brand itself. For 25 years, Sabyasachi Mukherjee has built exactly that. Soul in Kolkata, heart in India, but ambition increasingly global. In 2021, he sold 51% to Aditya Birla Fashion and Retail, not an exit, but an attempt to build something that outlives him, in his words. Now that ambition takes its next step, a multi-year collaboration with the Metropolitan Museum of Art, and that is an opening which is expected shortly. The question is simple: can craft become a multi-billion-dollar global business without losing its soul? And can Sabyasachi outlast Sabyasachi? Hello and welcome to Young Turks Reloaded. I'm Shriram Finance, and today we explore the business of all things Indian luxury with the man himself, Sabyasachi Mukherjee. Sabya, great to have you back on the show. Thanks very much for giving us the grand tour of this wonderful new place that you have here in the capital. And before we get started on all things luxury, there's plenty of breaking news from the house of Sabyasachi. So let's start with that. What do you have lined up?
Well, there was an announcement with the Metropolitan Museum, and we are going to showcase that at New York Fashion Week. We've just opened a new store. I'm still reeling with so much because, you know, you're out of work for some time, and then when it happens, it just pours.
Have you ever been out of work?
Well, not really, but, you know, you have a little bit of downtime in summer, and then, you know, the season time comes. There are bridezillas, and there are there are new store openings, and there are multiple categories that need to be pushed out, and now there's a show in New York. I think it's a lot.
So that's a lot to deal with. But, you know, take us through what this place is. It looks like a museum almost, which is the look that you go for with each of your retail stores. But what's special about 26,000 square feet of what you've put together here in the capital?
Well, this is all inspired by Calcutta and my love for the city. So, you know, whether it's the Chaurangi corridor, or whether it's the Hogs Market, or whether it's just the Calcutta trams or time travel, all of my ideas have been put together into retail, because I think that, you know, when it comes to luxury, e-commerce is really going to die, because people need to have human, you know, especially with the onslaught of AI, people need to have more and more human connectivity. And if stores are going to be white boxes, there's not enough reason for people to shop in stores. They could rather shop online. So if you want to bring back people to come back to you again and again and again, you need to build experiences that are worthy of people to travel. And that's how it's going to multiply your business.
So you're saying that e-commerce for luxury as a category, that's on the down?
Absolutely, because I think people are, you know, the amount of people who are dropping off from social media and Instagram is alarming, because a lot of people are finally realizing that life is short-lived, and one needs to take advantage of that and stop living a passive life online and get into the real world. And it's happening everywhere. You know, recently I'm not very digitally savvy. So I was at a big department store in Italy, and then there was nobody at checkout, and you had to talk to a computer. And I was like, what is the world coming to? You know, it's happening in airports also.
Yeah.
And I think a lot of people, if they had to choose between pressing a button or talking to a human, would choose to talk to a human, especially because there is so much isolation everywhere. And retail will quickly understand that the more you bring people into stores, and the more you give them human connectivity and warmth, the more they will buy.
Luxury goods is a market that's seen actually a very, very difficult period, especially in the last few years. Does it not worry you that you're getting into a space at this point in time when it's getting increasingly challenging for the current incumbents?
That's why I'm building these stores. Because you see, my job is to think ahead of time. In the short term, people might think of this as a lavish expense, but I think of it as a long-term investment. Because one of the reasons why luxury is failing, it's because luxury was never meant to be transactional. It was meant to be experiential. So people, because as luxury per se, as we know from fashion goods and services, is becoming more and more transactional. People are finding it disappointing and they're moving into real luxury, which is about experience. And if you want people to shop luxury, you need to give them experience. It's very important.
You know, you said that you have a difficult relationship with couture. Explain that as somebody who's come to be known as synonymous with couture in India specifically. Why do you have a difficult relationship with couture?
I don't know if I make couture because if you equate craft to couture, I don't know it's the same thing. I make very high quality craft, ready to wear and believable clothing. I sometimes think that when you I keep saying one thing, that the smaller is the star, the bigger is the dress, the bigger is the star, the simpler are the clothes. And I think I don't like to make clothes for Cinderella's stepsisters. I would like to make clothes for Cinderella, and I see Cinderella in a shirt and jeans.
In a shirt and a jeans, very different from what you have on display here. There's no shirts and jeans.
Compared to modern, sometimes compared to couture, where you have to buy a van to fit your clothes in, that's still Cinderella shirt and jeans.
So you will not need a van to pick up a Sabyasachi outfit? No, never.
I'll kill myself. No.
Never.
No.
Not even with this multi-year collaboration with the Met. We've seen what happens on the red carpet at the Met.
But that's different. That's costume. That's not clothing. If I have to make costume, I would fit the costume in a train. But if I have to make clothing, you rather fit into an Uber. It's important.
When we talk about global ambition or global aspiration as far as the brand is concerned, what does that realistically mean? What does it mean in terms of positioning? What does it mean in terms of pricing? What does it mean in terms of the kind of international markets that you hope to tap into? And what does it eventually also mean in terms of identity, to take this Indian brand and convert it into a global luxury brand?
So, if you asked me if this was possible about 10 years ago, I would have said it's an impossible dream. Today, I see that there's a remote possibility of this happening because of social media, because what's happened, social media has created connectivity. So what has happened, I think people globally are far more accepting of change, inclusivity, and accepting things from across borders that are alien to them. The second thing is that, the young kids today are not really buying. Because you see, their previous generation bought because they were insecure about their social capital and they needed to buy luxury goods to establish authority. But the younger generation today does not need to buy luxury goods to feel good about themselves because their social capital is not defined by wealth but by purpose. So, they don't feel poor because they're poor. They feel rich if they have purpose. And that has completely altered the game. But what they're all looking for is authenticity, and they're looking for consuming products that are also going to build ecosystems, soft power, and India has so much of it. I've always said in almost all the places that I've gone to that don't mistake India to be a third world country because it truly is a first world civilization. You all might be smart, but we are wise. We are here for the longer haul. And I think eventually, see what has happened with many luxury brands all over the world is that many of them don't even own manufacturing. They trade. They build things in other countries, they bring it back to their own country and they put a label and they charge a premium to it. So the question that a young person is going to ask is that, do I need to buy a kimono from a French brand or rather would I go to a Japanese company and buy it? So as people want more and more and more craft, they will buy it from brands and countries that own the craft. So because for them, provenance and authenticity is important. And as people want to do self-expression through craft, India is going to become a very big player in the luxury business because they would want to buy craft from an Indian brand, not from an international brand that is appropriating the craft and sticking a label.
I was waiting for you to say that. Let's get into this appropriation debate, right? I mean, where do you draw the line between adopting culture or being inspired by culture and appropriating it?
I think the conversation really is about provenance. I'm like, are we willing to buy something from a brand that does not produce anything, but probably outsources everything and puts a label? I think, if you look at the really big players, if you look at Chanel, if you look at Hermes, they're silently increasing and strengthening their back end. They're building factories after factories after factories because they understand that there is a day when people are going to question that, are you producing the product? I think every brand needs to start all over again because it's almost becoming level playing field.
So are you feeling a little bit like a startup all over again?
You have to be a startup every day. You cannot survive without being a startup.
What does that mean in terms of how you're approaching business decisions? You talked about collaborations. You've done many over the last few years, including the likes of Estee Lauder, Louboutin, H&M, so on and so forth, and now, of course, with the Met. How are you approaching these global collaborations differently today?
I want to build collaborations that bring pride to India, that also create cultural awareness. And the third thing is education. We need to educate consumers about better consumption because lack of education gives rise to conspicuous bad consumption. And when consumption becomes bad, everybody suffers and everything suffers. And the first thing that suffers is human excellence.
Speaking of excellence and what you're attempting to do now as far as the jewelry business is concerned and the accessory business, what has driven the strategy in both of these businesses? And have you yourself been surprised by the kind of initial traction that you've seen?
When we do businesses in India, we ask two questions. What is going to be the size of the business and what is going to be the profitability?
Yeah.
We never ask what we are going to build and even if it's necessary. So somebody opens a mall, everybody opens a mall, and there are no customers. So I think the first question that you need to ask today is that, is there space for you? Is there a need for you? And is there a need for you? Are you going to create money or are you going to create wealth? Because there's a very different, when you create money, money is created with greed. Wealth is created with wisdom. Good businesses today should only understand that if you really want to be a business that's long-term, you need to build a business with wisdom. And you see, one of the reasons why a lot of Indians are supporting the brand today is because of the fact that I had the courage to build a brand with wisdom and tell people that no, India can. I was telling somebody the other day that because of the way we are, because of AI, all the white collar people are going to be redundant and the blue collar are going to be the new white collar because they have skill sets that AI cannot replace. There's a lot of things that the world can do that India cannot do yet, but there's a lot of things that India can do that the world can never do, which really depends on our culture, our craft, and our soft power. In the global stage, I think we only try to ape somebody else's power as hard power, but power is power.
Yeah.
Whether it's hard or soft power is power. You have to build on your own power. And India's soft power is India's hard power. So, one of the reasons why this business is going to become a very large business is because it's harnessed India's soft power, which is very unique.
What is the initial reaction and response been from a business point of view to both of these categories in terms of revenue, in terms of sales?
Well, our accessory business this year is going to touch almost 100 crores. And
How long did it take you to touch 100 crores for the clothing business?
15 years.
15 years to get to 100 crores?
Accessories 4-5 years. And I'll tell you, Shireen, the fact is that in the West, people actually buy accessories as luxury first before they buy clothing. In India, people buy clothing first and accessories second. But the fact that even if it's a very small business, the promise is very large. And, I think I did something very smart because I didn't, my name or my initials is not on my logo. My logo is a Bengal tiger, which is a national animal. So when you buy a Sabyasachi bag, you're wearing India as an identity. You're not wearing me as an identity. So I wanted to build a business that India could be proud of. They don't need to be proud of me.
But, in terms of tapping new markets, in terms of also drawing inspiration and sourcing from other markets to kind of make them part of your brand, what does it look like? How is it all shaping up together?
It's, I think the global perception of India is becoming a catalyst for quicker growth. And when I see a wave coming that, people are getting more and more excited about the country, I say just push your ambitions further. And, it's already happening because, if you look at our jewelry business, some of the biggest stars in Hollywood, from Julia Roberts to Scarlett Johansson to Katy Perry to Oprah Winfrey, you name them, they've all worn our jewelry in some of the biggest stages, like the Oscars, where everybody wants to wear the finest and the best.
How did you break into that circuit?
Just by doing a good product. I don't think it's difficult to break in if your product is good. Because, everybody wants to be perceived differently, and everybody wants to, especially with people who have a very large social cachet, everybody does not want to buy sponsored products or wear sponsored products because of the fact that they think that their public image is far more important. Not everybody wants to shortchange their public image for quick money. So there are a lot of big actresses who don't want to wear jewelry just because they're getting a sponsorship or money from a big brand, but they want to wear what feels right for them or their image. And, that's where we are breaking in. And that's what's happening to many, many customers as well. The super rich customer don't need to wear a super brand to make themselves feel rich. I'll give a small example. Let's talk about Kate Middleton. She can even wear Topshop to a biggest gala and nobody can undermine her status. She's secure about who she is, so she can wear even plastic jewelry and people will consider that as cool. And I think that's why I said the bigger the star, the smaller is the dress, and the smaller is the star, the bigger is the dress. Today, not just for India, but anybody in business who can create something that's beautiful and exceptional has a chance of becoming a super brand, because the power of democracy was never as strong as it is today.
Are you more comfortable with the ambition today?
No, and I don't think I ever will be.
No?
I don't think so. I think that ambition as it looks like has become a byproduct of excellence. Many, many things are happening. I didn't go and seek for Met. They came to me. And they came to me because, they probably saw the excellence, and then people think of it as ambition. I've always had a complicated relationship with ambition, but I have a very nurturing relationship with excellence because it's so private.
Let's also talk about the categories that you're in currently. Are there any lines that you draw for yourself to say, that'll be too much? And are there certain boundaries that you want to place the brand within?
No, I don't have a problem with scale and expansion as long as it serves a purpose. I have a problem with loss of integrity. For me, I don't know what I will do, but I certainly know what I want.
Yeah, what will you not do today?
I will never shortchange customer of value. People talk about price. People say Sabyasachi is a very expensive brand, but I can say this without batting an eyelid, Shireen, that if you compare me with all the top 10 brands in the country, I'm still the cheapest because at the price that we give exceptional value. And I'm not even talking about the brand. I'm not talking about packaging. I'm not talking about the floss of big stores. I'm talking about pure cost of goods to price point, to retail price. We give exceptional value because I think great businesses are built where you have integrity of the back end, the business, and the customer. What I would do is I would never drop the customer off the value grid. The second thing that I would not do is I would not go down on my principles. And these principles, for me, ethics, principles of business, these are very important. And third thing is that if my product is not serving a purpose, a social, cultural purpose, that a product does not need to exist. I don't want to do a product just because it makes money, because, it's very short term.
Speaking of what's changing in the marketplace and what are the consumer insights telling you, and we were chatting about the jewelry business, for instance, and how you're finding new customers, but also customers who are transacting in perhaps a new way. How's that also driving how you're designing the business?
There was a time, there was a lot of black money in the country, and women thought that men were gifting them jewelry, but they were using them conduits of black money. And men were using women to money launder, because if you had a lot of cash in your house, you told the wife or the woman in the house to go and buy jewelry so that you could store it, efficiently. And every woman who came to buy jewelry only asked two questions. First question was, what is the exchange value or buyback? And second, what is the making? And then what happened was we came into things like zero making charge or no making charge, which meant that there was no craftsmanship involved. And then, of course, things come to bite you back if you have too much greed. So there are lab-grown diamonds, there are lab-grown emeralds, there'll be lab-grown gemstones. The value of gemstones started falling. But what could have held the value, which was what Indian jewelry was all about, was craftsmanship. Because craftsmen, you obliterated an entire level of high-level craftsmen by making them do, quote-unquote, zero-making jewelry. And when craft skips a generation, it never comes back because the know-how disappears. And so today, a lot of jewelers are coming to understand the mistake that they have done, because craftsmanship has become more important than just gemstones, which is what we are trying to spotlight through the Met collaboration. Secondly, the kids today don't want to buy jewelry for investment because they are smart kids. They would rather put money in stock exchange and get better returns. They want to create valuations. And also the thing that they have understood, that at one point of time, people didn't travel. If you have too much black money, what do you do with it? You can only eat in small restaurants. And you can't even go and check into a 5-star hotel because they'll ask you for a PAN card. So it's like water everywhere, not a drop to drink. So today that economy is going to completely change the way people are going to look at jewelry as a category. So I'm not even doing wedding jewelry anymore because of the fact that when you do wedding jewelry of a certain kind, people can only wear it once or twice in their lifetime. I'm trying to make jewelry that people can wear it almost every day with Western, with denim, high and low, because you can wear it every day and it also appreciates in value. And that is what modern consumption is going to be.
Is there a brand that you look up to today outside of yours?
There are two kinds of consumers. One kind of consumer who buys brands, and the other kinds of consumer who buys product. I would like to believe that people should come to me to buy a product and not buy a brand. It's a little bit of a dichotomy because I know we have become a very big brand. But, it happens to everybody.
But isn't a brand a product with a story?
It is, but, sometimes a brand becomes bigger than the product, and that's dangerous. I talk to a lot of chefs, and their biggest product is that nobody wants to really come to eat my food. They want to come and experience a brand because I'm a top chef. And somewhere down the line, their entire purpose of being a chef was to feed people because they made good food. And they're like, even if I make bad food, people will still want to come and eat it because of the fact that it's become a big brand. And I think that is a pain that we all carry, that the lines get blurred between, are you really buying me because I'm an important brand, or are you buying me because I've got exceptional product? And the only way to get out of that pain is to keep making exceptional products so that at least you can tell them that while the brand is important, the product is more important.
Okay. So this reinvention that you're currently in the midst of, do you believe that you're towards the end of this stage of reinvention, and is the next evolution on the anvil now?
Well, I've already morphed, because you see what we have done is we have stressed a lot over the last few years in creating exceptional product. And, a lot of people don't see it because, when you make small changes by changing a lining or a fit or even a shoulder pad that comes from a better factory, these are invisible changes that a customer never notices. But when they wear it, it subconsciously makes them aware. And I think while people think that I'm a great showman, I make a lot of very silent changes that nobody ever notices, because you have to keep your integrity alive when nobody's watching. And I think I'm getting into a little bit of a comfort zone because I've achieved success. I've tasted what it feels like. I've got global recognition. Now is the time to put your head down and work and make the product better and better.
We wish you the very best of luck, all the success, and hope you have a wonderful New York Fashion Week, and we look forward to all of the action from this. Sabya, it's been an absolute pleasure as always. Thanks so much for joining us here on Young Turks Reloaded. Well, that's Sabyasachi Mukherjee for you. If you enjoyed the conversation, do send us your feedback. We always like to hear from you. Till next week, from the entire Young Turks Reloaded team, thanks very much for watching.
Hello and welcome to this very special broadcast right here on CNBC TV 18. The world of the future is shaped by trade. That is the big defining characteristic of how countries, how nation states, how companies plan their future. And a key part of this matrix is, of course, DP World, one of the largest players in the world. And to help us understand what this will entail, what the next era of growth of trade will look like, is with us Mr. Narayan, the Group CEO of the DP World. Mr. Narayan, thank you so much for joining us. A pleasure that you could take out time for us. Let me begin by asking you a big, broad question. The trade of the future, many say, will be defined by geopolitics, by technology, and importantly, tariffs. We're seeing a lot of back and forth when it comes to tariff pressures from various sides of the world. Some say that the era of globalization, the way it was imagined at least, is over. Do you agree with that, or are we in only for a new phase of perhaps globalization?
The latter. I mean, I think trade is going to continue. Manufacturing will happen in where the best facilities for manufacturing are available, and consumption will happen wherever there is purchasing power. So I am more inclined to go with the view that the patterns of globalization will change. In the past, nobody weaponized what they had. There was a degree of reasonableness attached to sovereign behavior. Regrettably, that has been busted. Which is what is going to cause all the real alignments that you're going to see in the world. So everyone was very dependent on China. Now, if you're a corporate risk manager, you don't want so much dependency on single sources.
Sure.
So some diversification of manufacturing away from China, it's just sensible for that to happen. And so it will. Move to the next best place, whether it's Vietnam, whether it's Malaysia, whether it's India, whether it's LATAM, whether it's places in Africa. It became globalization where there were no barriers to capital flows and flow of goods.
Sure.
Right? Now these barriers have been created.
Okay.
So the financial system was weaponized. The trade barriers started coming up. Sometimes through tariffs, sometimes through sanctions, sometimes through something or the other. All this has basically vitiated that full free environment.
Right.
to something which is now going to be more negotiated, more bilateral, less multilateral. The latest thing you're seeing now is, airspace is no longer free. Marine waterways are no longer free. Everybody is claiming sovereignty over what belonged to the world and humanity. The fact is, the world will find a way. It's a river. If a boulder comes in the middle, it goes around.
We're in the midst of the West Asia crisis. You made references, of course, to waterways, the Strait of Hormuz, the Bab al-Mandeb. Big concerns there as to what that means for trade, what that means for global supply chains. Before we get to that, just want to ask you a question. In terms of the sheer military risks that such a conflict poses, Jebel Ali Port, your flagship, has suffered damage as well. How do you account for these risks?
Suffered no damage.
There's no damage?
No. There's no damage to Jebel Ali Port.
But is there an overhang that tomorrow, if this situation were to escalate, that perhaps raises some concerns? How do you account for these risks?
Well, right now the issue is that vessels are not being able to come through to Jebel Ali. So, Jebel Ali was the nerve center of the connectivity of trade between East and West. If you look at the map, it's actually somewhere in the middle of the world, right? Now, if you take that kind of capacity away, it chokes everything before Jebel Ali and everything after Jebel Ali. If you shut the Straits of Hormuz, or they are not freely navigable, or they are not safely navigable, and do the same to the Bab al-Mandeb and the Red Sea, the costs of goods manufactured on the other side, by the time they get to the consumption centers, is going to go up. So who pays for it? The consumer, ultimately. Now, to the extent that demand is elastic, consumption will reduce. To the extent it is inelastic, people will just have to pay more for everything. So inflation is written all over a situation like this. Consumption pattern, the growth of consumption is going to get stunted because some people will not be able to afford to pay the higher costs associated with this. The fact is there are alternates will come if this lasts for too long, but they will be expensive. Everything will have an additional cost. But broadly speaking, the world will respond. I am convinced that this is not a problem that will last in terms of time for a very long period. I'm hoping that better sense prevails. And you cannot have, so free airspace and free waterways. 90% of the world is water for the use of all. Everybody starts claiming sovereignty, and then you can imagine where this all ends up. And so I hope no bad, unhealthy precedents are set, and the world finds the right leadership to resolve the issues today.
Speaking of precedents being set, you're in conversation with a lot of vessel owners, of course, that navigate through the two critical straits, Bab al-Mandeb, Strait of Hormuz as well. Is there a growing understanding, acknowledgement that perhaps the only way forward is to agree to some kind of, for lack of a better word, some kind of tariff mechanism, a fee mechanism for passing through the strait? I mean, is that something that is the new status quo, the new normal that companies will have to make peace with?
I just think that where does it end? How many countries have allow these kinds of passages. What will happen in Asia? What happens here will set a precedent, right? That you can do this. So, like the Suez Canal was an investment. Something new was created, was built, was not natural. Same with the Panama Canal.
Okay.
But the Strait of Hormuz is natural. So what will happen to cost of energy? 20% of global energy flows through that. And then who will determine what the charge should be? What's good, what's bad? So either people will, if it becomes too much, people will just find a better way. You cannot, I don't believe that. So today, we have a situation where the impact is being felt all over the world.
Right.
And therefore, there must be a lot of pressure, which must come to bear to the warring parties. Losing access to those two straits for global trade will cripple it.
Let me actually get your thoughts on the near-term impact. You mentioned the Strait of Hormuz, Bab al-Mandeb, as to how it lies at the heart of global trade. In the near term, we're seeing shipping routes being changed. We're seeing container costs go up as much as some reports say 70% on a year-on-year basis. Will things get a lot worse before they get better when it comes to global trade? In the near term.
Yeah, definitely. See, capacities today aren't available anywhere. Every port in the world is choked. Because suddenly you've taken away 20 million TEUs of capacity right from the middle. It's no longer accessible. So where all the shipping networks, typically because the trade is globally so imbalanced, you have large ships that start Far East. They lighten loads once in Asia, once in Colombo, Salalah, Jebel Ali, once in Port Said after the Suez Canal. And that is how the east to west trade route works. And then there is a Pacific route, which is straight Far East, China to Europe, and to the US, West Coast. Now, that is not impacted. But this entire route, which serves the whole world, is choked. Plus the impact of energy on energy. So I just think that a resolution will be found. These are very fundamental things. Either it will change the world forever. So some change will happen. Old status quo, in my view, is just not going to happen again. We have a situation today where the world has lost trust in the far west, but no one else has yet won the trust. So you're operating in a vacuum. You're seeing the one common thing that you see across the world, doesn't matter what stage of development you're in. You could be a very advanced country, you could be a developing country, or you could be a undeveloped country. Is that you're seeing, from a political perspective, you're seeing a move to everybody becoming more conservative. So the liberals have lost out major globally. It doesn't matter whether it's the most developed or the most underdeveloped. This is a reflection of not whether globalization was good or not. There's no doubt about it. It was fantastic. A lot of wealth was generated.
Right.
But the problem was in the distribution of that wealth. The exclusion of the benefits of globalization have created these new geopolitical forces, which will play their part.
So you're saying it's a cycle?
It is. It's all a reflection of that.
Sure.
You know, immigration, trade barriers, weaponization of financial systems is a reflection of that.
That's an interesting perspective. How this
But
is
you
all
see it across. So this is not difference.
right.
It doesn't matter what stage of development you're in. So whatever happened post World War II is fallen apart. Something new will emerge.
Many are talking about the China plus one strategy. At least many here in India are talking about it. They talk about how companies want to move their manufacturing out of China, look at geographies such as India, such as Vietnam, which can provide that healthy alternative. What does that do to global trade in terms of perhaps having more centers of manufacturing, more centers of export? Does this bring the conversation forward on the need for having strong supply chains, having solid trade paths, of course?
Absolutely. I mean, you need to first examine why it went to China. Traditional places of manufacturing were becoming too costly, and there was a massive cost advantage to move to China. And somebody didn't believe that China could ever become a threat. So get which capital went? Where do you think capital went from to enable China to become the manufacturing power of the world? It was all US capital. And then you came to a situation where there was over-dependency. But before anything, let me tell you that it was the Chinese who 10 years ago, a decade ago, told every China Inc. manufacturing outfit to produce for the rest of the world outside of China. So as global participants in development of supply chain infrastructure across the world, for a decade we only saw Chinese competition. Everywhere we saw opportunities to develop supply chain related infrastructure, we had only one competitor. That was Chinese.
That's an interesting thought.
So it's not, you can move it, and they did. They moved into Vietnam, big time, Malaysia, Africa, and again it was a question of wherever they saw the opportunity, or whoever saw the opportunity. Now obviously but two things are happening. People want nearshoring. They want to reduce the length of the supply chain to manage risk. People want diversification in their procurement strategy. They don't want to be over-dependent in one geography or in one area. They want many places, many suppliers rather than one. And this is normal. There's no rocket science behind this. This is a normal risk management. You want that kind of diversification. Then you will be superimposed on issues around climate, etc., etc., etc.
You talked about how there is a call for nearshoring. India is hoping to be a part of that journey. It is in any ways a very large consumption hub. It is also looking to become a manufacturing and export hub. In trying to be a part of this new global supply chain, what are some of the issues that India will have to resolve to get a bigger share of GVCs?
I think, India is so uniquely positioned right now. So this is a moment in time in history where I think there's a massive opportunity. As these decisions are being made across the world, that where do we go if we want to diversify our basis for procurement? So I do the analogies like of a hub in shipping.
Okay.
If you're just a hub with no market, in everybody's book you're a cost center, network cost, because there's no revenue generated from a hub.
Right.
But if there is a market close to a hub, then that is where you want to make the hub. So if I look at the world today and I see India, it is the fastest growing market amongst the large markets of the world, amongst the large economies of the world. So to create scale, plus if you look at the demographics of India, look at the availability of human resources, talent, this has to be the natural choice for everyone. Where you have a large market, you can scale to produce for the rest of the world. So again, these are moment in time opportunities. I think we have a very friendly and good environment in India today. But this is a window of opportunity. People will determine and make these decisions in the next few years.
How long would you give it? Next 5 years?
That's it. This is the opportunity for India. I think everybody recognizes India is the place to be. All the economic indicators in India are in the right direction. We have political stability, we have had major reforms, we are a digitized economy. I think I can't think of anything negative except us being able to absorb and move at the pace that is necessary to take advantage of this opportunity. The opportunity is there, staring us in the face.
To profit from this opportunity, you've given India 5 years. What are some of the immediate challenges that you feel the government of India should need to resolve? Is it entering into more bilateral trade agreements? Is it perhaps fiscal support to the industry to make up for any cost disadvantages of doing business here? What would you rate the highest on perhaps the priority list over the next 5 years?
Assist everybody to get the job done. Everybody is looking at India. What might be the challenges they are facing?
Let me then also ask you, if India is this a big attractive opportunity, we've seen the DP world invest significantly into India. Are there other opportunities that you're keen on exploring? Are you looking at further capex here in India?
We've been exceedingly bullish about India for a long time. And we already have, I think, $2 to $3 billion invested in India. And over the next 5 to 7 years, we have another $5 billion to invest in India. We are looking at some major opportunities across the supply chain. Just so you know, we are big in coastal shipping. We have almost 60% of the coastal shipping market share. We're looking to register more and more ships under the Indian flag. And we are using the gift city opportunity to do that. We have invested heavily in our container rail infrastructure in the last many years. We have 6 port concessions. We are bidding with one which is under construction right now in Kandla, Tuna Tekra. I believe we will have some opportunity to look at a big port coming in Maharashtra as well, to which we are keenly awaiting. We are going to be there as participants as and when it gets bid. As you know, we have some concessions which are now ending their concession life. So we are looking forward to what the government policy would be in respect of those concessions. We would love to see those concessions being extended. There's been so much change in the way container terminals are built today, their size, the nature of equipment, the technology that is being used. And these are all 30 years old. So they all need to be better in terms of quality. I think the plan for the new port in Maharashtra, which is significant size, is something that India has required for a long, long time. And someone is hoping to participate there as well. So across the supply chain, DP World has one policy, which is whenever we operate in any country, the first thing we try and do is to connect the country from within across a multimodal supply chain infrastructure, and then connect the country with the rest of the world. So we operate in 80 different countries around the world. So for every Indian business, we can open 80 new markets for them. And that's the kind of proposition we take to owners of cargo and manufacturers for all countries where we operate in. So we participate in the entire trade ecosystem, both within a country and then connect that country to everywhere else in the world.
Great. We're nearing the end of this question, conversation, Mr. Narayan. So a large part of our conversation has been about looking forward. What is the new reality? What is the new status quo? What is the new normal? So let me then by asking you again a forward-looking question. Technology. Everyone is talking about AI. No industry is isolated from this conversation. Tell us, to your mind, when you look ahead at the logistics provider of the future, what changes with the advent of this new emerging technology? Do you see AI applications being confined to the area where you're doing data analysis? Do you see physical AI, automated machinery operating? What is the future of this new emerging technology when it comes to logistics?
All of what you just said. I think, AI, I can tell you about our thought process at DP World. We don't believe AI is to problem solve. We think AI is so huge in terms of impact. We have to reimagine how we do our business, assuming that AI exists.
Mr. Narayan, I'd like to thank you for taking our time and for sharing these insights on a wide array of issues, everything from the West Asia crisis to what it means to have resilient supply chains to pressures that logistic infrastructure often faces and what the future will look like. Mr. Narayan, appreciate this conversation, appreciate the indulgence. Thank you so much for joining us.
Thank you for having me. It's a pleasure.
Always a pleasure.
Thank you.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Loans. Now, we all need them. We all take them. But this is one instrument in the world of finance that must be handled with careful consideration. Now, the Reserve Bank of India recently proposed restricting the sort of revolving credit that NBFCs or non-banking institutions offer retail borrowers. So what is revolving credit? This is basically a type of an overdraft facility or a loan or a line of credit that doesn't have a fixed EMI or repayment schedule. Now, this is, of course, extremely good news for borrowers. It offers a lot of flexibility, but it can also lead to undesirable consequences, both for the lender and the borrower, if the borrower doesn't show repayment discipline and if the borrower doesn't show enough awareness about this form of credit. So while all of this is being discussed at an industry level, this week we thought it's a good time to reiterate some of the basic hygiene principles when it comes to responsible borrowing. And today, particularly for the sake of this show, we are going to focus more on personal loans or credit card loans, basically a form of unsecured borrowing. Why unsecured? Because this is not a mortgage. This is not a loan you're taking against a house that you're buying or a car that you're buying. So we must be very, very judicious when it comes to the use of these loans. We can use them very smartly as well to fulfill our financial goals and aspirations. But how do we do it? Now, to help us with this, to answer all of our questions, today we have on the show Shubhankar Mishra, Interim MD at Equifax India, and Amit Pathak, who's the head of personal loans at Kotak Mahindra Bank. Gentlemen, thank you so much for joining in. You know, usually we spend a lot of time talking about creating assets and investing, but I thought borrowing is a very important topic, and whatever is being discussed at a regulatory level, it just gives us a good backdrop. and a starting point, right? So, Amit, I'm going to open out with you. You're the man with the money at Kotak Mahindra Bank. When all of us...
I think there is unanimity on this panel and in this room that India does stand at the cusp of doing something wonderful at population scale, using the benefits of technology and marrying that with the social goals that we've talked about. Indian innovators in the social space have addressed market failures and market gaps, but it's not just in the ecosystem of innovators or impact investors. We've seen corporate India step up to many social challenges, whether it's tuberculosis, it is AIDS, or it is even other issues around education outside of healthcare. There have been solutions that we brought to bear at scale. But the question that's been raised here this evening by the innovators is the questions that we ought to focus on. The journey has been great, a lot has been achieved, but where do we go from here? And what is required at this point in time to do this at scale? How do we take this beyond India? How do we take this to the world? And how do we create meaningful impact? Those are some of the issues that we want to discuss and address here this evening. Mark, you talked about Bill's memo on AI. I have to say it's a bit of an AI warning. So as we talk about all the wonderful things that AI is doing this evening, I'll give you a quick cheat sheet of what Bill has said in that memo today. He's basically called for slowing things down. He said if somebody has a credible plan to slow things down, he would vote for it. And a token tax. He believes that the tax system nudges you towards replacing humans with machines, and I think that is going to be a challenge that policymakers are going to have to contend with. He's also talking about reserving some tasks, some jobs for humans. Humans reserved is the term that he is going with, so we'll address all of those issues, and I think they're important in the context of countries like India, where we do, of course, have large populations and a young population as well. But without further ado, Mr. Raghavan, let me start by asking you, I think one of the innovators here left us with a very interesting question. And he said, can we ensure that Indian technologies developed in India, made in India for the world, compete in the world on the back of the beauty of the technology, the magic of the technology, and not on price. What is the role that you believe the government can play there? We have the production-linked incentive scheme in India, which champions manufacturing across 13 different sectors in India. Is it time for the government of India to look at an innovation-linked incentive scheme, an impact-linked incentive scheme? What do you believe is the way forward? Is that even an idea that the government ought to consider?
Thank you very much, Shireen. This is a very important question. And before we started this evening, I was sitting next to an innovator who pointed out that increasingly their market is global, and we heard that over here too. The principal challenge in growing innovations in India and in the world is not the innovative capability, it's not the economic need for it, but it's the pipeline from innovation to market through the regulatory hoops. The regulatory hoops have so far been constantly applied across scale, one size fits all, and that provides one kind of a hurdle. And the other hurdle is, till recently, the regulatory requirement was, if it hasn't been done before elsewhere, we are more wary of it, and you need to go through greater hoops to do it over here. Those are being constantly challenged by industry, by scientists, by other groups, and they are breaking down. So I think we're going to see increasingly Indian innovations going globally. Now, last point, how is that going to happen, right? Because there's always a constant talk about let's catch up with China, let's catch up with someone else, and so on. And by definition, if your goal is to catch up, then you're not going to be truly innovative. You're looking at something which has happened elsewhere, and you want to repeat that here. But over the last several decades, we've got institutions in India which have the capability to do wonderful new things and to scale, and that ability has been transformed by current technology, which actually miniaturizes many aspects and allows the feasibility of new ideas and innovations to come. So you asked what the government needs to do. It's one simple thing. Institutional flexibility is all that is needed. The institutions are there, the talent is there, the people are there, but so far the concern that somehow you need to have, whether it's a small institution or a new institution or a state institution or a central institution, the same kinds of rules apply. If they're removed and we have different kinds of regulations for different classes of institutions, then they will be liberated to do wonderful things. That's happening. There's a lot of discussion at the Niti Aayog, at the Prime Minister's office, in different ministries. The One Health mission is a good example of bringing multiple 17 ministries together. So as more and more of this happens and compounds, we're going to see greater impact.
Mark, leave the regulation to the government and provide the risk capital. That's your job. You talked about $4.5 billion. That's what the Gates Foundation has invested in India over the last 2 decades that you've been working here. Of the $200 billion that you have to spend in the next 20 years, how much is going to come to India?
Well, I think that depends on how innovative India is.
It's been established that we're at the leading end of the innovation
we like
cycle.
to provide a challenge. You are absolutely at the cycle. And in fact, Vijay was being too modest and stuff. I think the nature of our investments in India have actually changed materially just even over the last 5 or 6 years. So, 10 years ago, our investments in India were primarily focused on actual direct service delivery or direct support to the governments around how you get vaccinations out or treatments out for pregnant women or nutritional supplements. Now, a growing portion of our investments, call it 20 to 30%, and our aspiration is that it could go up over 50% of our investments, are actually investments in research and development technology. The One Health mission that Vijay modestly didn't claim for, but helped put together some ideas, and his leadership at DBT, or the work of the ICMR today, or some of the research funding that's been pooled in the latest budget for the government of India, is about enabling and capitalizing the private sector to do things and to drive innovation that wasn't the case of it, and it's built on the platforms that I talked about in my remarks about the 10 years of universal payments, the Aadhaar identity system. Aadhaar, just to take one example that obviously is a core Indian innovation, the MOSIP partnership that we've helped develop with Nandan Nilekani and others now operates in 29 other countries, building on that Indian platform. And so we actually see that investment in India, don't regard our number of what might be in India as not necessarily investments in India for India, it's investments in India for Indian innovation that is also global innovation. If you take something like tuberculosis, and Sri Mulyani and I were getting a presentation earlier today, we've helped with some of our support, with governmental support. There's been the development of a new diagnostic that can be, it can diagnose tuberculosis for essentially $2. That's a fifth of the traditional price of a TB test. That is going to make an enormous impact in India. It already is. And there are also innovations taking place in tuberculosis treatment. And in tuberculosis, we have a partnership with the ICMR around a potential new tuberculosis vaccine, which would be the first new tuberculosis vaccine in a century. But those are also going to be global public goods. They help address tuberculosis in Indonesia or South Africa, my home country, or anywhere around the world. And so these are really both and investments. And so in that context of our Gates Foundation portfolio, it is all in pursuit of that goal of measurable human impact. And we are committed to absolutely be in India for the lifetime of the foundation, which is through 2045. And I'm very excited to see how those investments can continue to grow.
Well, speaking of investments, Prashant, let me ask you this from a venture capital point of view. Sri Mulyani was talking about blended finance. The ability to take risks, and what we've seen impact investors do is to take, in their words, extraordinary risks without really visibility on guaranteed returns. Now, is the ecosystem in India ready to take bolder risks than we have previously? You've got some experience with ACT grants that you set up through the course of the pandemic. What is the ecosystem telling you in the ability to take bigger, bolder risks?
Yeah, Shireen, I think it's evolving. It's evolving significantly. I think venture capital in the early days focused largely on urban issues and making urban convenience their primary goal and make money out of that. But I think there's a real shift towards technology and science and some of these areas, and they're leveraging that to also serve Bharat. So, and the next opportunity that a lot of venture funds also see is how can you address not just the 50 million, 90% of venture capital has gone into serving just 50 million Indians. So even if you want to shift not, let's say, to the billion, but the next 300-400 million, then you would have to look at how do you, and in many cases, I think there has to be a convergence of capital across the board. And RDI, which is 11 billion fund and complements a lot of what Gates is doing to be able to scale, these innovations from early to where they can be deployed at scale. I think that's where this convergence will start to happen. If you see globally, nowhere has technology had large impact, institutional and large population impact, without the government also coming forward for research and development. And we are a decade late, but still I think 11 billion is a significant amount of capital to be deployed in the next just 5 years. And I think, and venture philanthropy will complement that. And Gates, what the Gates work has inspired something like ACT, and we see many such folks, and this is where it's going to become a collective. And once it becomes a collective, then it's not really about just philanthropy or venture or government funding. I think all of them will go towards solving solutions, creating solutions for the next 300, 400, 500 million people. And the last thing I'll say is that a lot of these solutions, some of them will be just government support and funded by the government, but we are starting to see a lot of services that can profitably be delivered because of AI, and that could never be delivered before. So market models will start to take over, and that will then just create a more virtuous cycle of more funding from venture capital coming into this whole Bharat opportunity.